All right, welcome everybody to the 2025 TraderLion Trading Conference. We're super excited to be having you guys once again. This is the fifth year now of the conference. Every single year has been fantastic, and this year should be no different. We're really looking forward to this amazing lineup of speakers that we'll get into in just a minute. But first of all, a huge thank you. And everyone right now in the chat, I'd really be curious to see, where are you guys tuning in from? We want to see who's the furthest away, and we'll have a quick contest there. So let us know where you're tuning in from in the chat right now. Just want to say, and we'll get into this more in just a minute, huge thank you to Ninja Trader Live for helping power the conference, and we'll mention them in just a minute. First things first, we've got an amazing star-studded lineup this weekend, the next weekend, and the weekend thereafter as well. We have over 30 traders, 35 to be exact, of market wizards, top educators, and excellent traders as well. Here's just a handful: Morgan Housel, Stan Weinstein, Victor Sperandio, Lando Raschke, Rance Breitstein, and we have many other fantastic ones as well. So looking forward to all their amazing presentations, fireside chats, and I know you guys are going to walk away with a ton of actionable advice. So I look forward to seeing your guys' feedback on these excellent presentations. Here's the lineup for today. We've got Jack Schwager kicking things off, discussing untold stories and defining traits of market wizards. Should be a fantastic discussion. Then at 11 a.m. Eastern, we've got Linda Raschke discussing how to tilt the odds in your favor for both part-time and full-time trading. That should be fantastic as well. Then at 12:30, we've got Pradeep Bonde discussing process equals profit, routines for trading episodic pivots and momentum bursts. At 2 p.m., we've got Leoš Mikulka discussing position management and sell rules, how price progresses. He'll discuss in detail how he trades, moves up stops, decides when to sell into weakness and sell into strength as well. That will be fantastic. Then at 3:30, we've got Lawrence Bensdorp discussing the magic of combining non-correlated systems from a systematic point of view, but there's many actionable takeaways for discretionary traders as well. And then at 5 p.m., we wrap things up with a great fireside chat with Denise, Shull, Bill Long, and John Burns of the Rethink Group, discussing the truth behind trading decisions, discussing the biology behind how we actually can achieve peak performance in the market. So that will be amazing as well. Let us know in the chat right now, who are you most looking forward to of the speaker list? All of them will be great, but I'd be curious to hear which one of these presentations you're most looking forward to. All right. One ask that we do have, because we do keep this completely free, is for you to help us spread the word about this resource. Every single year, for the 4 prior years and now this year as well. Again, this is completely free. We work hard to make that happen. But in exchange, we do ask that you help us let other trader friends know about this resource that we're creating. So if you don't mind, you can easily scan this QR code or click the link that's popping up in the chat and the description as well to tweet out this message right here, which will link back to this live stream as well. So let your trader friends know, let anybody who you might think might be interested in and find value in this, let them know as well, because we want to reach as many traders as possible so they can benefit from listening to market wizards, top traders, and top educators as well. So again, you can scan this QR code or click the link that's in the chat right now. And a huge thank you in advance for doing so. As I mentioned, this conference is powered by Ninja Trader Live. Super excited that they helped us put this together. And this is a tremendous resource that you can learn from, especially if you're focused on futures. They've got fantastic educators and live traders pretty much every single day, 6 days a week. And you can visit the QR code to learn more right there. And the link to that is also down below in the description. Highly recommend going ahead and checking them out. By doing so, you're helping support us and this conference. So thanks so much in advance. And this is a fantastic resource. Great traders. I know many of them who are on this platform, and they share wisdom and lessons every single day. So definitely go ahead and check them out. Also, this conference is brought to you by Deepvue. This, of course, is our charting platform, screening platform, and soon to be in the near future, much more than that. This is my daily driver for screening, monitoring charts, finding new ideas, and we have so many amazing features built in to speed up workflows, save you time. If you're a growth stock, swing, or position trader, this is the best platform to analyze both the technicals and fundamentals of stocks. and the intuitive dashboard allows you to set up, amazing configurations that again help save you time at the end of the day. That's what we're all about. And this is the first ever time that we're offering a free trial. So if you're interested in that, and I highly recommend you do so, go visit deepvue.com. And again, there's no credit card required, but you get a free trial. And again, this is the first ever time we're doing that. So go ahead and take advantage of it and check it out for yourself and see what you think. And definitely let us know your feedback as well. And we look forward to seeing you over there. One other thing I definitely want to emphasize is that these sessions are being recorded. I'm sure I'll get that question a few times today. And if you see that question in the chat, please let them know very kindly that yes, it is being recorded. And we've got a special treat. We've got a free VIP pass, which basically stores all the recordings, all the notes that we'll create, all the slides, all in one place for you on the TraderLion website. And it's 100% free. All you have to do is register. You can scan here to visit that. And the link is also in the description and the chat as well. And this gives you access to not only this year's material, but also all prior presentations all in one place. So you don't have to go, looking all over to find a particular presentation. You can find it very easily. And as I mentioned, we'll be adding speaker notes, key takeaways, a lot of additional resources in addition to the recordings that you don't want to miss. And that's not all. By doing so, you also get access to free giveaways. We'll be giving away a TraderLion Masterclass or annual membership of Deepvue every single day of this conference rather. So you definitely don't want to miss that. And all you have to do to enter is scan this right here and register. We've already got thousands of folks in there. So definitely go ahead and join them and get access to all this free resources. One thing I did want to mention as well is that this conference is also brought to you by the Trader's Handbook. This is our debut book that we just pushed out this year. You can see my copy right here. It's amazing to see this come to light. We worked tremendously hard on this over the past year or more, and it's amazing to hear your guys' feedback. We've had over 13,000 readers and 400 plus reviews in just over a month now. So it's fantastic to see everybody get access to that and to hear what they think. And here's a testimonial from Stan Weinstein, the author of Secrets for Profiting Bull and Bear Markets and the founder of Global Trend Alert. The Trader's Handbook is a clear, no-nonsense resource for anyone serious about improving their trading. It's rooted in common sense, sound technical principles, and most importantly, discipline. The authors focus on price action, trends, risk management, and teach you how to build a real process, not just chase opinions. It's a practical book that respects and emphasizes the core truth that the tape tells all. I recommend that you pick up a copy for your trading library, and that's from Stan. So go ahead and listen to Stan. Pick up a copy if you haven't already. You won't be disappointed. And not only do you get this book here, but this also unlocks access if you go ahead and submit your receipt to us to the full suite of the Trader's Handbook educational course with bonus webinars, bonus resources, bonus model books, and bonus educational articles as well. Really fantastic stuff. So not only do you get the book, but you can also easily unlock all those resources there for you. So definitely go ahead and pick yours up today if you haven't already. And I'm very proud to say that we're rated 4.9 stars on Amazon, over 400 reviews. That's amazing. And looking forward to hearing what you think. And if you already picked up your copy, let us know what you think in the chat right now. All right, let's keep it moving here. Also, I do want to mention we've got a lot of free other resources on the TraderLion website. We've got free courses library. The Ultimate Trading Guide is a fantastic one as well. The TraderLion podcast is archived there, educational articles, and much, much more. And again, you can access all those free educational resources at TraderLion.com. And of course, the link to that is in the description as well. And if you want to take it a step further and go even deeper, we have fantastic masterclasses with amazing market wizards and educators on all topics from trading psychology to market history to futures, contrarian trading, to Stan Weinstein teaching you himself how to use stage analysis, Oliver Kell presenting his swing trading system. And the great thing is that during this conference, all of these resources are 30% off. So you can visit TraderLion.com/university or use the link down below in the description to check out that sale. Great value here. We work so hard on each of these classes. The educators are fantastic, and it's really one of the greatest ways to speed up your basically learning curve. So definitely check this out if you haven't already. And if you don't know which one to start with, one thing I'd recommend is the Oliver Kell swing trading. I think that's a great one to start with, especially if you're a swing or position trader. All right. One thing I do want to ask, because again, this is completely free, this conference, but every year we try to do something good as well on top of that, and that is to raise money for a fantastic charity, St. Jude Children's Research Hospital. Each year we've done this, and each year we've raised thousands of dollars for this great cause that can help children experiencing cancer and help them with their treatments and all of that. So please consider a donation to St. Jude's using the donation box to the right side of the stream, or it might be below it as well. Even $1 is great, and if you enjoy this conference, which I know you will, and learn one thing, please go ahead and pay it forward and donate at least $1. We've gotten so much great feedback over the years from this, and I'll personally be donating as well. Definitely, if you enjoy the conference, pay it forward and consider a donation to St. Jude's. It basically helps, make this conference, work towards the greater good as well, which is fantastic. All right, one more thing is please go ahead and subscribe to the TraderLion channel on YouTube. We don't just do the conference each year. We also have webinars with market wizards. We've got, of course, the TraderLion podcast, educational tutorials, the Trader's Handbook webinars, which go through each chapter of the book and break it down even more in depth, share more examples as well. That was fantastic. If you've watched that series, let us know in the chat what you think. Definitely go ahead and subscribe to the TraderLion channel. Our goal this year is to surpass 200,000 subscribers. So please go ahead and do your part. If you're not already subscribed, go ahead and click that button down below. And also, please go ahead right now and leave a like on the stream. It helps increase visibility on YouTube, and again, helps more traders hear about this resource that we're creating 100% for free. And with that, sit back, relax, and enjoy. Let us know what you think in the chat as we go. Ask questions as well. And one thing I do want to ask you guys is let us know in the chat right now, again, which of the speakers today are you most looking forward to, and also a quick reason why. And with that, sit back, relax, get your notebooks ready, and enjoy. All right, welcome back, everybody. It's my honor to introduce the next presenter at the TraderLion conference, Jack Schwager. He needs no introduction, but I'll give one anyway. Jack is the best-selling author of the Market Wizards series, where he's interviewed the world's top traders to uncover timeless lessons on psychology, risk, and strategy. His work remains essential reading for serious investors and market professionals alike. Jack, first of all, great to have you here. Thank you so much for the time. Welcome.
Thank you. Appreciate it.
Yeah, of course. Let's dive right in. We'll keep this informal, but I think we're going to cover some great topics today. First things first, if you had to reverse engineer a market wizard, not by personality, but what kind of happened to them in their life, what kind of formative events would you kind of set up? Failures, turning points. What would you have as part of their story?
Yeah, sure. So one thing that I've noticed throughout the years of doing these books, is that quite a number of these market wizards started out with an interest in markets in high school, which is not normally a time where most people even know about markets. And I remember, for example, Steve Cohn telling me about how he used to go, at lunch. He would at lunch go to the brokerage firm to look at the board and stuff like that. And I'm finding that now also. In fact, in this new book I'm working on, a couple of traders particularly one started as early as 13. So you're getting an interest in markets. And interestingly, sometimes the catalyst is the high school teacher has a trading contest, and that gets people hooked. So that's one thing. And another thing that's been a common theme is, which was surprising in the first book, but not surprising thereafter because it kept on repeating and repeating, is how many of these people who succeeded enormously completely failed in the beginning. In fact, I would say at least initial failure is much more common than initial success. So I guess there's certainly been people who've been successful from the beginning, and being successful in the beginning doesn't mean that it's not profile, but failure and the ability to recover from that seem to be a big deal.
Do you think that failure is kind of necessary to allow people to understand how they can push risk and really create that performance, or that's something you can learn as well, even if you start out more risk averse?
Yeah, I guess the failure is kind of important in two ways. One, it takes a certain type of personality to be able to overcome and to believe that
Right.
you can bounce back and just to keep going, to be knocked down, keep going, get knocked down, keep going, that type of thing. So it's important in that respect. The other thing is, and I've heard some traders say that who hire other traders say they don't want to, they prefer to hire traders who've blown up before, because at least because if they haven't, they don't have respect for that possibility. So it's important to go through the experience and to know the pain. Actually, good one on this, Ray Dalio is a good example of that. So talked about painful trade where it was like a pork belly trade, and he picked the wrong side, and he was watching every day the market open, limit down, I think it was long, limit down against him, limit down, limit down, limit down. And that pain sort of, that electric shock almost, I don't know if he used exactly those words, but it kind of is paraphrasing the feeling he communicated. That sort of instilled in him the fear that was necessary for risk management to control.
And outside of what we just covered, are there any, looking at the majority of traders you've interviewed, are there any other, key traits, two main traits that many of them share? And, for each of those traits, if some come to mind, are there any market wizards who really embody those aspects of trading?
Yeah, so there's obviously lots of traits, but let's just take two, right, as you asked. So the first one, people, I know people have heard it a million times, but it is the single most commonly mentioned thing that comes up in interviews. It is definitely the thing that if you were to poll all the traders I've ever interviewed, what is the most important thing? I would give you 10 to 1 odds that the answer would be risk management, one form or the other. So as much as people have heard it before, hey, you've heard it before because it's true. And so if risk management embodiment, let me take two of the traders. One, sure. Bruce Kovner, who's probably one of the most famous traders of recent times, and he had a line, and this is also out of all the books, this is the one line that is my favorite sentence in all the books, and probably the one that was maybe most influential on myself. And that line, it's 10 words, is know where you will get out before you get in. And the beauty of that is it's like literally one sentence, and in that one sentence, it captures, I would say, 90% plus of risk management. Because when you are not yet in the position and have full objectivity, decide before putting on a trade, okay, at this point I'm wrong and I'm getting out, preferably by putting in a good till cancel stop, then you've defined what your maximum risk is. And you've got risk control on that trade. You are sure the market can gap beyond it, but in most circumstances, you've pretty much defined your risk. So that is a very powerful sentence, and so in terms of embodying risk control, that's a great sentence. The other thing, the other one I would pick would be Peter Brandt, who was an unknown market wizard. So Peter is a chart trader and basically looks for setups where he believes he can get a much better potential return than the risk required to put on the trade. So he'll be the first one to tell you that chart analysis has very little edge to it. But he's basically trying to pick points where he can put on trades, and as Kovner says, know he's going to get out before he gets in. Pick that point where the trade is a failure is relatively small in its risk compared to what the trade will provide if he's right. And so that looking for trades where you can put it on with limited risk, with the risk still being meaningful, that's an important point, because of course you put on any trade with small risk, you just have it closed, and you'll get stopped out almost all the time. But the idea is that if you can find meaningful trades that you can put on for meaningful risk that is not too far away.
And was there another trait that really stood out? Look, outside of risk management, was there other one that really comes to mind?
I mean, there's lots of traits that stand out, but maybe one that's underappreciated or one that's important is patience, and patience comes into it in two ways. One is waiting for the right trade, and the other is when you're in the right trade, having enough patience to stay with it to its point, to where you realize at least some significant potential, not taking the first day of profits and jumping out if you're right. Now, the person who's kind of the epitome of this, on the patient side of waiting for the right trade, is a fellow I interviewed in Unknown Market Wizards, Amrit Shull. And Amrit is kind of like, I think the title of the, I forget, I should have, I know the sniper is in the
chapter,
title, right?
Yeah.
And it's like waiting for the perfect shot. And throughout that whole interview, he's always emphasizing how important it is not to get distracted by wanting to do something, because two reasons for that. One is those marginal trades, just to be able to do something, are the ones most likely to lead to some loss. But they also distract you from really paying attention and focusing on the key trade, on what is the most important trade. And it's a theme that's come up. It's come up in the interviews I'm doing now. So I'd say he's a good embodiment, thinking in terms of you're waiting for the perfect shot. And he emphasizes that one of the wrong-headed things people have is having a target, percent target every month, because the markets, no matter what your approach is, the markets are not going to provide the same type of opportunities in different situations. So you may be a perfectly good trader, and the market just isn't giving you the opportunities that your particular methodology requires. And if you are trying to meet a return every month when the opportunity isn't there, you're going to end up taking trades that you really shouldn't, and it's not only not going to get you to your target, it's more likely to keep you from your target.
And when you said patience, what came to mind is also how it applies when you're in a winning trade. And I was interviewing a trader that's fantastic, and he talks a lot about letting the randomness of the market work for you, and to get that asymmetric return, once you've worked so hard to establish a position, picked it up at a spot that's low risk and high potential, when it works, you kind of have to be vulnerable to your system and let it work until the trend really ends for whatever your style and objective is. And I think that's a key part of patience as well. So that's fantastic.
I totally agree. And there's a famous line in Reminiscences of a Stock Operator, which many of your listeners probably are familiar with,
Yeah.
which is the protagonist. It's not written by Livermore, but it's about Livermore. And there's a line in there where he says, it was never my thinking that made me the money. It was my sitting. Got that? My sitting. And that's exactly that point.
Yeah, excellent. You mentioned a few recent interviews from Unknown Market Wizards. I know you may have started interviewing already for your upcoming book, which I'm looking forward to, but were there any of these recent interviews that really stood out to you outside of what we've already talked about? And I'd be curious to hear why as well.
Like favorite interviews or whatever?
Yeah, favorite interviews.
Yeah, so I'm working on this book now. And by the way, let me just say here that for the first time ever, I'm working with a co-author, George Coyle. And if you want to get into it at some point, we can discuss how that happened. But in fact, he was the catalyst. I wasn't planning to do the book. And it turned out through our conversations, he ended up being the catalyst for doing it in the first place. But anyway, favorite traders. So in this book, actually, there's a couple that are interviews that I think are as good as any I've ever done, and now we've done. And one of them actually is, it's the first time I'm going to have a full chapter with an anonymous trader. And the the reason is that, well, he has a phenomenal story, phenomenal record. I mean, this is a guy who literally went from 50,000 to like a $500 million. All right, so it's a phenomenal story. He's also an unusual background for a trader. He's a musician, and he also had a number of failures early on. So altogether, that particular chapter is one that I would say is one of my favorites. But right now, maybe the favorite of the ones I've done. There's another chapter in this new book, another one I particularly like, and we're not including any chapters that aren't good, but sort of thinking of which, if I had to pick, are my favorites.
Yeah.
And there's another
Your favorite
one,
children.
Yeah, well, that's not. Yeah, favorite children. You're not supposed to have favorite children, but
Yeah.
Anyway, Christian Kulamaji, who has a well-known presence because he did a lot of social media stuff and sort of taught people a lot of things. He was very free in sharing his methodologies and he did these live sessions for multiple years where people could watch him actually trade the whole time. And his story also is interesting because he just started trading with no knowledge, no skill. He had graduated. He was a security guard, essentially, just that's how he's making money. And he took the money he earned as a security guard to trade. And he blew out a few times, and he finally got it. And then built it up to like, and he started with like 5,000, literally 5,000. Built it up to, at his peak, he was over 100 million. And then actually suffered a big drawdown, which he was very honest about talking about it and telling and completely explaining what happened to him and why it happened, and very, very honest in his whole narrative. So that's another. Although he still ended up with a fair, he had a huge drawdown, but still, even if he ended up with only 50 million instead of 100, coming from 5,000 even to 50 million is still a story. And like I say, his honesty was refreshing. And one of the things he said, interestingly, was that he didn't. He's very self-effacing. He said, "I haven't come up with anything original. Everything I do in trading, I've got from somebody else." And he does give credit where credit is due.
Yeah, quite a bit of our audience is inspired by Christian, actually. So I've watched quite a bit of his streams and really looking forward to that chapter.
Yeah,
so that'll be fantastic.
I have to say, I really like Christian. Just, I love that honesty in that interview. Yeah.
Yeah, excellent. I also want to know, kind of looking back at your whole catalog, which is quite a few market wizards now. Were there any that really stood out in terms of how their edge was unique? We just said with Christian, nothing new is in the markets, but I talked with Chris Camillo from last year, and his edge is TikTok and looking at social sentiment. So yeah.
So really, I have to say there's two. I got to mention two people here, and one you just mentioned, right, Chris Camillo. And for those people who don't know Chris or what he does, and you've kind of given a little introduction there. The amazing thing is, and let me preface this, I went through a whole career in markets, 50 years virtually, I guess, 50 years, and before I did this Chris Camillo interview, and my concept was, well, you either use fundamentals or you use technicals, or you use some combination of two. That is 100% of the universe. And the incredible thing is, I didn't realize that that's not 100% of the universe. Chris Camillo doesn't use any fundamentals. He doesn't use any technicals. And when people hear that, they kind of say, well, my reaction, well, how's that possible? And the reason it's possible because he trades 100% on social media. Doesn't need to know, want to know, or need to know the fundamentals, doesn't use charts. He basically just all his trades are based on social media and also picking up social trends. He's using social media. There's a bit of the Peter Lynch approach to his thing, because when he started out, it was a matter of just seeing what trends were happening. Even as a kid, there was another guy as a kid. I mean, he was a high school kid, and he would go to auctions to buy stuff and then resell. He'd find stuff that was underpriced, undervalued, and then be able to resell it. But he talks about going and stopping. He had this thing he always wanted to stop for I think it was an Arizona soda. I'm not sure which one it was. And one day seeing that it was displaced by another brand, and went back to his brother, who was a broker, and said, "How can I take advantage of this?" And his brother explained options to him, and so he bought calls on the stock, and that was his first trade. So he's one. Now the other one, I mean, Chris is completely unique in that, as I just explained, but another person who's completely unique because he literally breaks all the rules was a fellow called Jimmy Baladimas, who was a prop trader for First New York. And I knew about him because my son, first job out of college was got hired as a trading assistant, and they assigned him to Jimmy Baladimas. And my son tells me, "Dad, you wouldn't believe this guy." He tells me about him. So I knew he was legitimate because my son worked for him and all that. And as I said, Jimmy Baladimas breaks all the rules. This is a guy, not just contrarian, but he has to fight every trend. I mean, and not to his benefit, by the way. People are going to think, well, if it's not to his benefit, he's fighting a trend. How the hell is he? Is he very successful? And the thing is, he had this. He was always taking quick profits along the way. So he shorts a stock, and let's say he shorts it at 100, and the stock is going to go to 250. He's dead wrong on the stock, but he shorts it at 100, gets a little break to 99.5, takes a profit. So he's constantly trading in and out. He was so talented at trading around the stock that when the trend was really dead against him, he kind of compensated for most of the loss. And when it wasn't, he was making money. And so I interviewed him in a month where it was one of those months where the market was up. Couldn't put together 3 down days. I mean, 2 down days and then to make a new high. 2 down. And in the very last day of the month was when I interviewed him. The market, there's some news, and the market rallied, fell 2%. He was being short the whole time. So the whole month of stock, and he ended up that month near break even, which was great because he was wrong all month long and just made a null back. But so that was his talent, and the reason why he's different is exactly that. He was doing what you shouldn't do, which is fight the trend. And I say in that chapter, my first sentence is Jimmy Baladimas breaks all the rules, and my first sentence that's an introduction, and my first sentence in the conclusion is something along the line, maybe exactly, don't try this at home, literally. And I think because 999 out of 1,000 people who would do what Jimmy's doing would not only lose, but will lose everything. So it's one of those situations where there's, I was going to say, it's not that there's no lessons to be learned. The incredible thing is that despite that, there's a really important lesson to be learned in that interview. And that is that people tend to think of trades as binary, in the sense, you get in an X and you get out a Y.
Right.
But the real insight here is that it can be tremendously powerful to be able to trade around the position. For example, let's say you buy a stock at 50 and you think it's going to 60. Okay, that's your trade, and then it quickly runs up from 50 to 55. So the idea there is, you could stay with it and hope it goes to 60. But you could also say, okay, I'm going to take profit on a third or half or whatever. And now, let's say the stock keeps on going. What's the worst thing that happens to you? You've made $5 on 50%, and you'll make $10 on the other part, okay? Good outcome. Now, what if the stock pulls back or a commodity or whatever it is, pulls back, which often happens. Now, let's say it pulls back to 52. If you had kept the whole position, you're sitting there thinking, hey, I had this $5 profit, now it's at 52. I better just take the $2 before it goes back and I lose everything, right? So it makes you much weaker. But let's say you sold it at 50, part of it at 55. Hey, you're happy it's going to 52. Now you can put it back on. So this idea of trading around a position is a really good insight, and that comes out of that interview. So while his methodology is one I would say no one should try, that part of it is really important.
Yeah, and if you hold your whole position, it pulls back to 52, you sell, it's going to reverse back to 70 quickly. And you've lost out because psychologically, exactly.
But it puts you in the key idea is it puts you in a much stronger position.
Exactly. And, speaking of don't try this at home, what's the flip side of that? Are there any market wizards where their styles seem the most repeatable for not common folk, but, traders who want to get good at this, put in the time, all of that? Are there any styles that really stand out?
So a lot of it is very individualistic, and some styles are, a lot of styles are completely not applicable to most people, whether it's somebody like Jim Thorpe, Ed Thorpe, I said Jim Thorpe, thinking football player, Ed Thorpe, who was just a brilliant quant and kept on coming up with different methodologies to get capture inefficiency in the market. That's not going to be applicable to almost anybody. And then there are traders who are very intuitive, and when you have somebody like that, again, it's almost an innate skill. So you either have that type of innate skill or you don't. Right. So there, and the methodologies all tend to be very different. But I think ultimately, and then you have traders who use fundamentals in a very deep sense. Again, for most people, probably not repeatable because they're not going to do all the work that's involved, or be able to think in those terms. I think of somebody like Kovner, who when I spoke to him all those years ago, was talking about all these different. He was up to speed on all the intricacies of not just U.S. economy, but all key European nations, Australia, New Zealand, even anything. He just had this, and commodities, and interest rate markets worldwide, the whole picture. So again, that type of ability to see all these different factors and how they combine and be able to put it together effectively, again, out of reach, I think, for most people. So I think something like a Peter Brandt approach, which is using charts and trying to identify, and this comes up in the new book also, there are other traders in this new book who use charts, different methodologies of charts, but they find the particular patterns that they see have an edge, because they seem to win much more often than they lose, and they know when it fails where they get out. So right. I think that's a type of approach for people that is probably more within reach than a lot of other approaches.
And when you're preparing for an upcoming Market Wizard interview, what do you do to really make sure you're ready and have the right questions to ask? Do you like to learn a lot about their style ahead of time from different sources, or do you like to go in with kind of a blank slate and just see where the conversation goes? So
in the past, I basically will know just general things, and I want to know basically what kind of trader they are, and so some stuff that might be, when it's a public person, I'll check some of the public things that have been written, or I'll get something. A lot of times these are traders that many of the interviews are individual traders who there is no background. In fact, Unknown Market Wizards, the entire book is like that. They're really
Right.
there is no preparation. It's all going in. So I'd say of those two extremes of doing a lot of prep and going blank slate, I'm probably much closer to the blank slate school. And I go into these interviews with the intention of not with a list of prepared questions. In fact, how could I have prepared questions if in many cases there's no background that I know, right?
Right.
So I basically just try to have a conversation. And most important here, and I tell people this who might be doing interviews, and is the most important thing is to listen to the answers, because I'd say the biggest mistake that unskilled interviewers make is they have a list of prepared questions and they're so busy waiting for the answer to stop to get to the next question that they're not listening to the answer. And in my experience, most of the good material in the Market Wizard books came not from the first question, but they came from following through, and somebody says something, oh, that's a tangent, and you go off on that tangent. So that's very critical. So I try to have a conversation and listen to the answers, but I don't do much preparation. In fact, preparation before the interviews is definitely well less than 1% of the work. The actual interviews is probably less than 3%, or certainly less than 5% of the work. And most of the work is taking those lengthy interviews and boiling them down into readable chapters.
Right. And how many interviews do you typically have with a market wizard? And is it helpful to see them, 3 months apart, 6 months apart, to see maybe different market situations and all that?
So it's never like that much apart. It might be, but in many cases there are multiple interviews. Steve Cohen was, Ray Dalio was. A lot of them were multi-market. Actually, I would go for the book. I don't know if the majority were. I don't think the majority were, but a significant number occurred in more than one session. And then some of them are single sessions, but they tend to be longer single sessions. So it varies. It's both ways.
Yeah. And I actually don't know this. What was kind of your impetus for starting the series? And at the beginning, when you weren't as well known, was it tough to get some of these traders to agree? It sounds like you started out with a lot of traders that you knew already, so that's certainly helpful. But was it tough to get some of the first guests to be interviewed?
The first book, I was enormously lucky to the point that I didn't realize how lucky I was, and that I got, I had very few I don't remember the rejections I had on the first book. But the way that the Market Wizards whole series began, and it didn't begin as a series, I never intended to do a second volume, but so
we're lucky that there was, so it's great.
What's that?
We're lucky that you kept on writing them, so yeah.
Thank you. The way it started is, I was to give the background here. At the time, I was a research director in futures markets, and had been doing that for about 10 years or so. I didn't think there was a really good book, comprehensive book on futures market analysis at the time. And we're talking now back in this is early 80s. So there were books out, but I didn't think there was really a good comprehensive text. And and this sounds terribly conceited, but I thought I could do a better book than anything that's out there. And that was my motivation. It wasn't to sell books. I just wanted to write the best book on futures markets. And I took a sabbatical. Things worked out conveniently in a way, and I took a sabbatical. And this is pre-PC. I mean, PCs existed. I wrote the book in '83. This was a book called A Complete Guide to the Futures Markets. I wrote that book in '83. PCs existed, but not the way we now with all the programming. So you have to be a real tech nerd to be into PCs at that point in time. So I did this all I did this all manually, so no word processing, no Excel sheets, and literally remember, I can still see myself with this calculator, this hand calculator I had, and literally doing multiple regressions by hand on a hand calculator. So it was, and the book itself ended up being like almost 800 pages. So it was a real intensive job, and it took about a year. I never wanted to do, I did end up doing other analytical books, but I didn't intend to at the time. Anyway, so that was that book, and it did pretty well for an analytical book. It got re-released in an updated version in, I think it was 2017. Anyway, that book did decent, did well for that for an analytical book. And another publisher approached me, it wanted to have lunch, so invited me for lunch and pitched me on this idea, wanted to do a whole series of books, one on each market, and I could write them directly or be editor-in-chief or whatever. And I was still a research director at the time, and it was also a time problem. But I said, look, I've done it. I don't want to do it again. If I'm going to do another book, I want it to be more of a mass audience book. And he said, do you have anything in mind? And I had this idea of market wizards for a number of years, but because I had a job which was more than an 8-hour-a-day job, I just never did it.
Right.
And that was the market wizard concept, because I did know some great traders, and I thought that would be a neat book. So I mentioned to him, and he said, that's great, why don't you do it? So that was the catalyst. I guess I needed a push to do it, because I knew it would be nights and weekends, and for that year where I was working on the original market wizards, plus my regular job, it was like, it was an intensive work year. And I couldn't do that again now, but at the time I just had tremendous focus, and I could literally sit down and in a night get a lot done. But not lack of sleep and all of that. But that's how it got done, and that was the catalyst. Was really, if I hadn't written the analytical book, the complete guide, I never would have ended up writing Market Wizards.
Well, either for that book or for obviously the sequels, the rest of the series, were there any traders that you really wanted to get a chance to interview that it just didn't work out for whatever reason, whether they passed away or just time crunch?
Yeah,
anything come to mind?
Sure. I mean, the most obvious example, the immediate answer I have for that is George Soros. I tried multiple times. I never spoke to George himself. I never got past his coterie of interceptors, right? So, so that is the one that, and because George is probably one of the greatest traders of all time, and a very long career and a fascinating life story. So I think it would have been a really good interview, but just was never able to get it.
And doing the books now, first Unknown Market Wizards and the one you're doing now, is there anything that really is different right now by these current traders versus the ones in the past, or really it's just adaptations and the markets might get a little bit faster, but at the core they're kind of doing the same thing?
Yeah, interesting. In most books there really isn't. I couldn't say that there is a real difference in terms of everybody has individualistic styles, and also like Unknown Market Wizards, I interviewed Peter Brandt, and Peter Brandt is, I interview him is in the mid-high 70s, right? So it's not like he's a young trader. He's not like it just happens I got around to interviewing for that book.
Right.
So it's not like the later books necessarily have younger traders. However, the current book I'm working on, and which working title, which will probably be the title, is Market Wizards Next Generation. In this particular case, a lot of the traders are younger, and almost all, I think, are 40 or younger. So which, if you're looking for people with sizable, decent length track records, you can't get much younger
than that. Yeah.
Almost everybody in their 30s, right? That you can't push it any further than that. So this is a very, very young group relative to any group I've ever interviewed, which has been always mixed. So that's a big difference. And one thing I noticed in this book, which never particularly, which is not, didn't occur really in other books. I mean, it may be people who did it, but in this case, a number of the traders started the same way, and they started by shorting small cap stocks that had these rallies, which were let's call them fundamentally unjustified.
Yeah.
And that was and eventually almost all of them gravitated to broadening out and doing other things. But I was surprised to see quite a number of these traders did begin with that variation of that same strategy, looking to short these small cap stock that has some news, which is let's say news which is it's not really news, but it's made to sound like something, and you get a sharp 3-4 day rally, or sometimes only a 1 day big rally. And there are also these stocks that have these very large percentage moves, like they go a few 100%, or even as much as 1,000%, and in 1 to 4 days, and then they completely collapse. So that particular type pattern is one a number of these traders began their career with. And ultimately, like I say, they all expanded to do other things, and in some cases they kept on doing that as well as one of the strategies. In other cases, they completely abandoned it because they got too big to even bother with it. But so that's one distinct way where this book, the trading methodology in this book is different than in most of the other books, and in all the other books.
Yeah. And speaking of like building a track record, what would be kind of the performance that you'd see that it's like, wow, I have to talk to this person and see what's going on, or, even one just performance metric that, outside of everything else kind of signals to you, hey, this is a special trader and it might be worth considering this person for the next book?
Yeah, I've got two different ways of looking, or two different things I look for. Either one. Sometimes, rarely you get both. You probably can't get both, but one is a story where somebody takes a small amount of money, and like I mentioned, like the anonymous trader in this new book is a perfect example. 50,000 to 500 million, and actually, there's another trader in this book who's, of all things, most of his career was as an agricultural futures ag trader, which is not the type of market focus you expect to give you extraordinary returns. Again, another example of a guy starts with a small account and builds it to $500 million approximately. So there are a number of these traders that had these. So that type of story where you take a very small amount of money and build it into a tremendous amount, that I don't care how you do it, that's the story. And then the other one is people who have phenomenal return to risk. And I'm not talking now. Most people use the Sharpe ratio. I'm not a fan of the Sharpe ratio, but the one big advantage of the Sharpe, and we can talk about it if you want, but the one big advantage of Sharpe ratio is that everybody uses it. So if I talk in terms of Sharpe ratio, it has, people will have a way of relating to it.
Right.
So I'm not talking about people who have Sharpe ratios of better than one, which is very good. It would be if we wanted to, or even 2 or 3. I'm talking people, and Sharpe ratio. The problem here is that I guess I got to back up here. The big problem with the Sharpe ratio is it penalizes upside volatility, and so many of the traders I interview have this great asymmetry where the returns are just so much larger than the losses. So the alternative, there is a Sortino ratio, which at least some people are familiar with. The problem there is everybody calculates it wrong. The Sortino ratio only counts losing months, which is good, and when people calculate it, they use all the data points, which is wrong because you're literally throwing out almost half the data points because you're only using the losses. So if you make the proper adjustment, which I call the adjusted Sortino ratio, it's the statistic I look for. But so the way everybody calculates the Sortino ratio now, it's always higher, almost always higher than Sharpe. But in terms of Sortino ratios, I'm talking about people, traders who have Sortino ratios like 15 or 20, that type of thing. So incredible return to risk. So either those two. So if a trader makes 15 or 20% a year and has a really high Sortino, that's still extraordinarily good.
Yeah, I think maybe it was with Tom Basso. You mentioned his process is obviously Mr. Serenity, but his ability to manage risk as well set him apart, and just the consistency that's very cool. One thing that's interesting with a lot of the traders I talk to, who are mostly trend followers of growth stocks or momentum style, similar to Christian Kwalamagi, I would say, is their batting averages might be very low, 30%, but their average gain to average loss, that's where their edge is really. When you look at all the market wizards, or maybe you've got some cool observations, how important is batting average? How important, what's the most important metric to really focus on there?
Well, the least important stat is batting average, right?
Yep.
So it ain't baseball. And the reason for that is that some of the best traders, as you mentioned, have very low percentage of 30%, sometimes even 20%, but their winners tend to be much larger than their losses, and that's the key. So it's not just, it's a combination of two things. It's a combination of what percent of the time you're right, which is what everybody tends to focus on, but it's also very equally important how much do you win versus when you're right, versus how much you lose when you're wrong. And typically, really good traders tend to have very high ratios of their winning size to their losing size. Right. And that's what makes them great. It's not that they have a super high percentage of winning trades.
Yeah, it makes sense when risk management is mentioned over and over again, capping your losses. And that was another thing that was interesting with Chris Camillo, is he doesn't use stop losses, right? That's another thing that's a little bit different.
No, he doesn't use stop losses, right? Exactly.
Yeah.
It's amazing.
Yeah, unique. One thing I wanted to ask you actually is you might be able to tell by How to Make Money in Stocks, but William O'Neill, he's a big influence for a lot of the people in our audience. I was wondering if there are any interesting stories you remember from talking with him, or some key takeaways that you got from speaking with him when you're doing his interview.
Yeah. So O'Neill was in the very, very first book, in which I read my own books after I write them. So it's been, but the last time I read that interview was a long time ago. So the interview was very consistent with what he preaches.
Right.
So this combination of fundamentals and charts and studying historical winners to see what a pattern of a big winner looks like. He was as a personality, he was just a real enthusiast of American capitalism and the opportunities it provides. But those who are familiar with O'Neill, what he wrote was very consistent with what he talked about.
Yeah, great. And going back to all those metrics, Sortino, Sharpe, all of that, it is kind of one of the goals of Fundseeder to be able to kind of bring it all into one place, the data. And of course, you're the co-founder of Fundseeder, which helps traders get capital by uploading their performance. Is that right?
Yeah.
Is that fair?
So just a background. So I was co-founder of Fundseeder. The idea and the real founder was Emmanuel Bellari, he was with ADM at the time, and I consulted on a fund that they had formed, which is how we knew each other. And we were at some conference and having dinner, and he pitched this idea to me. And the idea was that, hey, there's a lot of traders worldwide. who have trading talent, but don't have the pedigree, don't have the contacts. They could be in countries which nobody will ever pay attention to. And wouldn't it be a good idea to have a website where these people could load their track records and be verified, and then use that data to as a product for an investment vehicle like a fund, right? So I said, hey, I thought it was a good idea, and anyway, so that's how it started, and all along the way, I should say really my role is pretty much, I'm not involved in the day-to-day anymore. Fundseeder got acquired by RQSI a little less than a year ago, so really RQSI is now, and RQSI, for people who don't know, most people probably won't, it was founded and is run by Neil Ramsey, and Neil has been investing in traders for his whole life, and some of the famous traders that he was either the first investor seeding it or very early on. Toby Crable, who is probably one of the best futures fund managers out there. In terms of return to risk, by the way, I don't know anybody who's better. Fort is another big CTA that he founded or was an early investor, and others. So anyway, RQSI is now has taken over Fundseeder. So at this point, Fundseeder, the idea, like I said, was to have an investment product, and through RQSI, a few months ago, a fund was launched, and so the idea is to take traders who have signed up through Fundseeder and seem to have particularly exemplary return risk track records, and utilize them for this fund product. And the traders can be from any country, could be from anywhere. Right now, it's linkable if you're with Interactive Brokers. You can directly link, and everything's updated automatically. You don't have to do anything. If that's not the case, there's an Excel facility where you can upload your own data, and then it's not verified, but you can upload your data, and that's going to be operative. And I spoke to them this morning. That'll be operative sometime in July, and then there'll be additional brokers added. The next one is going to be TradeStation, and after that Schwab, which is obviously a big one, and then after that I think NinjaTrader, and it'll go on from there. So the idea is it's an avenue which makes it possible for traders in any country, of any background, if they've actually performed, to upload their data or link it to the broker and have an opportunity to be chosen to be able to manage money. So people who would have no access to manage money ever would have an opportunity through the vehicle.
Yeah, great. We'll link that link down below in the description for everybody. Jack, really enjoyed talking with you. It's great to pick your brain on all this stuff. You can see from behind me, you're a big influence on me. And if you haven't read Market Wizards, everybody go ahead. That's my homework assignment to you. Pick it up. Just one last question. Were there any, not necessarily personality traits, but habits or disciplines that might seem overlooked by a lot of people, but actually a lot of the Market Wizards seem to share? So specifically habits that might seem trivial, but actually can make a big difference.
I guess I'm trying to think. Maybe the one I would say that is underappreciated is flexibility, meaning that too many traders get into a position and just are rigid, and they can't change their mind. And any news that comes out, or any, I shouldn't say news, but any developments that happen, whether fundamental or technical, that are contradictory, that we should give second thought, end up being rationalized. Well, that's not, right. Yeah, this is bad for the trade, but it's already in the market, or whatever the rationalization. But the key thing is flexibility, the ability to change your mind. And and the best illustration that I can give of this is Stanley Druckenmiller, and this is a story that goes back to October 16th, 1987. For those of you as old as I am, or not quite that old, but may relate, know where this is going. But this is the Friday before the great crash in October 1987, and on that Monday, the market was down. I think futures, the tape could never catch up. But I think futures, which were able to trade, I think was down like 29%, if I'm not mistaken, in one day, and oddly enough, without any real news. But so the biggest one-day crash by far, not only in the U.S. but maybe in most markets. So Stanley at the time was with Dreyfus, and he had been short. He was short for most during that period, and on that Friday, and most people who know about this thing, I think picture it as there was this big crash that came all of a sudden. Actually, the market had been going down for months, and not only that, but the week before that big crash, it was a really very weak week. The market went down a lot that week. So Stanley looked at the market on Friday and said, gee, it's down to support levels, it's going down all this much. So what he did is he was heavily short, he covered his entire short position, and then he went long. And not only did he go long, he went leveraged long.
Wow.
So I used to ask when I gave talks, I would ask the audience, anybody ever make a worse mistake? And I stopped asking it because I realized that I couldn't even make up there is no worse mistake. I can't think of a worse mistake. So that sounds incredibly, horrible. And if you looked at his track record, October 87, I believe he was not far from break even. And so how the hell is that possible? How could you make the biggest mistake ever and not be down much, be down an enormous amount? And the answer is that over the weekend, he realized he was wrong. He had this, he was determined Monday morning to come in and get out of his position. So he didn't look at it and hope that it would come back. So Monday morning, unfortunately for him, the market doesn't just open lower, it like gaps down 12% right off the open. So he's just switched from short to long, and right off the bat, in the very first second of trading, he's down, and the market keeps on plunging right after that. But what does he do? He basically had orders in to cover his entire position right away, right at the opening. And here's the kicker. Not only that, but he reversed back to short.
Wow.
Right on the opening. So that's the epitome of flexibility. It's not only being able to get out quickly when you're wrong and know you're wrong, but to be able to actually switch over to the other side. But that is the classic example of flexibility, and that's a trait that people often don't appreciate. And personality-wise, I think people who are very adamant one way or the other and aren't willing to listen to other opinions are probably not going to be good traders, because being a good trader requires being able to admit you're wrong.
That's interesting, because I think a common trait that's prized for investors is conviction and belief in your idea and seeing it through. But traders, it's kind of a different situation.
Yeah. You need conviction when justified.
Exactly.
Yeah. But when the facts change, you need to be able to change quickly.
Excellent. Well, Jack, I think that's a great story to leave us with here today. Thank you so much for your time. Again, appreciate it. To everybody watching, I hope you enjoyed immensely. Check out the links below in the description. If you enjoyed, go ahead and leave a like down below. Subscribe if you're new to the channel. And Jack, thanks again for your time. And we'll see you.
Thanks, Richard. Appreciate it.
Yeah, thank you. And we'll see you at the next presenter. Cheers.
Okay.
All right, welcome back, everybody. It's my pleasure to introduce the next speaker of the TraderLion Conference, Linda Bradford Raschke. Linda is an incredibly experienced short-term trader who is featured in Jack Schwager's Market Wizard series. She's also the author of Street Smarts and more recently Trading Sardines, and is the founder of LBR Capital Management. Linda, welcome. So great to have you back. Thank you so much for taking the time.
Thank you, Richard, for having me on again in the TraderLion group. And welcome to all of you, and thank you for showing up for a joyous presentation on your favorite subject, process and trade management. Now, seriously, it's we'll just get into this, but my job here is to help you stack the odds in your favor of being one of those very select few percent to be profitable on a consistent basis. And all of us have different things that make that a challenge. So just moving right on, I thought I would approach this first. If you're newer to the game, you'll no doubt feel like it's become a passion, and I could easily spend 24/7 just studying charts. They're so engaging. They're ever changing, and they draw us into it. And I just think that's really important to have so much excitement for something that you're about to devote a ridiculous amount of energy and emotions and resources to, even if you're not doing it full time. So we start off passionate about a subject because we have a love, for it, and it's exciting. We've got market movements, and plus there's that bonus that we're constantly learning in the beginning. And not to say that we don't learn for the next couple decades, but it's really new and exciting. So we start off with a subject as a passion, and we haven't quite reached that point where we realize all the challenges and the grunt work involved until we're a little bit further along, at which point, when we start to become frustrated, perhaps we're not making as much money as we thought we should, or we've made money and given a little bit back, then I think the mindset needs to shift a little bit to the fact that we can approach this as a hobby. And once you approach the fact that the markets can be the greatest hobby in the world, then it helps take the pressure off, that performance pressure, and get us back to that initial passion where we're just purely enjoying the study and the process. So now with the hobby, we can approach it on a little bit more casual basis, lower pressure. If we look at it as a hobby, it's more suitable to if you're doing it part-time. You can't really make a ton of money doing this part-time because it does require so much preparation and process, but it doesn't mean that it can't be the greatest hobby in the world. So it does have that constant intellectual stimulation. The world is changing, the markets are changing, and perhaps we know at this point that this is not going to be our full-time job. We're doing it on the side. We know the pitfalls and challenges, but we like playing the game. And then there's that third category, which perhaps when you first start out you might aspire to, and that would be trading as a job, meaning trading for a living. And, this is a whole different ball of wax. You must really treat it as a business. And I consider doing this for a living to be at that point where you can put your kids through college, you can buy a house, you can put money away from retirement. And for me, the successful traders who are doing this for a living are doing exactly that. They're doing it for a living without producing newsletters and services and courses and this whole education spiral, which actually can be a huge profit center in and of itself. But in my opinion, it's extremely difficult to do both well. Okay, so trading is a job. It demands discipline and focus. It's how we pay our bills. And there's a much different type of pressure to be profitable, so that just keep that in mind. It's not always fun to have that same kind of pressure where all of a sudden your ability to pay your bills depends on your trading income. But going back to the hobby part of it, because I'm a huge fan of technical analysis and I'm a huge fan of market culture. And to me, these are some of the things that make it so rich as a hobby. So the very first book written on not just technical analysis, but more the markets, was written by somebody called Joseph de la Vega, and in 1688, Confusion of Confusions. That's a daunting title right there. And I like his little quip, a little translation of a quote that he said: "There will be readers capable of understanding all of what I say, but perhaps there will not be many, but there will be some." Okay, so moving on, I just want to present that he was one of the first to put these 4 enduring principles for traders to be successful in this field. Never give trading advice. So for myself, I might preach things that have been helpful like process, but I'm never going to say, this is my position, or I think you should buy here or sell there, or I think that, X, Y, Z. I'm not going to tell somebody else how to trade, because it's really a journey that all of you take on your own. And that's really important to remember, because, perhaps you see things on the internet or courses and so forth, and there's value in that for sure. But with that said, different styles resonate with different people. So part of our journey when we're first starting out is, let me investigate market profile. Let me investigate this style of trading. Let me see if I can write some algorithms, etc., etc. You see? And so for me, it's important that all of you are doing your own journey without me criticizing or interfering. And that's the only way that it's going to be meaningful to you in the long run. The next point he said is that we must accept profits and regrets. That just simply means don't look backwards at your mistakes and have regrets that you shoulda, woulda, coulda. I mean, that's life. And so I think that was also a nice note that he said. Accepting profit sounds pretty basic, but it means lock them in. Okay, so lock them in and don't regret the losses that you had or the journey along the way. Market profits can vanish like steam. So this was the quote out there on the internet, but in the original book, the quote was, "Profits are like eels, how easily they slip away." And perhaps you've seen that on your own bottom line. It's easy to build it up, and it's equally easy to give some of that back. So we want to work on tools that are going to keep us from doing that. And lastly, we need both capital and patience. I think the most challenging thing in the world is for somebody to try to trade and make money when they only have a $5,000 account. Of course you can make money, but you're not going to make enough to live on. And so in the big picture, in the big scheme of things, I think that your long-term success is going to be correlated with your level of capital that you have to trade. Doesn't mean that we can't, learn along the way, and perhaps we'll reach a level of competence where if we wanted to do this full time, we could solicit funds from a friend, a relative, reaching out through new emerging, market sources and new emerging CTAs. There's lots of ways to reach and raise capital when we get to that point. But most importantly, De Vega provided one of the earliest behavioral takes on trading psychology. And he commented on the herding, the overconfidence, the regret aversion, and excessive trading. All core themes in modern behavioral finance. So I know that you guys know this stuff already. Sometimes I find when I do a presentation, I'm always lecturing to myself as well. So even though I've been trading full-time for 45 years now, and actually not full-time for the last 5 years, I'm partially retired. But, I'm constantly brainwashing my own self as well, because that's really what the game is about. And so just not a lecture on my own bad habits, God forbid, okay? But let's just get this out of the way, and then we can really move on, you know. Herding means following the crowds, chasing the momentum, and we stop doing our own independent analysis. It's probably the most important thing. And Wyckoff, if you study Wyckoff, my hero for technical analysis, has talked about the importance of you coming up with your own style and your own game plan independent of anybody else. So that means don't read other people's commentary, don't read other people's newsletters. He talked about locking yourself in a room with no windows and a closed door, meaning you're isolated from outside influences. And that to me is probably the number one thing to advance your progress, when you can free yourself of looking at all the other stimulus out there, from Twitter to, you know, emails to services, because there's an endless amount of them. He criticized excessive trading, and think about it, how easy is it just in and out with one mouse click? And so that's become a problem. Just look at yourself and ask yourself if you overtrade. When I started off, I was on the trading floor in the pits, in the stock options, and of course that was our job, to flip the paper, if you will. And then when I went upstairs, in order for me to make a trade down to the futures markets, I would have to pick up the phone and call down to the pit. So it took a little bit of thought and planning, and it wasn't like it is nowadays, where we can just get carried away with mouse clicks, which is very addicting. So just think about that in your own style of trading, not over trading. And I thought this was fun. He observed how traders would invent clever reasons to justify market movements, okay? So now we have overconfidence and a narrative bias. I'm not going to go into all the cognitive biases that are out there, but they are important to be aware of. And look and see what your particular Achilles tendon is, all right? Also, the disposition effect, which has been well researched nowadays, and that's simply the tendency for all of us to hold losers too long and sell winners too soon. And why do you think that is? I'm going to leave that for you to research on your own. In fact, these days you can easily put something into Grok or ChatGTP and see it spit out some answers for you. And the real problem with that is that you read it, but you don't really think about it in terms of yourself. So we're going to look at some tools that you can use to make it hit home a little bit deeper at the end of this. All right. There are, by the way, lots of software tools nowadays that will analyze your trades, and you can just input automatically your blotter or spreadsheet at the end of the day, and it'll tell you your average winner and the average holding time for the winners, and your average loser and the holding time for the losers. So it's super cool if you really want to delve down into the analytics of what's going on under your hood. And lastly, the rumors, the greed, the fear, all of these lead us to make irrational decisions. And I see it all the time, you know, left and right, because we're more susceptible to that when we haven't been taking care of ourselves. For example, we're tired and didn't get enough sleep, or we just had a fight with somebody, or we walk in and we're not prepared, and that makes us susceptible to all these emotional factors that lead to irrational decision making. So let's get down to the first step on improving the odds here, okay? And that comes down to some basic accountability and responsibility. Acknowledge the fact that your drawdowns and overall lack of performance is going to come more often than not from behavioral issues. Okay, it's not because you screwed up on the execution of the trade. It's not because you forgot to put in a stop and so forth. In the big scheme of things, it's the patterns in your own behavior that are going to most influence the bottom line. Okay, so don't excuse your mistakes, because it's an opportunity to study these peak performance guidelines. And I'm sure that most of you who have excelled in sports at school, when you were young, or perhaps musical instrument or some type of other performance-oriented discipline, have heard these things before. Lastly, you guys, it's darn near impossible to be profitable when you have distractions, and that includes a full-time job. So what are we going to do about that? How can we still make this game fun? We're going to look at that too. But let's start off with the first goal of gaining experience, okay? Our market education. And we want to gain in the market study with the limited amount of hours that we have, assuming that you do have a full-time job or other outside things going on, all right? Take the pressure off yourself to make money. That's the number one thing I want to emphasize, with this presentation, is that in the long run, when you remove the pressure and you think of it as a hobby, when you remove the pressure to make the money, when you stop getting so hung up on the bottom line, and then it might start to come a little bit easier, and we'll have more fun, all right? Professional traders, again, who are doing this for a living, and I'm one of them, it's a lot. It's a lot to put on your plate to think that you are going to do this full time and make enough money to build up a retirement fund, to pay for health care, to perhaps, pay for a family. And it really adds a different shift of pressures that is not going to make the game fun for you until you've had many years under your belt. All right, sorry to mention all those things because it is a fun game. Okay, now let's get down to some brass tacks, how trading really works. And what we see is that traders and people newer to the markets love to study indicators, and they love to look for the entries. Why not? It's like you're going big game hunting, and that's part of the thrill, is that stalking to catch that trade. And a very small amount is devoted to the risk management side as well as the trade management. Okay, so trade management is actually very different from risk management. Trade management, of course, involves the initial stop. How are you going to manage that trade, trail the stop? Are you going to play for targets, and so forth? The actual risk management might pertain to the size of that initial trade and, well, the portfolio aspect of it, okay? Because we really need to manage the overall risk in the portfolio, assuming you're trading more than just one market, all right? So there's lots of different things going on there. And we really neglect to think about how much we have to invest in this continuous improvement. So I can just give you some examples with myself, because I'm always studying and doing research and trying to figure out ways that perhaps I can come up with an automated trail stop system that works for me, where I can put trades on and leave for the day and know that it'll capture the things that I want it to capture. So I worked a couple years on that. When I first started trading, I would say 10 years into the game, I went up to New York and was introduced by another trader in one of the FCM's offices to Market Profile. And I thought, I couldn't make heads or tails out of it. And I never used it for the first 25, 30 years. And in fact, I still don't use it. But my husband, Damon, is a very astute Market Profile person and big on that auction theory concepts. And so over time, I've really learned a lot, from him, and just from looking at the profile charts and giving it a little bit more credence than I would have in the past. And then I've found ways to translate those concepts into just the straight bar charts, because that's what works for me. So I'm always trying to reframe things and learn myself. So we already talked about starting off with the markets as a hobby, just to take the pressure off and keep it fun. All right. And now we want to start looking a little bit more about science behind it. And this is really important nowadays because there's so much attention given to the fact that with social media, with digital content, with the way the internet works nowadays, we've got this dopamine squirt. Every time we click on a mouse, you get a dopamine squirt in the head. So we also know that identifying patterns, and this is what makes the game so fun, identifying patterns also will release dopamine. That's why we like studying charts so much. You see a recognizable pattern and it releases dopamine. So this is part of this reward pattern process in our heads. You know, the little dopamine neurons are firing. Yes, that's right. You got that chart formation right. And before you know it, we're on the road towards addiction. Does that sound familiar to you? I mean, I'll tell you flat out, it's definitely the way I operate. Addiction, yes. But we don't want this to become an expensive hobby now. So here's the hard facts about this, gang. It's like there's been so many different studies done. I saw the first one done about 25 years ago through Revco, which was an FCM, and they looked at their accounts at the end of the year. And by the way, they did have professional traders trading too. They concluded that less than 8% total were profitable at the end of the year, and this is including the professional class of traders. Now, there's been more dire studies that have been done in the last 5 years, including one that said that 97% of day traders lose money. Well, we just came off some exceptional periods where we had helicopter money after COVID and you know, another period fueled by AI, and so we really had some artificial aberrations there. I mean, surely most of you remember the days of GameStop and diamond hands, right? And you could do no wrong. And there were plenty of people around us that we saw big money, especially when crypto was first taking off. And then those people went through some little challenging times when everything nosedived again. So realistically, don't think that people are outperforming you left and right, because that's really far from the truth. And the truth is, at the end of the year with the day traders, maybe 3% will be profitable. I can't even tell you guys how many studies I have seen with this, including studies with a Brazilian group and all kinds of independent categories. So the real trick too is not just to be profitable 1 year, but can you be profitable 3 years in a row? And we're not worrying about making a living at this point. We're just worrying about being green. So let's go back to stacking the odds in our favor and take it from there. By the way, when I was on the trading floor, we would simply look at, were we green at the end of the day? And I traded stock options, which in those days were denominated in eighths. So we'd take all our trading cards at the end of the day, tally everything up and say, okay, I made 110 eighths flipping, you know, this, and I lost 80, you know, eighths, you know, flipping that. And the whole goal was just to be green at the end of the day. So really approaching it one day at a time is a pretty good way of keeping things in check mentally. In the long run, our goal through this process is to find something that we can do consistently. So that is going to take some investigation of different styles. Do we want to trade options? Do we want to trade stocks? Do we trade futures? Is there a time of day that works best for us? You know, what style of trade management do we like? We might try copying somebody else's style and then after a month or two say, nah, that's not really working for me. And that's part of the reason why it takes people 3 to 4 years before they even arrive at what their style is going to be or where they feel most confident and comfortable. Because it's like trying on hats, and you have to give it, 1 to 3 months. Do I like doing this? Give it a chance and see if it works. If not, you move on to perhaps we want to do spread trading where there's less stress. perhaps we want to trade options where we don't have to worry about that overnight exposure, you see. So give yourself a chance to trial and error different styles when you're first starting off, because when we settle on something, we need to start to do it consistently without the distraction of trying to do too many things at once. And part of that process, we're going to come up with our own rule set. We're going to come up with consistency in risk management, probably the most neglected area. And then in the long run, we need to keep score, keep our records for accountability. So important, because, you know, face it, in this business, we don't have somebody looking over our shoulder and saying, why did you do that? You know, why did you carry that loss as long as you did? You know, nobody's really analyzing what we're doing. And so we have to be responsible for that ourselves. So the record keeping is huge with regards to this. All right, so process is going to what leads you to that consistency. Process for our analysis. I was always told that you need to do it at the same time of day every day. In fact, that's what Wyckoff had recommended. So find a time of day. It could be right after the markets close. It could be in the evening. I know that Larry McMillan, who I'm a huge fan of, does his at 2 a.m. in the morning. He wakes up and then he can do his analysis undisturbed. So find a consistent time of day for your initial analysis, for your initial preparation of the next day's game plan. Come up with a consistent process for execution. Are you going to put on a trade and then write it down? Are you going to enter the stop as you make that trade or after that trade has been confirmed, you see? So all of these things are going to be instrumental to letting you get into that groove where it can just flow. So if you take somebody like, I won't use golf as an as an example, but you know, tennis, it's practicing so that you're always going to hold the grip the same way. You're going to go about your motions in the same style so that you don't have to think about it anymore. And so same thing when we do our execution. I know that I'm going to be taken care of by my own best habits that I put on the trade. I stuck in the trade management algorithm. I wrote it down. I know it's part of my game plan or my playbook, you know, by which I like to find setups, and then it goes from there. So this will go a long ways towards minimizing those unforced errors. That's really what makes the difference between a professional and an amateur. Okay, not that amateur doesn't have a negative connotation to it, but with any discipline, you know, tennis, golf, piano, you know, trading, we all make unforced errors. I make unforced errors. We're just human. But the thing is that I'm going to make less than the other guy. So that's where we want to do, is reduce down those unforced errors. All right, moving on. Enough about that. I want to use some real life examples here because I found that it's always fun if people hear stories of other individuals, right? Now, I'm not using anybody's names, and nobody would recognize who these people are unless they are these people themselves, which I'm not going to tell them about this. But I have had lots of friends over the years who have been successful in the markets, and I don't have so many that aren't successful in the markets because they tend to go by the wayside and then engage in other activities or jobs that are better suited for their own skill set. All right, so by telling you stories of people that are successful, we can start to see some common denominators. All right, so I want to just give a few situations for you. Because there's a common theme among the ones that are successful. Okay, I'm not going to repeat these horrible, depressing studies, you know, about how many people don't make it. But Moving on. Okay, I'm going to talk about a friend that I've had for 25 years. Actually, he's been trading a little bit longer than that. I've known him for 20 years. And he started off on a energy desk. So you have lots of firms that specialize in commodities. It could be the grains. It could be energy futures like nat gas and crude oil. A lot of people 30 years ago that started off trading before the internet and before the software that we have nowadays usually started with a brokerage firm like a Merrill Lynch type of firm as a broker, stockbroker, 40 years ago, or on an institutional desk, the Goldman Sachs cliche type of thing, or on a commercial type of firm that did the cash management. So he started off with a firm that traded the cash markets and the energies. A very bright person, very detail oriented. We have talked probably every month for the last 20 years, and it's not necessarily the IQ that's going to make or break a trader, but this fellow has a very high IQ. He's excellent at risk management, detail oriented, all the ingredients are there. So at this point, he had a very successful fund with a partner that he ran for just a couple years, enough to make a lot of money. And so he's financially secure and he doesn't have to trade. That's a huge plus. On the other hand, he now has a blended family with 5 young kids under the age of 12, a lot of distractions, huge minus, and he's still trying to do this other little business on the side of helping out with this one fund. So you've got pluses and minuses, and he has 2 trading accounts. That's why I thought this would be a good example to start off with. One makes money consistently, and the other one just does not. And he can't build it up, and he's very frustrated, and he'll tell me, it's like magic. This one account, if I pull $5,000 or $6,000 out of it, it just makes it back. So let's see what he's doing here. So his first account, that is the magic account, where he's not even really trying, it's doing just one strategy, and that's with stock options. And it's a holding period of 2 to 5 days. So we're not necessarily in front of the screens watching all the ticks or the intraday charts. Here's a setup. We go in, we buy our call spreads or our straddles or the outright calls. We hold them for a couple days. There is a risk, point where perhaps if the initial trade loses 50%, he'll close it out. And the frequency of occurrence for these setups is maybe 2 to 3 trades a week. And lo and behold, it's bread and butter for him. But on the other hand, this fellow's so smart that he loves to come up with zillions of strategies and ideas. And not only that, he likes to trade futures and stocks and stock options. And I'm like, Joe, you can't do all of those things. It's like walking into a 31 Flavors and wanting to taste all the types of ice creams. So this is his trading account, where you can get all fired up, and he'll do momentum stocks, just holding time of like 2 hours. He'll want to trade the futures. He's mixing and matching time frames. And mind you, he's quantified all of these things. So he's always like, well, this is a 4 times risk type of trade, meaning you can make 4 times the profits versus 1 unit of risk. And he's always saying that to me. And then over time, I was like, wow, despite having quantified all the risk reward of all these strategies, he's still at that point of 2 steps forward, 2 steps back, 4 years, and the account is flat. He'll make money and then give it back. So he did admit that he stopped doing his record keeping. When I first met him, he had a calendar on his wall, and every day that his account was green, he would put a gold star on that day. And I thought that was brilliant. Just a little visual representation of a job well done. And we don't care if we made $5. We don't care if we made $5,000 for the day. That wasn't not what was important. It was just that we were profitable at the end of the day. The other problem that comes along is that now, because we have a new person in our life and a blended family, and we want to spend time with that person in the evening, be able to tuck the kids in bed, be able to sneak in some exercise after working during the day, we're too tired to do our homework. Okay, well, that's going to lead directly to a flat bottom line. And so I think for now he's turned this second account into a hobby. Now, this is me being an outsider looking at it to see what's fulfilling his needs. Yes, he's frustrated because he knows he's a better trader than this. He knows he should be making a lot more money if he were doing this full time, as something that he had to. But it's a choice of values. So for right now, his value is the family and making good with that. So the longer time horizon of the first account frees him up from all the noise. Very important, because I see newer traders all the time getting caught up in the most minutia of noise. Another fellow was like, oh my goodness gracious, he was like overkill, sending me charts every day, 1 minute charts into the 30 minute, into the 120 minute. I'm like, you are not going to be a functioning human being 5 years from now, because you can't maintain that pace or that level of intensity. And so you need to find out what is going to free you from that noise in the markets, because the shorter the time frames that you look at, the more noise there is, and that's usually what gets people all chopped up. So for him, using these call options as a vehicle allowed him to be on a higher time frame, a daily time frame, and not worry about all the intraday noise. The second account, of course, offers the thrills and actions. This person is like an Elon Musk type of character. He is not so emotional. So becoming, emotional with greed and fear and impulsive stuff was not his problem at all. But I think that he became a little bit of a dopamine junkie, with the mouse there. So just too many styles, too many momentum-based strategies, provided a lot of stimulation, but no bottom line. Personally, I see a lot of newer traders like that all the time. It's the overstimulation. It's, realizing that sometimes just one trade a day is just fine. You don't need to be involved in everything that's wiggling and jiggling. So Joe's a friend. He's getting what he's wanted. He's involved with the markets. And, I think he knows internally that he's making a choice right now to give up the overall big profitability in exchange for, spending time with his new family. But that's just an example of somebody that's been in the markets for 25 years, brilliant person, has the experience, but has an account that is not making money. And so we'll start to see why it is so hard for even experienced traders to make money consistently, because we have other things going on in our life. Now, another friend, in fact, he's a friend of both of ours. I've known him for almost over 2 decades. I think he came to a workshop that I did 25 years ago. And he used to be an institutional trader on a bond desk. So again, that background of being able to come in with a lot of experience. Very competent, can read any chart, but he's choosing not to be in front of the screens full time at this point in his life. So he came initially to the workshop when he was making this transition from the corporate world. And from there, he took maybe 10% of the content that I put out, and he developed a system and made it his own. He did the back testing on TradeStation and created a robust model for himself. So now he does just one strategy. That's fine with him. And you can read what that is on the slide. He gave me all the code for this model. It's pretty simple. And I can testify that it's had one losing year in 20 years, and that was in 2022. So he uses that model to trade high liquid big cap shares. You know, obviously Nvidia would fall into that category. And that works for him. He bakes bread. He's always sending me pictures of the bread that he's baking. He babysits his twin granddaughters, and he vacations for a month or two in Italy. So here's another individual that's been in the market for many, many, many years, has tried different things, and then narrowed it down to just one strategy, even though this fellow is perfectly capable of trading 20 markets at once and, you know, probably doing a whole lot more than he is. But that is not going to work for him and his lifestyle, and it's just more stress than he wants to take. So we're going to start to see a common theme here where traders that are successful have been able to narrow down what they're doing to just one or two strategies. You see, just one or two accounts. You don't need to be doing everything out there. And that's what takes time and maturity. So be kind to yourself, all right? Moving on, Swiss Miss. So I became good friends with Swiss Miss, and I'll say that because she has blonde hair like I do, and she lives in Switzerland. And she too had been with a brokerage firm maybe 15, 20 years ago, like the UBS type of firm. And then she was a trader there, and then she went out on her own, and she trades just 3 futures markets. And she has built up her own playbook, just 2 or 3 strategies. So she's very selective. She has specific time of day that she likes to go in and do her trades. And I really only saw her get into trouble once, and that was doing this one strategy that was really working best in up markets. And we had a period there, obviously, you know, 3 years ago where we didn't have an up market. And that was a period that was a struggle for her. So even though we have our strategies, we still need to be asking ourselves, are they appropriate for the current environment? So we've got gals out there too. I want to talk just 1 or 2 more. Part-time Aaron. So I've known Aaron for 27 years. Again, successful individual, great analytical skills, very conscientious, which is an important trait if you're a trader, to be conscientious. He's detail-oriented. He places his stops. And he has finally found something that works for him after realizing that when he quit his job and was doing big-time swing trading, it was just too much stress. He didn't like that stress, and that's okay. So he narrowed it down to 2 or 3 patterns that he'll do. It might just be 5 or 7 trades a week. His average holding time is 7 minutes per trade. He locks it in by scaling out. He has a hard and fast stop, and that works for him. See, so he's found, again, one style, one strategy, and just 2 or 3 futures markets that he does that with. So there we go. And then I'll mention one more trader. There are a few losing traders out there that I do know, and I'm going to just nickname him Q, okay? He's a trader wannabe who's been trying to make a living or even be profitable for 10 years now, okay? Can't fault him for not trying because he certainly applies himself. He started off doing Schoenfeld's program, which was, I don't know, at least 15 years ago when they offered such a program up in New York, and just didn't really go anywhere with that. And he spends the time in front of the screen. He spends the time studying. He doesn't have to worry about financial pressures because his family is well off and basically support him. But, you know, after 10 years, he's still not profitable. And he's got the knowledge, but his whole thing is coming down to emotional issues in that he'll make money 4 days and give it back on the 5th day, usually from having an argument with his mom. So I'm told, okay? So you can see we have all the tools that we need to be profitable, everything going in our favor, no distractions, well capitalized, and yet still not be able to be consistently profitable. And it more often than not comes down to behavioral problems, psychological problems, or emotional problems, particularly if we go on tilt. All right, so that was his thing, going on tilt, just too often. And he was a very calm, composed person. So moving on, we want to figure out ways to get into that top 4% again, or top 2%. Let's be optimistic. Let's say that 6% of all retail traders are profitable, okay? So first thing we can do is lower that trade frequency, because when we start to overtrade, we're taking more and more marginal trades. There are just not that many high probability trade setups. And you'll start to become more and more chopped up. Or else we will stop being able to recognize the best trades. So lower frequency of occurrence, and that takes patience and discipline. Specialize in just one market and get good at that. If you're day trading, think about making just a few trades only and ending up green at the end of the day so you can give yourself that star. Brett Steenberger was always very adamant that you keep your records for when your best trades were and when you did your worst trading. For most people, the last 2 hours of the day tend to be the weakest, and the morning session tends to be the strongest. But I've seen it in reverse, where traders do best in the afternoon, where there's that well-defined trend, and tend to get chopped up or overtrade in the morning. So the point is, know your time of day and your style, all right? Keeping these statistics is going to quantify things for you, not just about particular market conditions or setups, but your own tendencies, okay? Where are your unforced errors coming from? And I can't tell you how many people I have seen go on tilt or overtrade or do dumb-ass things from not enough sleep. And I'll testify that there was a period in my life where I did not get enough sleep, and it did not help my bottom line. Okay, so let's just look at a few strategies just to give you an idea of things that would work. If you have a full-time job and you want to do some trading on the side, let's just get down and look at some fun different things, okay? It was funny because just today somebody sent me an email, and they were struggling. They'd been trading for 10 years, and so they started going in this asking questions things, you know, well, did I think this or that type of thing. And I had to write back and say, look, you're on the right path, you know, don't try and optimize it, you know, because we think that we should be able to see things where everything's a winning trade, and that's not true. We have to accept that there will be losers. That's what stops are for. Okay, so we all have trades that are losers, and it doesn't mean that you were wrong. And some people just can't get that through their head, that if they're making a trade and they framed it out and it doesn't work out, it doesn't mean that you were, quote, wrong, which they take offense about. It means that you were doing the best job at that time and the trade just didn't work out. So you have to find out kind ways of framing things out for yourself, okay? Don't just look at the winners when you're looking at a strategy. See all the times that it didn't work, because there's no such thing as a strategy that works 100% of the time. So my all-time favorite stock was IBM. This is a great story because when I was on the trading floor, I had a partner who ended up being a market maker in the IBM options in Chicago. He was the head market maker, and he actually knew the specialist in New York. And so since the mid-'80s, I probably was watched every single tick in IBM. Don't ask me why. I wasn't trading it, but it was sort of at that time like the leader for the market. And then it just went dead and was a dog for like 15 years, horrible. And all of a sudden it's really come to life again with this AI and some of the businesses that they've built out. And so I have one strategy that pretty much works on any market as long as it's got the relative strength and the leadership. And it's what I've posted on Twitter a lot. It's the 5 SMA strategy, where we have that persistency of trend. meaning multiple closes on one side of the 5 SMA. And so you can see the first circle that I have down there on this particular slide shows where we had that close below that 5-period simple moving average. So the model that we had built at that time was, what happens if we buy on that first close and we exit on the first close back above, which could take 2 or 3 days. It doesn't always happen within one day. What percent of those would be profitable? No stops used. So if it was a blowout V spike and you bought that pullback, it could be 20 days before you actually had that first close back above that 5 SMA. So this is a model, not a mechanical system. But it's a great model for entering things, and especially if you're using stock options, or you can manage the trade as you see fit from there. So this is IBM, and I just simply wanted to show this lovely, lovely example because this stock had too many years in the doghouse, and now it is a relative strength leader. Okay? That's for longer term trading. You could easily find something like that, do your scans at night, and put something on if first thing in the morning, buy some call options on the opening, or however you want to frame it out, and then go off to your job during the day, and you don't even have to look at the market until you come back home. There is a way that you can make that work, is what I'm saying. Okay, most of you would probably feel a little bit wanting for more, but there are creative ways to make this work. Okay, for a different style, let's look at some short-term trading. Let's say that you have a full-time job, but you still are able to look at the markets for an hour and a half in the morning. I know lots of people that trade early in the morning. So now we're going to do something called chunking the data and just break it off into specific time segments. And you can do that. You can allow yourself to trade for the first 2 hours of the day and then go off and do other things. Or perhaps it's for an hour in the evening if your strategy so fits into that style. Okay, obviously futures are going to be the candidate that fits this better than a stock or an option. But let's just look at some charts and say, I like to use 8 a.m. Eastern Time as the start of the U.S. session, because that was the time that the institutional traders would all come and sit down at their desk up in New York. The bonds would open up 10 minutes later and so forth. And even though the New York Stock Exchange wasn't open, it's a very sweet time of day. So I have a page that has all the markets, the future markets that I trade, just with this U.S. session starting at 8 a.m. And we have certain patterns, especially with stocks too, especially with even the New York Stock Exchange opening for the futures. Is it a gap and go? Today, when the market opened, it was a gap and go because we opened and started to rally consecutive bars off of that New York opening in the S&Ps, and it kept advancing higher. So that was a gap and go day. Here what we have is the S&Ps opened at 8 a.m. Well, this is, they didn't open then. This is just the data that I've got here. And I like to look for what's trending off of that 8 a.m. reading and see if we can cop a trade that might be a holding period of 20 or 30 minutes. That's all. You can trail a stop. It's unlikely to continue on straight up or straight down. But you see here, this is the red line indicates the previous day's low. So these are my main pivot points. The previous day's high and the previous day's low. And here with the S&Ps, we would have opened up in the middle of the previous day's range because it was above that low for the day. And we rallied up and then, of course, fell all the way back down to retest that low. That's an important concept, but we're not going to go into that now. We're just looking at, can we get some spread off of that 8 a.m. reading? And so we started looking at what happens if we buy the breakout of the first 20 minutes and we exit 10 minutes later, 15 minutes later, 20 minutes later, you see? So right here, if I go down and I circle those first 4 bars, what happens if we had a buy stop and a sell stop above and below that? And then we exited 3 or 4 bars later. Are we going to have a positive expectation? What happens if we hold that for 10 bars and trail a stop? So you see where I'm going with this. There's all kinds of things that we can do to model to get an edge. And I'm just going to let you have some fun with that. You've got these charts. You'll be able to go back and reference them. And it's not just the S&Ps, of course. Here's the euro currency. So this also is opening at 8 a.m. So naturally it traded through the night, but I'm just looking at this as if this is the US day session, because we have Asia session, Europe session, and US session, which I start at 8 a.m. And here you can see, actually, it would have been interesting if you had shorted the low of that first 20 minutes. I don't know if we didn't actually trade above that high there, but there was a spread here between here and here where we went down and we filled the gap to the previous day's high. So the green line is the previous day's high. So what we've done here by chunking the data like this is we've added some structure, and this is really important if you're doing short-term trading. How can we create structure? We can do it with time of day functions. We can do it looking at the gaps, and we can do it the previous day's high and low. And if you want to pursue this type of study further, read that market profile book written by Jim Dalton, Mind Over Markets, because it'll make you conscious of, are we trading on both sides of that opening price? Are we trading on both sides of that first hour price? And frankly, it doesn't really matter to me if it's that first hour of New York Stock Exchange session, or here we're just taking this first hour before then. But you've created structure with the high and the low of those time periods. Okay, let's just look too at this lovely world of high beta stocks and options, because this has become a lucrative field for many and conversely a crowded field. So if you're going to adopt to this style, just be aware there are every prop shop in the country doing this. So now it's going to become a little bit more dependent on your execution skills. But one of the most popular scans is to see, what's going to be up or down the most pre-market. And of course, we can filter this by the capitalization of the stocks that we're looking at, or the companies that we're looking at, rather. All sorts of different ways to filter that down even more. I have one study that I've always used, which is I want to see, and I use TradeStation for this, the stocks that have the biggest 5-minute opening bar of the last 20 sessions. And that'll catch some really nifty types of moves. So in this particular next slide, I've got KLAC. This just happened a couple days ago. This bar was the largest opening 5-minute bar of the last 10 days. We gapped up, and you can see it was a gap and go. So my rule set is, if it doesn't trade back down below that opening bar within the next 4 bars, you've got to gap and go. Find a way to get on, and I'm always out of these trades before Europe closed. Usually the morning session now, because it's such a crowded field, after the first hour, the juice is really taken out of that trade. Now this did have follow through the next day to the upside, but if you're using 1-day options, little hot potato things, these little daily options, you just want a short holding time of those. And I have some friends that do this, and they typically scale out, so locking in some profits right away. All right, last but not least, systematic trading, which is really important to study, because even though you're unlikely to come up with a mechanical system that you feel comfortable trading, this is where we really learn the most about principles of price behavior. Some examples of systematic trading might be a trend following system. It's got hard and fast rules, black and white, where we enter, how we manage those trades, how we add to those trades, or if we have to re-put them back on after a stop out. I've always had best success with the short-term volatility trading systems, and Toby Crabell popularized this with his concept of where is that range expansion bar, all right? So I don't like trading these on a mechanical basis because there's a lot of whipsaws and volatility, but it's probably the only system in my book that I would ever trade mechanically. It just has bigger drawdowns than you would think, and it will be profitable at the end of the year. So let's just take a look at what I'm talking about. I picked the soybean futures, and unfortunately this is CQG, so you cannot see the entries and exits on the chart. But let me just tell you what the rule set is, taking 90% of the previous bar, adding or subtracting that to the closing price, and that's your buy and sell stop. Now, Larry Williams popularized this style by adding and subtracting to the opening price, which became problematic in the last 20 years when we had this globalization and you got Asia, half the move unfolds in Asia and Europe. So if you tried to then apply the buy and sell stop to the US session opening price, the system does not work. But with the closing price, you can initiate, and our exit was to exit on a tick above the previous high or close. So this is a system that Bob Buran, RIP, popularized. So here was an entry on these soybeans, right? This very first circle to the left. And the system went long there because it was taking this spread to here. So how would you feel if you bought almost the high tick for the day? Probably not real swank about it. But that's why it's important if you do systems or modeling to do your own testing so that you really understand the numbers besides it, and don't get freaked out, if you, bought or sold at what might appear to be initial poor trade location. So it went long here, and then, of course, a stop is put in. We hold overnight, and the exit would be a tick above this bar that was that big bar up. Now, what happened in this case? I will tell you. The system got stopped out on that spike down with that tail before it got its profit objective. Okay, so these are things that happen in trading, be it discretionary trading or a mechanical system. It looked like a huge trade. You had this monstrous profit that you went home with, and the system was waiting to exit on the tick above that previous high, but we pulled the stop up just a little bit above the entry price, and it ended up getting stopped out. That's what happens. On the other hand, it then went short on this breakdown where you have that red slash, okay? You hold that trade into the close, and this is where you really learn the power of the trend days and that range expansion. You hold it into the close, and then it covered on the trade below the low of that bar. So these are just some examples. The trade after that, where there's a red, it actually went short there, practically on the low tick, and got stopped out when it came back up. Sad, sad, sad. But then again, it went short where you see this green slash here. I put green because it was a winning trade, and the red, I don't know, ignore the colors. They're not very consistent. And that was a big winner. And then conversely, over on the right, you can see that huge bar to the upside, which was a big winner. Before then, getting stopped out on the high tick, or rather initiating on the high tick at the top. So you see we've got a mixture here. It's a mechanical system. It has a win rate of about 65%, not bad. It will catch big outlier bars, and it'll be profitable at the end of the year. And a lot of us, like me included, will be pulling our hair out if we sit in front of the screen and watch these things, because it is so annoying when it has whipsaws. That is the nature of mechanical trading. So I have to show you the good, the bad, and the ugly, and that's my job. All right, moving on. Record keeping. How many of you actually write down your P&L at the end of the day? I'm not necessarily telling you have to write down every single trade and P&L for every single trade, although I do have friends that do. But how many of you track your bottom line? Okay. There is, of course, plenty of software that will do that for you. For me, the best record keeping is done by hand, but maybe that's because I'm old school. I had a colleague who was younger than I was, and all his record keeping was done on Excel. So at the end of the day, he would type everything into Excel, and that worked for him. I kind of am an old-fashioned pen and paper gal. It makes me more aware of these things. But the record keeping is the only thing that is going to keep you accountable to yourself. It's going to stare you in the face at the end of the day. We don't like to write down our losers. We don't like to write down a negative day. But I feel like it's important if you're first starting out, meaning the first 5 years of trading, because it's going to keep you mindful of, wait a minute, am I hitting a pothole here where the market environment is changing? Maybe I need to step back a bit and take a breather. Or maybe I'm starting to go into a drawdown. Am I getting burned out? Okay, that's a very common thing that causes people to lose money too. We feel like we have to go, and we're going to miss something if we stop trading, and then we get so burned out we can't see straight, and invariably you'll do damage to your bottom line. It's your subconscious saying, listen, chickie, you need to take a break. So I just thought this would be fun for you to see. I used to write down all my, I'd log numbers, and I'd do this every single day at the end of the day. And I did this for 20 markets as well as the market internals. So this was from 1990 that I started doing this, and I feel like it's probably the thing that made me a good trader today, was doing all this detail work by hand. I don't know if it was a meaningless exercise or not, but it kept me astutely in tune with when something was lining up. For example, that IBM chart that I just showed you. When I was looking for that, when I was looking for examples for you and I saw that chart, I was like, where was I? Gosh darn, something's wrong with my process. Well, right now I'm not trading stocks, but it made me very irritated because I hadn't seen that. It wasn't part of my process, doing the stocks right now, and I actually just had cataract surgery. They did lens replacement in my eyeball, so now I really have no excuse for seeing things clearly, but I kind of took a good 6 weeks off to not be doing that. But I would not have found the IBM for my own trading account unless I had a process such as doing the nightly homework or rituals. So this is one thing that I used to do many years ago, and I did it for a solid 20 years. And you guys are going to laugh, but I still have every notebook with all of these sheets. Okay, this is a little bit clearer. This was 1992, and I would write down the 10-day closing ticks. Some of these things don't work anymore. The trend, the 10 and 5-day trend, were great buy and sell signals. They don't work anymore like they used to. And so that's sort of how the markets work, when you find the key, they change the lock. But the most important thing was I would write out my order sheet every day. And you can see I did this by hand. Now I can automate the sheet so it prints out and I just fill in a few things, whether I want to buy or sell. But I thought it would be fun for you to see this because, hey, The Swiss franc and the D mark were what we traded instead of the euro currency back in those days. And so we didn't trade the NASDAQ futures and the Russell futures. We trade the S&P futures. And so I would write down my notes for the morning. On that lower left, you can see sort of the game plan that I had. All indicators were for strong up on this day. And I just made some notes to myself. If you really care, you can read them later. But I would write down my positions and my exits and what I wanted to do. And that was really integral part of my process. So I want to have time for questions here for you guys. And I just want to give you a quick summary because I know I have a tendency to babble just a little bit, especially since it's a Friday. Create a written plan. I do this every year. I write down what is my plan or my business plan for the year, even if I write down the same thing year after year. So you want your specific entries for rules, and it's okay to rewrite these things, but that process of writing it down in the first place gives a lot of pause for thought. Position sizing. You need to have a consistent way to position size. I based my positions off of quantifying the average true range, for example, in the futures markets, and then using a fixed dollar amount that I would risk. All right. Start each trading day with a good night's sleep, of course, to just review the charts, review your plan, what's on the economic calendar. This really doesn't take more than 5 minutes, but it's part of the process so that you don't get blindsided. I can tell you that it was more than a few times when I didn't do this that I got blindsided by a crop report or something totally dumb, okay? And I always have that previous day's high and low written down by which I'm going to monitor the price movement. Maintaining a trading journal does not mean that you have to write down all the entries and exits. So for me, I started keeping a journal, just making notes of things that I saw or even things that I read. And believe it or not, I still have boxes of these notebooks. I never go back and really read them, but I think that process of writing stuff down is really important. So I know I said here, the details of each trade. You can make it what you want it, but I think it's important just to have a journal that we write things down in. You can monitor the market's volatility and sentiment readings. I think that's important because it keeps us in check as well. We don't want to get overly bearish at the bottoms or overly bullish at the tops. Right now, I don't think we're quite at any extreme. On our own mental side, what are we going to do for our own mental well-being? Breathe, visualization. You guys are gonna laugh. Okay, seriously, don't laugh. My magic crystals. I've got quartz and I've got rose quartz. I've had these for 30 years sitting on my desk, so they're magic for me. I still study the markets. I still will buy a trading book if I hear or see of something interesting out there. And it could be one that was from 20 years ago, perhaps, that I just hadn't had a chance to look at. So for me, that's back to this is the greatest hobby in the world, guys. Last but not least, your success should be evaluated on how much you stick to your process. If you stick to your process, the results will take care of themselves. And that's pretty true with any discipline out there. You get the correct form for your golf swing. Trust that that ball over time is going to go where it should go more often than not. So it's concentrate on the process. This has become very much in vogue in the last 10 years with all this peak performance psychology. And my opinion, there's a lot of merit to it. So with that, I'm just going to give you one last quote. Josh Waiken, he wrote a book. You can look him up. he had been a chess master at a very young age, and then he went on to become a martial arts top world competitor, and he's done a lot of things that demonstrate that he has the ability to achieve peak performance in a number of different fields, all applying the same mindset. So this quote is, "The moment we believe that success is determined by an ingrained level of ability, as opposed to resilience and hard work, will be brittle in the face of adversity." So he's basically saying that you can have an IQ of 160, and that's not going to mean anything when it comes to trading the markets. It's more that perseverance and determination, like, aha, I'm going to find out how to do it the right way this time. And so with that cheery thought, I just got my second printing of the Trading Sardines book, which is being shipped to me, and I'm finally going to list it on Amazon. So hopefully in another month you will actually be able to order it off Amazon if you should wish to laugh at some funny stories. So thank you guys all. Take this stuff to heart. I know you're going to go through a wonderful conference here with lots of lectures and master classes, and I'm sure there's plenty of wonderful technical analysis tools to investigate, but none of it's going to mean anything if you can't apply or use it consistently. Thank you, Richard.
Yeah, first of all, congratulations on the second printing of that. That's fantastic.
Long overdue.
Yeah, long overdue. And thank you so much for running through this. I definitely have some questions. First, I think it's amazing how you included those case studies of, thank you for bringing back the ambiance that we were looking for there. I think it's great that you talked through all the different case studies of the different types of traders. I think probably everybody watching this can relate in some respect to one of those. And it reminded me of kind of I think it was Ed Secoda who said, we all get what we want out of the markets, especially the Joe example, where he's got one account that, is just, it's not boring, but, it's just steady. And then the other one is more about, action and getting that excitement back. And I wanted to ask you, if there's someone like Joe trading that second account and they've got many different strategies that they're employing, maybe many different markets as well, how should someone pick one to focus on? Is it the one that they're most excited about? Is it the one that they're performing the best in? Any thoughts regarding that?
Well, I'm one of those people that had like a lot of strategies, a lot of different profit centers. That was when I had my hedge fund, but I also had two sidekicks, and colleagues that helped me organize everything. So, I don't want to ever come across like I was superhuman and able to do all these things without the assistance of an amazing team, and they all helped execute and everything. So part of that, I think, is going to come down to like what's tickling your fancy right at that time. I used to, S&Ps were my number one contract. I felt like at one period in time, this is probably not true, but I thought I was like the world's greatest S&P trader, and I was good, but I now spend more time trading the energies and the precious metals, just because I've kind of had a groove with them for the last couple years, and I haven't been trading the S&Ps as much. So it's sort of roll with it. I don't know how you would choose what you want to do. I'd actually like to go back to just doing nothing but trading the S&Ps, but I seem to keep on getting lured into, trading some of these other markets, and I'm just not good at doing too many things at once. Like, I know if I end up with more than 5 or 6 positions on, I am dead meat. Even having trail stops and money management, it's not going to serve me. So everybody has their own balance for themselves. Might just depend on how much energy you have, and where have your profits been coming from. If you started off as a stock trader, I mean, my goodness gracious, we've just had the most amazing 5 years, with all the high beta stocks and the AI stocks, and I think that's going to continue for a bit. But perhaps at some point you'll just want to try something else to be fresh. You know, the futures, I love the futures because one mouse click you can buy or sell, you know, as much as you want without worrying about the hassles of the options execution or things like that. So it's just, you know, part of staying fresh. I would suggest that everybody try something that they haven't tried, you know, each year. If you've never traded a particular market, make a trade in it. So for example, when Bitcoin was first listed as a futures market that you could trade, I'm like, well, I have to do this, you know. And I made a trade in Bitcoin. I held it for 5 minutes. I made a few ticks. I closed it out and I said, okay, thank you very much. You know, now I've you know, pat the pony is what they say. You test it, you tried it out. And at that time, it just didn't have the liquidity. The spread was way too big between the bid and the offer. And I'm like, this is not a market I want to get engaged in at this time. Now, of course, they have the micro Bitcoin, which is a little bit more liquid and deep. And of course, you can trade the crypto on those types of platforms. But don't be afraid to try something different. If you've been doing Forex, which, you know, of course, became much more, you know, much easier to do the last 15 years, you know, the CME futures contracts are wonderful. You can buy on bid and you can sell on offer, and you can use many of the trade management algorithms that you would use on the futures or the bonds or any other market. I don't know all that you can do in the Forex markets these days because they have proved so much. They've really come a long ways in those trading platforms. But, you know, just try different things and then you can make up your decision for yourself, and that's growing as a trader. That's all about growing. See, so it's not necessarily picking one strategy to stick with initially. It's just try something and then you'll feel like, I can do that. I can, and it just builds up your confidence.
Yeah, excellent. And then another question I had regarding looking back on your trades and analyzing them. Any advice on how to really focus on analyzing your process versus just the result of the trade, or any other thoughts regarding analyzing your trades? For instance, you know, myself, if I don't have time to look at every trade I did, I like to focus on my 5 top performing ones and my 5 or maybe 10 worst ones to try to focus on the ones that maybe will tell me the most about how I was trading during that period.
For myself, I have this philosophy that I really don't want to spend too much analyzing the bad trades, because I know what I did wrong, you know, and I want to move on. But if I see that I'm making the same mistake 2 or 3 times, that's something that needs to be fixed. All right. So I can give you an example. I have a new platform that I'm using for trading just because it had some algorithms on it. And seriously, this is true story, guys. I mean, I make more execution errors than anybody. I came in 2 days ago, and I knew what my positions were when I went to bed because I put on, you know, positions in the evening. And I came in the morning, and it showed me short S&P futures. And they were like 6 handles against me, and I'm like, I didn't short the S&P futures. Where did that come from? What happened? You know. And then I went back and I looked at when those trades were executed, and it was like 1:30 in the morning, and I must have somehow put an offer out there that I didn't realize hadn't gotten canceled. I thought that with this new platform, usually what happens is at the end of the day, all the working orders are canceled out. You have to put in good till canceled if it's going to be valid for, say, 2 or 3 days. And I didn't figure that out. And then was it this morning or yesterday morning, I came in, and lo and behold, I was short Russell futures. I'm like, I didn't want to short the index futures. What's going on, you know? Same thing happened. There were resting orders that had been filled, you know, in the middle of the night. I'm like, ooh, this is not going to happen to me again. So I'm like, I have a flaw in my process here with this new platform. I have a flaw in my execution process, and if I don't address that flaw right now, it could cost me some really serious money. I didn't want that to happen. So I I went and saw how the orders were being managed and placed and so forth, and fixed that. And now I have added to my routine at the end of the day, check the working orders box, because I kind of keep my execution platform off to the side because I don't like to look at the ladders and all these orders and stuff. I was so used to having an assistant do that for years. So, that was a problem for me. And I'm like, I better fix that problem right away. So there's always, work like that going on.
Great. And are there any non-finance related books about processes or developing systems that you found helpful or that you would recommend to anybody that might help their trading, but it's not directly related to the finance in general?
Wow, I'll tell you, the best books in the business are on peak performance in sports, and the thing is, they're only $10 to $15 books, and there's tons of stuff online. So just Google peak performance in sports, and anything that you find can be translated to trading, and you don't have to pay $80 for a trading psychology book.
Great. Well, Linda, this has been fantastic. Any last bits of advice or anything you want to make sure people leave with as their key takeaway from today's presentation?
Gee, guys, just, these are amazing markets that we have, and find a way to make it fun. Don't stress over your performance. Don't stress if you don't feel like you're as profitable as you think you should be, because it comes with time. And I think that most people expect it to happen in 3 years, and a lot of times it could take 8 or 10 years. So that's why I say, think of it as a wonderful hobby. If it's meant to happen sooner than that, it will. And sometimes it can happen, if you team up with a colleague. Perhaps there's, one person that specializes in the coding or, some other type of area, and you guys can be buddies together. That's another way to be accountable and share the camaraderie. Don't get in these big chat rooms where everybody's yakking and engaging and posting their trades and stuff. I'll tell you, that's going to take you down to the bottom faster than you can sink with an anchor tied to your feet. All right, don't get caught up in that. But it is fine to find one good friend, and a lot of people have found a friend through those types of rooms. So I'm not putting them down per se, but just see, is it really going to help you right now? Or perhaps it's just there for a little bit of a month or two boost, to get you jazzed again. And, then in the big scheme of things, it'll happen when it's meant to happen. So just have a lot of patience. If this was so easy, we wouldn't have all the wonderful professionals and teachers and doctors and everything we have out there. We'd all just be traders trading against each other. So thank you, Richard.
No, thank you, Linda. Appreciate it. And this was fantastic. To everybody watching, I hope you guys enjoyed as well. Definitely leave a like down below if you did, and we'll be right back with the next presenter. See you soon. All right, welcome back, everybody. It's my honor to introduce the next speaker of the TraderLion conference, Pradeep Bonde, the founder of StockBee. He has mentored thousands of traders over the years and is known for developing the episodic pivot and momentum burst setups. Pradeep, thank you so much for being back here. I think the topic you're talking about today is fantastic, talking more about being process oriented, how to develop your processes, and sharing a lot of the processes that you have for your own setups, the EPs and momentum bursts. So first of all, thank you so much for your time, and it's great to have you back.
Yeah, good to have you back. So yes, I want to talk today about processes which is one of the issues which new traders face, and even existing traders or traders always have process kind of problems. Yep.
Yeah, perfect. I think it's really poignant, and you've talked about so much in previous videos and webinars, the different processes that you have set up. So why don't you take it away and kind of run through first, why is it so important to have a process? And then I know you're going to give a lot of examples too.
Okay. So let's go. Let me share the screen for this, and then we can look at basically the thing.
Yep. Let's dive in.
Okay, so let's look at a process orientation or process flow, because ultimately the goal or the whole philosophy with which I work in terms of trading, and when I even talk to developing traders, is if profit is an outcome of following a good process. So if you have a very good process and a setup, once you have a setup and you have a process, then if you follow a process, profit is just an outcome of following a process basically. And in order to have a process, you need to have first setups. So I define setups into two categories broadly. One category of setups are like home run kind of setups or mini home runs. So in a home run or a mini home run, what you're looking for is moving your account in a large increment in one trade. So say a good example of that would be an EP is a home run kind of a setup. I have a variation of EP 9 million, which is a home run kind of a setup. So one trade will move your account by 20%, sometimes 50%, or at times even 100% plus in one trade, right? And basically, the other kind of a thing which I do is really singles, which is basically something where I'm looking for moving the account. Sometimes that trade can move your account just 0.5% on overall capital. And when I'm talking about 20, 50, 100%, I'm talking about overall capital. I'm not talking on that particular trade, right? 0.5% to sometimes up to 5% in one trade, basically, right? And now, in order to do this successfully, there is a process flow which is required, and that process is what I would focus on today. For doing something like this, I have a process which starts, most important part of this process happens in pre-market or aftermarket. So as soon as the market closes is when companies start announcing earnings, or companies announce earnings after the market opens. So in order to find stocks which have earnings as a catalyst, or a sales as a catalyst, or some news as a catalyst, most of the stocks will also announce any game-changing news or any news after hours, after the market has closed, or before the market opens. So for this, I have a process which I follow religiously, pre-market and after-market, which goes through steps. So I am looking for every stock which has come out with earnings. So for this, what I have is a tab group which I have created. I have selected which website which I am going to use for doing this information gathering, how am I going to do it, in what sequence, and I have a group of tabs which I use for doing this. And this group of tabs basically I'm going to pull that in here. And if you see here, right, when I come in, I open all these tabs in one go, and all of these tabs are what I use in order to find the information which I am looking at. So the websites which I use is Briefings, The Fly, Wall Street Journal, the Morning Star, then MarketSmith, and then nowadays, because AI is becoming a very good tool, so I'm using Perplexity Finance AI tool to research some of these companies. the starting point is always earnings, right? So today, like after the market has closed, there are two companies which are announcing earnings, and you see that they see CVGW has already. So I look at these earnings. Whenever I'm looking for earnings, I'm looking for a surprise. So in this case, there is a negative surprise, and there are only two stocks. Or I'm looking for year-to-year revenue to be higher than 39%. Now, in order to show you this, today doesn't really show you anything because there's not many companies. If I go into the history and try and look at basically some of the archives, like let's say Wednesday is a good day to look at, right? And when you look at Wednesday, you see that so many companies had earnings, right? And basically, and then you can sort them by year, and you can see the one which I'm most interested are the one which are having a very high sales growth, 39% plus kind of a sales growth and surprise, right? So this is where I start. So THO, this had a surprise, right? And so that will be the starting point whenever I have this. Similarly, this is before the open and this is after the close. After the close also same thing, same process, surprise. The one which I have surprise are the one which are going to be what I will research, right? And in order to research them, I use this tool briefings, the same website. But here again, in terms of a process, I have created two tabs for this process. So I have this tab which is where earnings are showing, and this is a general all news here, and this is just specific. If you see the filters here, this has been filters and only it shows certain news. So it only looking at broker research, commentary and earnings, rumors and summaries, while this is looking at everything, right? So this allows me to quickly focus on earnings related news. So I go through this earning related news now. So you see basically news has started coming. KC's general beats by 68 cents and beats on revenue, provides outlook, increases dividend. So now this stock I will go and research further by looking at different sites. First thing I would look for is I would look for what is the news item on this. I would read through this news item. Based on that, I know obviously they had a good earnings and things like that. Then I look at the chart to see if it was rallying into earnings. If it was rallying into earnings, there is no trade, but this stock is not rallying into earnings, right? So there is a probability that tomorrow at least or for next 3 to 5 days the stock is likely to go up. So I'll go into more detail in terms of processing this information. I will look at basically anything which is showing this kind of an information. I will look at basically the I will look at what is the news item and see what was the news on this for a couple of days earlier, what was the news, so that I can research this particular thing, right? I also use
Pradeep, can I jump in with a question?
Mm-hmm.
What could you see in those previous 3 days that would just scream to you, all right, this is a stock to really be focused on?
Yeah, so what I'm looking for is this stock didn't rally into earnings, right? And there is a big surprise. I'm just taking, I have not had time to analyze this. This news came in just while we were recording this session, right? So, but here, this stock has not gone anywhere for almost and last time it had earnings, it had 16% reaction, right? And so there is a potential that it will have a reaction because the per se, if you look at just the larger numbers, look attractive because it's 68 cent beat and it is guiding also higher, also increasing dividend, right? And basically, but the important thing is I only look for a surprise if the stock is neglected, and this stock is neglected, right? And at least for a month it is neglected. So then the move become more explosive if it is neglected. Does that answer your question?
Yes, and also in terms of the fundamental catalysts in briefing or anything, is there anything that you look for that would stand out to say this might be a better trade? Yeah.
So now now this is just a news item I have seen, right? And but I will go into looking at what I call as a X-ray of the stock, which is to look at the fundamental picture on this stock. Now obviously this information will not be updated immediately because this information just came out 1 or 2 minutes ago, but I can see what is happening here. This is in a stock which is not really, it's projected to grow for the next 4 quarters, and for the kind of retail stock it is, it's a good projection. 9-10% for that kind of a retail stock is not bad, but this is not something which I get terribly excited about. I will get excited if I see something which is 39%, 40%, 50% growth rate. To give you say an example, like say if I see something like this, then I get excited, right? And then I will go more detailed kind of a thing. Now, in addition to this particular, like looking at the X-ray of the company cases, I also look at like basically on Morningstar. Morningstar is more focused on like valuation, right? And so I always like this is something new which I started using this year because I've seen that it helps. Like if the stock has a valuation, this thing. So here in this case, Casey General Store is trading at 439, right? And basically, and they are saying that by their valuation metrics, right? And it's like it's not something which is Casey's is trading at 3% premium, right? So it's not like it's very cheap. Like sometimes you find stocks and they're trading at like a very discount to, then look, there is a likelihood that value investors will get interested in this stock and things like that. So this is just an additional layer of information which I use nowadays, and I found some good trades by using this tool, which is their valuation tool basically, where they tell you what is the fair value for that particular stock. So fair value for this stock is 329, and if you see currently it's trading at around 419. So that means the surprise may move the stock, but it's not going to move the stock big kind of a thing, right? So I just use this as an additional tool, and then I use this particular tool. Whenever I'm looking at this particular tool, right, there are certain things which I am looking for. Obviously the sales growth being very important, but again sales growth is context specific and sector specific. What is a good sales growth in retail is very different for a sales growth in a technology stock or a consumer discretionary stock. So this is consumer discretionary, but it is basically even a 10% growth rate in retail is good for retail, right? And basically, but I look for also if there is a sudden, if you see in recent time there has been a surge in mutual fund ownership, then that will attract my attention, because that's what I look for. Like if I go back to the previous example which I just showed you, right here, you see that like there has been a sudden jump from 492 to 642. So there is something, funds are also attracted to this particular thing. So once I look at all this, then nowadays I started using this Perplexity Finance, which is very good for like creating prompts. I'll just give you a quick examples of how I'll use this, but I have different prompts which I have created to look for, like say what is so I would like use a couple of prompts saying, look, what are the analysts saying, what is the bullish case, and then it creates like basically summary, right? And also like I use this to say, look, can you summarize the earnings call for this particular thing. So it just allows you to, rather than reading 20 pages of SEC filing, you can just read a few paragraphs and you get the gist of it, like, or what is the analyst opinion on this particular stock kind of a thing, or which funds are, what is the fund ownership trend on this. So I have created these multitude of prompts like nowadays, and I use that. So once candidate goes through this vetting, and if I find something which is attractive basically, right, that's when it will go into my next day or same day stock to trade, right? And then when you do the analysis, sometimes you find a stock which is going to go up for next 2 or 3 quarters, and sometimes you find a stock which is just going to go up for 1 day or 2 days, and you trade that accordingly basically. So ultimately these stocks, once I analyze, will get either go into a bucket which will be like either a longer term potential or a bigger potential, or just 10 to 20% potential kind of a thing, right? So this is one thing which I do like basically for a process to find a trade, and this process runs before the market opens. By 8:30, I looked at everything. Most of the earnings come in by 8:30. Very few earnings come in after 8:30. So I will have like whatever I do in the evening, I will have a list, like say, if, let's just put in cases as an example there now, because it's gapping up a lot in the post market, I can see, right? So that is one stock which I have now, one idea, right? And basically, so that process is over. Next day morning, I might add 1 or 2 candidate to that particular process, right? So this is one process to find something which are the catalyst for that day. But what I have found is that whenever there is a catalyst, the stocks go up on that day, but many times, because they're having large gaps nowadays, they pull back and then they offer you an opportunity to enter after a couple of days or a few days, right? So what I do for that is I have a scan which is part of this process only, which I run in the night or in the morning, looking for a delayed reaction, delayed reaction EP kind of a thing. So what I do is I scan for stocks which had a big volume moves in the last 1 month. So what I look for is I think a catalyst is a good catalyst if it makes more than like a 4% move on a 9 million shares kind of a thing. So I look for those stocks which have made that kind of a move in the last 25 days, right? And then I create a watch list of those stocks. Going through this, each of these stocks I'll go through. So to give you an idea of, like, and I say today morning I went through this list and I created this watch list, which was my watch list coming into today, saying these are my delayed reaction watch list candidate for today, and one of them was CCJ, right? Because it had this catalyst here and it went sideways, it was setting up, and then it went up today. This is a stock which I am watching. Now in this particular case of this stock, there's a catalyst which there was earnings was 3 days ago, and it reacted very positively to the earnings. It did like a highest volume traded ever in its entire lifetime. So it did 63 million shares traded or something like that. If you see, 68 million shares were traded, the float is 249 million, and it has a good catalyst and earnings. It has a large order which it has received and things like that. So this is a stock which I was watching today for possible delayed entry. So this is how like this particular process runs, and I create this watch list of stocks which are setting up, which are the catalyst, and they go sideways or sets up. So in case, like say in the case of CRDO, there is a good earnings, it faded on that day after gapping up. Now it might have a delayed reaction, so I'm watching it for the same thing. Same way ELF. So this is a combination of these two processes which I run, and I create a watch list then for the day, or a trading list for the day basically, right?
And to show an example, like if you go back to T2000, could you bring up APLD? Is this too short of a pause for a delayed reaction EP? That third day I'm talking about. So there's one tight day.
Yeah, but like what happened really is like this is again like there is a 15 billion order, so there is a clear catalyst. And the volume is like a huge, right? And 239 million shares traded, more than its float traded actually. Now I was hoping that it will set up as a delayed reaction, but sometimes what happens is they don't really give you an opportunity. Where there is a genuine catalyst, you just have to enter, because sometimes they don't give you delayed reaction kind of a entry, right? Basically.
Yeah, and this would be an example of something you catch on day one, because I think the news came out at 8 a.m. About the partnership with CRWV, and that's what created this 60% move in a few days. Yeah,
and this is again as part of a process. Now, because I know what is the catalyst, I write it down here itself, so that I don't have to go back and look at the catalyst. Similarly, whichever stock I want to like in a target, like CRDO, the catalyst is earnings. So what I do is I put the projected earnings here and sales and earnings, so that like I don't have to remember. So these are all small process tweaks which I have done, where like you know what is the catalyst. Like say here I wrote down the catalyst, like hims and hers on that day. There's a tie-up with Envio, right? So, and this is where it became a delayed reaction kind of a setup. So I go and like as a process, try and avoid the trying to remember what is the catalyst and just put it there.
Yeah, right. And Do you, I mean, you must draw from your logistics background to some extent when you're explaining this and developing this. Any key takeaways or things you want to mention related to that in terms of how people should think about creating processes for trading?
See, whenever you are creating processes for trading, right, and processes have steps, right, and processes have tools, and processes have like a sequence basically, right. Now, when I worked in logistics, logistics is a very process oriented industry. Every single thing is driven by processes, right, and basically the thing which is important when you are looking at a process design is you need to master your tools, right. So that's why I only use certain websites. I'm not going to go and look for a random or like keep changing my websites and all. Within that, I know exactly what information I am looking for in briefing, right, and basically what information I am looking for. Like certain information is not available, like in certain information is available in briefing, certain information is better available in some website. So I know exactly what to look for, right. Also, like in a where to find what information is part of your process flow. So mastering your tool is one part. Second is when you have a process like this, right, and you have to think through. Now, when I do delayed reaction EP, and if I have 3 good candidates in delayed reaction EP, right, now if I focus on this particular thing in the first thing in the morning, I'm going to miss out on a lot of breakouts, right, which I am fine with, because I want to prioritize. If something has a real catalyst and I am really wanting to get into it, I want to prioritize that over running another process. So those are again process related issues which I look for in terms of how process is designed. So some days I make a conscious decision that I'm not going to look at running my breakout scans in the morning, because I have these 3 birds in hand, and those birds are worth more than the one which are likely to show up in the scans.
Yep. And how should traders who are completely new to trading or in their first few years, they don't have processes yet, how would you recommend them start building them and, choose what steps to include, what software to include, all of that? How have you developed and continued to evolve these processes to match changing market environments, new setups? The delayed reaction is something relatively new that you've developed. So how can people create a process and improve it, slowly over time to always get better?
See, I think another key to success in this business is once you find a setup idea, is to have a process which is foolproof, right? Now, when you start developing a process, the first iteration which you do is never going to be perfect, and you have to keep on iterating till it becomes very easy for you to run, and then you try different tools. So I tried out different tools. I looked at all the other things, right? And basically what I want when I train traders, and I'm just training one trader now, and I told her to only focus on writing a process and only following the process basically. The moment she takes a trade out of that process, I've seen that her performance goes down, right? So the process should be written, the process at least in the initial stages, because that is when we are trying to develop the process, right? So the process should be written process. The process should have simplicity in it. That's most critical, because if the process is too complicated, I tried creating some very complicated prompts on that AI thing, but it just doesn't work. Simple prompts you create and it works, right? And basically, so those are key to doing it, and when to do what, right? And a lot of time I see a problem with how traders approach, like newer trader. First thing in the morning, you should be ready with your watch list, and then you prioritize that particular watch list, right? Now that process is important. If you're in the morning, you're starting to look for where is the earnings and what is the thing, and you're trying to find say anticipation. I run a process called anticipation, but I don't touch anticipation as a process till 3 p.m. in the afternoon, right? So again, the process development part is the most important. And once you have a process and you start following a process over a period of time, over 2 weeks, 3 weeks, months, 6 months, 1 year, 2 years, you will realize which processes are redundant, and you can drop those redundant processes. You try out some new thing. Like every year I try out something new in the process or every 3 months, and I see like this market, this thing which I am trying out this year is not something which is like basically I was using, but I am trying this out as a tool, as a process hack to see if this helps, because if it doesn't help, after I evaluate it for a couple of months, I might drop it, right? And basically, so, and then simplify your process. That's the key, right? And you have to keep on simplifying your process.
Yeah, excellent. So that's an excellent run through of more catalyst type trades. What about for the momentum burst and anticipation setups? Would you mind running through your processes for that? That'd be great.
Yeah. So this is like this is the entire process which will run for this particular thing. For this particular thing, right? And there are two types of trades I will take. Basically, one kind of a trade will be a breakout, which is like basically something which breaks out and like goes up for that particular day, right? And basically which is based on a scan. And there is another process which is the anticipation. So which is like a watch list I am creating for finding setups which are likely to break out. So in a breakout kind of a process, I have a very simple process, and what I do is I have these two breakout scans which I use, right? In addition to this, I have the other software which I use, Trade Ideas. So let me run through like the whole process, including Trade Ideas, to give you an idea, right? And so this is a breakout scan which I run, and I start running this as soon as the market opens. So as soon as the market opens, I am just going through which stocks are having a breakout. And again, this is color coded. So you will see that this is green, that means it's bullish. This is red, that means it's bearish, right? And basically, so I toggle between these two scans first thing in the morning. In addition to this, I have this entire set of scans which I use in Trade Ideas, which are again breakout variations of breakout scans, which I use basically. And that thing is again, these are simultaneously running in addition to this particular scan basically, right? And because then you can find setups which are like, say today, like Tesla is an example of a trade which I took from this particular scan, because it opened lower and then it started showing up here when buyers came in, and then I immediately went in and bought Tesla for a trade, right? And basically, so I am using a combination of this process to find breakouts basically, right? Now breakouts are something which is like, you don't know, you don't have that stock on your watch list, and it suddenly breaks out, and then I enter that particular trade. So if I had to show you an example from today, right? And so here, like, and I say this fastly, right? This shows up in my scan today, and I entered this trade when it showed up, right? And this is a breakout. Now I wasn't watching fastly, I didn't have it in my watch list. I saw it as a breakout and I entered it, right? Now in addition to this breakout scan, which is where I am reacting, right? Because this is a reactive kind of a process where I am reacting to a scan candidate and buying it on the fly kind of a thing. I do an anticipation of breakouts for singles. For anticipation, this particular process runs primarily in the first half an hour, 30 minutes. I want to get into as many breakout as possible in the first 30 minutes. Even though I run it throughout the day, the real concentration for this process is 30 minutes. Now what I do is, once these breakouts and all has come in and all, in the afternoon there is nothing to do actually, right? Because you're already in trades, you're just managing your trades and all. So at around 3 o'clock, 3 p.m. is when I start looking for anticipation setups for the next day, right? So I have a setup, like I have a scans for anticipation, and in this case I will have a bullish anticipation scan, and I look for these particular stocks which have like if you look at the condition, it's just looking for a stock which has basically a momentum and which is up or down less than 0.4%, right? So it's a very tight scan which is looking for stock which has a narrow range day. And then I have even the columns which I use for doing this, there is a certain process. If I am doing anticipation, I have a column which I use which is the net change, and I always sort by the lowest net change and always look for the one which has the lowest net change first, because the lower the net change, the tighter is the candle, right? Or it's like, say this particular stock has a net change of 0, right? And so that's what I'm looking for. So every single column is again there is a process involved with it. Like, and if I am looking for buying breakouts, always all my breakout scans are already sorted by volume. These are the kind of process innovation which I have done in. So in the morning, you know, whatever is showing up at the top has good volume and liquidity, right? Whatever is showing at the bottom has less liquidity. Then again, like I have some fundamental scans. So if a candidate which is showing up is in one of the fundamental bucket, then I have this thing set up. So everything which is required for me to make a decision is there like a dashboard in this particular process.
Yep.
Right? And only thing which are required for me to make a decision on a breakout is there in this particular layout. Now other layouts have other things because I might use them for some other purpose, but here I don't need too much information. All that I need to know is this stock like in bucket 1, bucket 0, bucket 2, or is it part of the IBD 250, just to give it a more importance or things like that. So all these columns, how they are sorted, is again a process which is fixed every day. Same thing I do. Okay. So now if I go through the second process, what I do is this anticipation thing. I go through this process and I look for an anticipation setup here, right? And when I look for an anticipation setup, when I find an anticipation setup, and this is an example of a process innovation which I did. So what I used to do is I used to create an anticipation watch list, and I used to look for buying them next day morning, right? But nowadays I don't really buy them next day morning. If I see a good anticipation setup which I think is likely to break out, I buy them just before the market close, between 3:58 to just 4 o'clock. I will buy an anticipation candidate without like looking for a breakout or a confirmation. Now there are two reasons for this process orientation, process hack which I have done. One, because if I spend the time in the morning with a watch list, anticipation watch list, trying to get into them, I might miss out on this. I might miss out on a good breakout, right? So the processes interfere with each other. A breakout process interferes with a watch list process. So I said like anyway, I am so sure that if this breaks out, I am going to buy, and I know that people do most of their anticipation work in the night and they try and enter it in the morning. So I just do it at 3:58 and take that small risk, but it frees me up my time in the morning to focus on this and this, right? So this is the process which I use for doing this particular anticipation kind of a thing. The watch list, if I have a good candidate, I would already be in it, that trade basically. So the combination of these two processes run simultaneously, and when a trade shows up, if it is from an anticipation and it breaks out, I would be already in it basically, right?
And can you show an example of a recent anticipation trade, just for people who aren't familiar with the setup, what it looks like, to basically see a good case study?
Recently anticipation haven't been working well, but like can I say something like this is a good example of today's, like this is also like it was a anticipation setup also, right? In a CCJ.
Yep.
See here, like it was up or down like 39 cents, right? And it was here also I had it in my anticipation setup because it was like on this particular day. It looked like this, right? And it was 0.08, right? So that's the kind of setup I look for, where the stock has momentum and it is going sideways, and I have specific criteria for anticipation. I only focus on anticipation setup where the stock is going sideways for less than 10 days. If it keeps going sideways for longer than 10 days, then there is not much of a urgency to get into this. So some of these are where anticipation setups coming into today, right? And some of them deteriorate, like some of them like during the day, but deteriorate like but that's what I look for. Like this is now becoming an anticipation setup because 2 tight days. Today it is very tight, just down 0.01. So this is something which I already have a position. I already taken a position in this one now, right? So that's an anticipation setup. So for an anticipation setup, what I look for is basically what I call as TTT, which is 3 tight days, right, in a row, or 2 tight days. Minimum 2 tight days. The ideal one will have 3 tight days. So this particular setup in this case is a 2T setup. So there are 2 tight days now. And this can become a 3 tight days. 3 tight days or 2 tight days is what I look for in a setup, basically like that.
Excellent. And I think another great process that I've learned from you, and you've taught many traders, is situational awareness. Situational awareness, your process for doing that. Do you mind running through what you look for and all that entails to help give you insight on that?
So for situational awareness, I have a process again, and this particular process I run in the morning. So this is a morning process, and this morning process is basically fundamentally trying to answer one question. Every day I ask myself a question in the morning: are breakouts likely to work for next 3 to 5 days? Right. So if breakouts are likely to work, obviously you go and load up, right? If breakouts are not working, then you don't you deprioritize, right? So in order to answer this question, there are certain tools and processes which I use, and one of the tools is Market Monitor, right? And in the Market Monitor, I'm looking at what is the breadth of things in the market, right? So here this is the Market Monitor, right? And in the Market Monitor, you will see whether buying is coming in or selling is coming in into the market, right? Whenever there is buying coming in, like currently there's buying coming in, so breakouts are working. Some breakouts are not working, but more or less breakouts are working because money is flowing into the market. Basically, this is a indicator of money flow into the market, right? But in addition to this particular tool of Market Monitor, I also have a new tool which I have been using, and which is a study 20% study. So this 20% study is basically, and this is plotted on SPY, and this you can only do in TC2000 version, platinum version. You can't do it in the normal version. But here what it is plotting is, it's plotting below SPY the number of stocks in the universe of Warden universe of stocks, right? And which have up 20% in last 5 days, right? So when you see extreme readings, like this was a 200 plus day reading, right? That was a 234. You see that the market had a correction, right? Now here, this was a 200 plus day, and in the short term period, like here recently, we had 200% plus day, and then the market had a pullback, right? So whenever this is like an oscillator, right? So when the readings are low, when the readings are below 20, I'm very bullish. And when the reading go to the extremes above 100, I become less and less bullish because that indicates that in the short period of time, you're likely to get a pullback. So using this particular methodology and tool, like a 20% study, which is like looking at how many stocks have gone up 20% in last 5 days. And in addition to that, the third thing variable is just the trades which I am taking, right? If they are having a follow through. If I see 3 trades in a row not having a follow through, I know that there is some problem in the environment, right? Because the setup is not a problem. Traded this setup for 25 years, right? So as a result of having this logically going through this, I answer this question either look at a yes. If it is yes, then you go buy breakout, or maybe, or select breakouts are working, then in that case you become more selective. You are only selecting breakouts with some catalyst or only A quality setups. You don't, or reduce your exposure total. And if the breakouts are not working, I just don't trade if the breakouts are not working, right? And basically, in addition to this, that's just the fundamental question: are breakouts likely to work for next 2 to 5 days, right? There is another question which I ask, right? And one of the things which I have discovered for trading over many years is, if you can get into a breakout as early as possible, or like what I call it, find and enter early. If you can find and enter early, it's very good, right? Because instantly you are profitable, and the trade is just you are just using market money to make money then, right? So I asked that second question: is find and enter early better here, or or waiting is better. So if I see that, like what I've been seeing in this market is every day morning, right, nowadays, almost for like in the last 1 week, even if the market opens positive, it sells up till 10 o'clock, 10:30 or 10 o'clock, and then the move starts. Like even today, you'll see the market sold up, and then at around 11 o'clock, this is like almost like a cycle which is happening. So if you buy a breakout early, what happens? You get stopped out, and then the stock goes up. Like good example of that today I can show you is like this particular stock NVTS, right? And out of the gate it came out, right? And if you look at on a lower time frame, it just broke out, right? And if you bought it, like, and it ended up giving up all the gains, and then later the buying came in and it became a successful breakout. So waiting little bit in this market condition is better than like finding an entry early. So this is again a process which I have like done. Similarly, I have a intraday tools which also helps me. Like this is number of new high and new low happening per seconds seconds in the market. So if I see lot of selling coming in, then I would like tighten my stops or like take profits early. So that's another process for situational awareness which is there basically. I think I can't hear you. Your microphone is off.
Yeah, thank you. And then this is excellent. And one other process that that I think is excellent that you do, it's very similar name to your 20% study, but it's your process for studying trades that have actually moved 20% in 5 days, and it's a way of teaching yourself what to look for to develop an anticipation setup or a similar setup. So yeah, if do you mind talking through that and how you use that to train your eyes for what to look for and build that visual memory.
So what I do is I have a couple of studies, right, and 3 studies I have like basically so every day when I come into the office, right, and I spend 20 minutes every day. There is not a day when I don't do this, right, as a process. This is again a process, right, and this is all because of my background of process orientation and all. I go and look at stocks which have made 20% move in the last 5 days, right? Because these are the kind of stocks which I want to trade, and I look at what is their, what was the starting point, what was the like, and I study them to see what kind of a signal would have got me into these stocks. And many of these stocks, like many of these trades, I would take also like if I miss a trade, then I go back and see. And also this study helps me in finding what works on 5-day time frame, right? One of the biggest finding on a 5-day time frame is it's not like really the stock doesn't need to have momentum before making a 5-day move. What it needs to have is just to start up a swing kind of a momentum, and then it works, right? But the bigger thing, the biggest realization is like the capitalization. You will see that all the stocks which are here in this 20% study, and I've been doing this study for many years, and there are stock B members who've gone and done a deep dive also on this one. You see capitalization out of the 80, there are 80 stocks here, right? And you will see that only 5 stocks have a capitalization about 10 billion, right? That's like 90% of the stocks or 95% of the stocks have capitalization below 10 billion. So this is a very important criteria, because when you have multiple breakouts, you should select a breakout which has a capitalization below 10 billion or a lower capitalization, because that's likely to make 20% move. Similarly, if you look at the price, right, most of the stocks which will make this kind of a moves will have a price below $20. So this is another thing which I look for in terms of capitalization, price, and sector. If you put a sector here, you will see that this list is dominated by technology, healthcare, and consumer discretionary stock. And this is all year round. Means like you can run this study for weeks after weeks after weeks, and you will see the stocks which is likely to make a 20% study is either going to come from technology sector, healthcare means biotechnology most of the time, and consumer discretionary. Occasionally, like currently, you will find some stocks are from metal and mining, but that's not really. So when you want to know what is the theme which is working, the 20% study tells you this, right? So I have this 20% study, both bullish and bearish side I study. Also it tells you, right, and basically that today, like you have 80 stocks, but on the bearish side only 11 stocks. So it's not like focusing on bearish side is of no use. In addition to this, because I focus more on higher price stocks because of size of account and things like that, I also have a study where I look for a stock which has made a $20 move in 5 days, right? It's a dollar study. So same way. And then I also have a study which I do more on a weekend. This I may not do it daily, but I do it on the weekend, where I look for stocks which have made 50% plus move in last 2 months. 40 days is 2 months of trading, right? And basically, so they have done 50% plus. So I want to see stocks which make 50% move. So on these studies becomes the output, like the output of this and the learnings from these studies then becomes input for developing setups.
Right.
And this is how I found setups like I found a setup EP 9 million from doing this kind of a work. When I found 50% stock, I found that they had a certain magnitude of volume. Or like I found a setup idea called weak structure short, which is a continuation short, by looking at these kind of things.
Yeah, excellent. And one other process that's related to this is if somebody wants to do a deep dive into EP 9 million or any of the setups, or another setup that they find, what's kind of your thought process for studying that, building that intuition, building that pattern recognition, so that they could recognize it in real time as quickly as possible?
So what I do is like for deep dive, right, and I deep dive all these stocks all the time, right, and basically now whenever I'm doing a deep dive on this particular stock, right, the number one question means you need do a deep dive with a certain hypothesis and a certain objective, right, and one of the objectives, where do moves start, right, because if a stock is going to make a 50% move, the general, I go to all kinds of websites and Twitter and all, and I watch a lot of YouTube videos, and I watch all your interviews also. General conclusion of people who talk about market is that stocks which hold up the best are the one which make the biggest move, right? My 50% study shows that is complete bullshit, because most of the 50% stocks start from low point and they make 50%. So if you want to find stock like GEV, it didn't start from it starts from low points kind of a thing. So in order to do a deep dive kind of a thing, right, I have what I always define. If I want to do a deep dive, like on a weekend, supposing if I am doing a deep dive, I define what is the question which I am trying to answer, or what is the problem which I am trying to solve, right? Because you can do a deep dive without an agenda, and then at the end of it, what is the learning? You don't know what is the learning, right? So if I am asking a specific question, saying, look, what catalyst makes stock go up %, right? Now that's a specifically focused deep dive, right? So when I start doing this deep dive, I look at then what was the catalyst for Duolingo, right? And it's earnings and sales is the catalyst, right? GEV, again, earnings and sales is the catalyst. Now what is the catalyst for Wingstop, and so on and so forth. And then I will see where there is a real earnings, real sales, and then you have lot of these stocks, like Dave has a real earnings and real sales, but a lot of these stocks which would have made a big move for the year, right? They would be something which is just some DFDV, right? I don't even know. It will be some catalyst which will be completely, we launched some treasury for crypto, or we managed to get 2 people to go in our spacecraft 300 feet above the ground, or things like that, right? So then you know what catalyst will move that, right? Then you start categorizing. You look out of this say 150 stocks are 50% up, let's say, in last 2 months, right? And you see that 50 stocks had real catalyst, and 100 stocks had this kind of a catalyst which is a story catalyst, and the stocks which had story catalyst made 2 times the move of the stocks with real earnings. So why am I wasting my time looking at real earnings, right? So that's the kind of, then again you want to answer the question, look, this is another one of my discovery, or not discovery but also observation basically, that most of the stocks which make even a 300% move, they make all that 300% move in less than 2 months. Very few stocks are going to make moves which will last 300% move, but like it will happen in 2 months or 14 days or 15 days. So this answers the question of look and how do you move your stops on those kind of things, right? Then so these which I discussed with you a couple of times, that concept out of these studies the concept came in, which is like there are magnitude moves and there are duration moves. Yep. And I also have studied, like this is not the only thing which I study. I have studied these stocks. I have this whole tab which I do for a deep dive, where I look for these stocks which have gone up for 5 years in a row, 10 years in a row, right? So I have these stocks which is like, say if you see this particular stock, Ecolab, right? Out of 30 years, right? This is a yearly persistency. So out of 30 years, it has 27 years, it has been positive, right? So what is the criteria? Why? What is the reason why? O'Reilly is a good example of a stock, right? In its entire 33 years or something, there are only 2 negative years. So what is special about this stock? So deep dive can answer these kind of questions, and then that can help you in finding different setups, or it can help you in finding stocks to hold for longer term.
Mm-hmm. Excellent. And to bring it back to kind of what you were talking about earlier in the presentation, could you just kind of break up your day in terms of when you're doing each process, the situational awareness, the prepping for the EPs and pre-market, all the way through the post-market? I think that'd be a good wrap up.
So I come to my office at 8 a.m. nowadays, right? And I have become lazy. Earlier I used to come at 7 o'clock. Now I start at 8 o'clock, right? So when I come in at 8 o'clock, right? And as soon as I open my computer, the first thing which is going to happen without like this thing is study 20%. Because the study 20% also is one of the inputs in situational awareness, right? So that allows me to see what kind of stocks, what sectors are working and things like that. And then that allows me to answer the situational awareness question. Now, so those 2 tasks are like the primary task takes around, this takes around 15 minutes in the morning, right? And then I start my work for what I have a process which I call as NTRT, MTRT, which is basically a process to find EP and SIPs, right? And basically, so this is where I start looking at earnings and news plays. So this is something where I will go and look at earnings which has been released last night or today morning. I'll look at what stocks are gapping up. And then I'll research. This takes me around 20 minutes, 15 to 20. It's a continuous loop which I am doing. So sometimes we finish and then some breaking news comes in and then you go back and research. But around 15 minutes kind of a thing, which I do this, right? Now once I have done this, I have a good idea how my day is going to be in terms of like what am I going to target, how aggressively I'm going to be buying breakouts and things like that, right? Then I have a visualization. I have set aside a time in the morning. I have a process of visualization, right? So I have these scripts which I have developed for visualization after studying the sports psychology and how the tennis players and all these other players do it and all. So I spend like around 10 minutes visualizing how am I going to be playing this market and what is that I'm going to do. And it's the visualization is just I'm prepping myself for the trading day in terms of clarifying my ideas, mind, and be very clear kind of a thing, right? And then once that is done, like I am looking for the market to open. And now supposing if I did some like research and I found some earnings plays and all, then if I want to enter them, right, and I enter a lot of earnings plays using what is called as an OPG order, which is opening price guarantee or market on open order, right? So by 9:20, if I am going to do something for OPG and all, by 9:20 my orders will be in for those stocks. So I would have already put in the orders and then I'm just going to be watching kind of a thing. And then once 9:30 the market opens, right, I am looking for either a delayed reaction kind of a setup which I am like trying to enter. If I see something starting to like breakout, then I'm going to enter, or I'm going to enter a breakout. Right, and then by 10 o'clock I'm done. By 10:30 means invariably by 10:30 I am done trading. In terms of most of the time I am like whatever I wanted to enter or things like that I am in, right? And basically, so then I go to the gym, I do all my exercise and all, and then the second part of this process starts. So I'm going to put it here so that like we have continuity on the same slide.
Yep.
So at around 2 o'clock I start looking at like I say by that time what happens is sometimes you have open positions, they get closed out, or you take a profit and you have more capital. So or like some of the breakouts which you buy, they didn't work out and all. So you start looking at second cycle of okay, I'm going to get into some breakouts. I'm going to run the breakout scan and look for some more breakouts, or some of the dollar breakouts, kind of breakouts which are slower in movement. They don't show up early. Those are the kind of breakouts which I will run. But by around 3 o'clock, right, this is also done. By 3 p.m. I look for anticipation. I start running my anticipation scan, and I also have anticipation and a reversal, which is like a pullback kind of a setup which I have developed. So these two I will look at it. If I find some candidate, even if I find it at 3:30, I don't enter them, because if you enter them at 3:30, a lot of time what happens, what looks like a good anticipation candidate deteriorates, right? So I wait. It's just like a killing time till around 3:58, and in 3:58 I put in my orders and I am done for the day, right? And then the cycle continues next day basically.
Excellent. Well, Pradeep, thank you so much for running through all of this. Do you have any general advice for traders who are earlier in their journeys in terms of creating their processes or thinking about the whole process of creating processes? Any general advice to leave everybody with here today?
So anybody who is a beginner trader or even a struggler trader, right? And the first thing I think, there is a hierarchy of decision making to arrive at a process which you need to do. And I think the first decision which you need to do is some time frame decision. Once for all, decide whether you want to be a day trader or a swing trader or a hybrid of day and swing trader, right? Or position trader, like, because once you decide your destination, several flights and several paths will open up.
Right.
So this time frame decision, once that is done, then setup. Because whatever time frame you decide, you want to decide like to become a day trader, you will still need setup. Now once setup idea is, you research setup idea, deep dive, back test, whatever you do, you decided to look for a setup for, let's say for a day trader, let's assume that you decided to become a day trader, right? And basically, and you are going to trade setup which is very popular, which is like a shorting small caps, right? Which is a very popular setup which day traders use, right? And basically now you need to have a process, because in order to short a small caps, you need to identify stocks which are making very big moves. So you'll have some scans, or you'll have run real-time scans to see stocks which are up 200, 300% kind of a thing. Then you'll need a process to research, because you can't just short it. All these people who do this small cap shorting, they will go to websites like the dilution tracker, they will read the SEC filing, they will see how many warrants are there and what is likelihood of like when that company is going to come out with a secondary filing and things like that, right? So you research, and then you decide these are my 2 or 3 candidates which are like, and I am going to be targeting, and then many of them will go a step further. They will decide their levels. They will probably put in like levels, support, resistance, or whatever they will draw on that pre-market, so that they know this is the level at which if it starts coming, I'm going to short, or this is the level at which I'll take my stop, or things like that, right? And basically, then there is a process which you need to have to find the shorts. You need to pre-borrow those shorts. So there will be a process to pre-borrow and things like that. So step by step, you will have a process, right? And once you get into a trade, then you will have a process as to how you are going to put the stop. What happens if it gets halted? What happens? All those things, right? And basically, so systematically you have to develop the process. Now, once you have a process, right? Whatever process you do, whatever process you develop, you have to keep iterating and simplifying, because process engineering, I studied process engineering. The first 30 processes which you develop are always junk. You learn by actually implementing the process. On paper you can write a process, but when you implement, you find, oh, if it halts, and if it halts 2 times in a row, All your process of saying I'm going to put my stop doesn't really work, because it just like opens 100% above your stop, right? And basically, so process undergo iteration. So iterate the process. Once you have iteration of process, and once you freeze the process, right, then unless there is some reason to change things, don't change the things, right? And because one of the problems for a lot of traders is they just keep changing processes, or just because a fancy tool comes in, they just like go, and tools can be a distraction, right? And every day, you know how this industry is, right? And I get pissed 5 new tools, right? If I start spending my time on the tools, my process will go for a toss. So then freeze the process, and once you have one process and one setup completely under your belt, then start developing, start thinking, look, now this process only requires 1 hour. What can I use my time better for? What other process can I do? What other process can I do to trade differently, and things like that. So it has to be a process. Means ultimately, you become a successful trader when you find a process which works for you. Right? Setups are in public domain. There are dime a dozen setup ideas in public domain. The difference between a profitable trader and unprofitable trader is the profitable trader has managed to develop a process which works for them, right?
Excellent. Well, Pradeep, thank you again for walking us through all this. This is excellent. Where can people reach out to you or learn more from you if they'd like to? Obviously, we did the episodic pivot masterclass at TraderLion, but other than that, which you can find on TraderLion.com, where else would you point people to?
I have Twitter is where a lot of people contact me. YouTube, my blog, or people just membership is one of the option. But even if you are not a member, most of the time, right, and if somebody contacts me and asks me a question, I may not be able to answer that in 1 hour, but I try and answer every single email, every single DM. I try and answer within a week. Expecting me to answer it same day is not going to happen because of the volume, but I answer all the questions which people have, basically all the time, even if they are non-members. I answer all questions.
Excellent. Well, Pradeep, thank you again for being a part of this and for sharing all this. This was excellent. To everybody watching, make sure you check out the resources that Pradeep mentioned. You can check out his blog, of course, StockBee, and we'll have the link to his Twitter in the description as well. So, Pradeep, thank you again so much for being a part of the conference, and we'll see you guys in the next one. Cheers.
Thank you.
All right, welcome back, everybody. The next presenter of the TraderLion conference is Leoš Mikulka, top performer of the U.S. Investing Championship last year with a return of over 400%. Today, he'll be focusing on a really important part of trading, position management, sell rules, selling into strength, how to manage your positions and manage winners, because we all actually know, winners don't just take care of themselves, so we have to approach them properly, and he'll be sharing his process for that, along with a bunch of other great tidbits about achieving strong performance. So Leoš, thank you so much for being here. Looking forward to this, and yeah, thanks so much for your time.
Yeah, thank you for having me, and also thank you again for putting this trading conference together. I think when we see the names that are presenting, I think it's an honor to be here, as a privilege. So I'm very grateful I can put a little bit of what I'm doing, and hopefully it will be useful at least for somebody. What I would like to go through is, as the headline says here, managing trades with price progression in mind. What it actually means is, because of course everybody wants to catch a big winner, and what I will touch in one of the slides is a lot of people start with a can slim or traditional growth investing, and very often you just see buy points and trying to add to the position and ride it all the way. But very often this is not the case. Very often there are points where you have to trade around the position, you have to reduce into strength, sell, you're gonna get stopped, knocked out, how to get back in, and so on and so forth. Just very quickly, some intro about myself. I've been trading now nearly 10 years. Personally, I'm not a full-time trader or professional trader, even though with my time zone being in Czech Republic, you can kind of understand it as a being basically full-time trader with a second job. Otherwise, I'm working in a software industry, and I'm coming from a sports background. That's also maybe where the competitiveness comes from, and the kind of being the last in line, having the responsibility, for making any mistake, and bringing this into the trading perspective. And also recently, not to have enough time, also became a new father. So
Congrats.
Thank you. So another thing to take care of and take care of the risk management from that sense. Otherwise, from the trading perspective, as you can see here, I would classify myself as a swing trader. As you will see on the further slides, my average holding period will be anywhere between roughly 10 to 20, 30 days. Approximately, of course, it's an average, so I might be kicking out some winners very early. I may be trying to ride some big winners through market leaders a little bit longer. But otherwise, my average stats from a long-term perspective, as you can see here, are the average gain is somewhere, depending on the market conditions, anywhere about roughly 6 to 12%, with average loss 3 to 6, trying to maintain at least that 2 to 2.5, 3 to 1 R ratio, with a batting average approximately about 50%. Sometimes it's closer to 40, sometimes closer to 60, again depending on the market conditions. And what I would say, I guess the big things from what I'm doing is I'll be very quick to reduce into strength. I'll be having a tight stops, which I'll be quickly moving stops, and of course occasionally I'll be catching some of these small gains, occasionally catch a big winner. Of course, it has some drawbacks. Very, very often I might get stuck in a losing streak of maybe 20 losing streaks by using these tight stops. But on the other hand, when conditions are great, like in last couple of months, you might be catching, on the other hand, 20 big winners with basically free lunch. When I go to a basic how I started with the trading, as I said, as many of us started with William O'Neill and the IBD Investors Business Daily, and with this book, How to Make Money in Stocks. And the very funny thing with that book is, like, every time you come back to it, you will discover something new. So when you read it first time, you probably see, like, okay, there are some bases, there are some cup with handles, and on the way back, I have to be adding it to my position to ride the whole trend for maybe 1.5, 2+ years. Like example with Coca-Cola, with these timeless principles, it appears over and again. And over time, however, we will probably start thinking, what does it mean when when William O'Neill says 20% is profit-taking zone. What does he do? Where does he take profits? Of course, I cannot see into his mind, but I try to highlight here probably what I would do, what I would try to do. As you can see, it's kind of a dancing around with that position. So when you start buying from the first base, you probably want to hold a little bit longer as you progress through the base. You might be holding into that first high handle or natural reaction, but over time you might be start reducing and freeing that capital, because of course time is also money, so you want to have capital available on hands maybe for some next breakout which is lined up and is going through the buy points. So there's multiple ways how to handle it. We will touch on multiple of those aspects in the further slides, but I just wanted to highlight that key principle of probably what I would be doing. I will very rarely catch the whole trend. I will most likely be several times out, and then I might have, depending on the strength, I might have to be getting creative of trying to get back in. But yeah, and as you can see, during that trend I will be probably trading the position multiple times. Further influences, as I said, I started with the canceling, but who further defined kind of my style, I think one of the key foundations, or the very solid foundations, were when I joined Mark Minervini's services and was kind of inspired by his books, by what he's doing. And I guess the main thing which kind of stuck in my head and the principles that I put into my trading are his quotes: improving your worst case scenario. Immediately when you get into a trade, you want to be moving stops, de-risking. For example, if you start with the average stop of 5%, you want to get ASAP into 4, 3, 2% maybe to break even and kind of free roll the trade. It's another of his term. You guarantee some profits. Now if you get stopped, it's going to be the worst break even. And further on, I got along with Leif Rada, who kind of helped me to fine tune this strategy and started looking into also alternative strategies, like looking lower into bases, kind of understanding the whole price progression, supply and demand action. And one of my favorite quotes that I picked up is 100% cashometer. It kind of goes along with getting ready lower in the base. When everybody's going into cash, you have to start going through watch lists and really trying to identify the next true market leader and maybe potentially start getting on already a little bit earlier than from a classical cup with handle or similar patterns. So also if you want to get a little bit of what we're doing in the champion team trading, feel free to join. I think we'll be very happy to have you on there.
And Leoš, before you go to the next slide, so sorry.
Yes.
Could you just expand a little bit on what free rolling means? Because I know you explained it quickly, but some folks watching might not be super aware of that term, and you'll be showing examples of it for sure, but could you just give another quick definition?
It's very, very simple, actually. It's basically taking the profits, the amount of profits, or moving the stop to the scenario when if you will get stopped out, you will not lose any money. So for example, if you say your initial stop is 5%, if the stock moves up 5% and you say half, now you get stopped for 5%, you're at break even, right? Or there are various strategies where you can combine, we will talk about it, where you can combine actually raising the stops maybe to 2.5% and taking off a little less, or maybe moving the stop to break even and higher.
Yeah, perfect. And this helps your mindset as well, not just the capital.
Absolutely.
Yep.
Other thing I wanted to talk about is, because maybe throughout the slides very often you will hear term overhead supply, or a lot of people might hear it when you listen to several talks, and there's always this term mentioned. I think the key principle is to understand what supply and demand is. If you think about it, the supply, it comes from a Latin supplere, means fill up. So what it actually means, right? When we say there is a supply, it means there's somebody trying to fill up the market, trying to give you the goods, and are happy to dump it in certain prices. On the other hand, demands coming from Latin demandere, ask for, is people calling for something, right? People are willing to pay higher prices. People are calling for, expressing their interest for certain goods. So if you have a lot of supply, it means there's a lot of, the market is overflowing with goods, but you don't have any demand. It's naturally causing the prices to drop, right? Because the sellers need to get rid of their goods. On the other hand, if there is a more demand than supply, it means the buyers are willing to pay higher prices, and there is basically no sellers left. And well, I just wanted to highlight, if I would show you these slides and not telling you what kind of name it is, not giving you moving averages, and if you just look at it first, like, what do you think? Where is the supply? Where are the trapped buyers? Where are the sellers? Right? It's some people might say, okay, I would like to fish along the lows because it looks super cheap. On the other hand, some more experienced people might say, okay, there are no buyers. There are no sellers there anymore. Here, the buyers are probably willing to pay higher prices if it moves through. Right? Both scenarios for certain styles are, I guess, feasible. You just need to know your style, and I guess what's the most important is where is the highest probability that you will experience less fluctuations, less volatility, the scenario where there will be less sellers on the way up. And if we move next, just to give you a heads up what it is, I give you moving averages, you probably have a clear example where you would be buying, because suddenly you see 200-day moving up, 200-day moving average moving up, 200-day facing down. You probably don't want to be entering in this kind of a messy scenario with vigorous ups and downs. And as you can see here, if you would be trying to get on board at this point, what happens after? You immediately hit probably that supply that we are talking about right here. It causes the prices to drop. There is really no demand in the market. Same thing happens here. You again run into those sellers right here, and eventually once you drain all that supply, you'll finally start moving up. On the other hand, if you would be buying in this area where there's basically nobody up here, then you have kind of a smooth sailing up. And maybe if you would start before starting looking at daily, if you would actually start looking at weekly, it will probably provide you even clearer example, because immediately you can see kind of transitioning from the uptrend in some kind of at least the sideways scenario, possibly downtrend, whereas here you are in clear stage 2 confirmed uptrend, probably on the way further move up. As you have here the first base, only thing that you have here basically second base forming, starting new stage 2 uptrend.
And you're pretty much, for your trading style, which is a little bit more short term, you're pretty much fishing within a stage 2 uptrend. You're finding spots and bases and consolidations and breakouts within an existing stage 2 uptrend for the most part.
Exactly. For me to start buying, I would be looking for at least the, what I would say, early uptrend. It means the 200 days, then the 100-day moving average, 50-day facing up, and stacked above each other for at least a month. And of course, then it depends on the depth of the base and the overhead supply that we just talked about. But those are the points that we'll touch on in a further slides.
Great.
And yeah, let's now get actually to some real case scenario and how to handle this whole uptrend, or how I would handle it in my trading, in my style. I guess the first thing what you need to understand is when you're getting into a trend, where you are in the uptrend. As we talked about now, are you moving back from some prolonged correction, some stage 4 downtrend, from some sideways choppy action, or are you in the midst of the uptrend? And if so, where in that uptrend? Are you out of the base? Was there any natural reaction, meaning price drop without any further base, like the normal base you will expect, like 4, 5, 6, ideally 8 weeks, whatever is, I would say, below 5 weeks, 4 weeks, that what we can call natural reaction, not proper base. In my experience, what we can observe from the bases, usually would be looking somewhere 1, 2, 3 max for natural reaction before you want to expect further bases to be set up. And as you will see in the example here with the Palantir, as a kid 8 moved into the stage 2 uptrend, progressed further base 1, base 2, and further here is kind of a tricky scenario. I would say that's the recent market correction. Really depending on I wouldn't necessarily get stuck in a terminology whether it's a base number 4 in a stage 2 uptrend or whether you would consider it as a base count reset, since we have a market correction of above 20%. To me, it's really just getting lost in a wording, and it's really your point of view. I don't find it that important, whatever you categorize it. Now the interesting part: how do I start getting into that position, and how I actually started getting into that position is. So first we would be looking into break of the downtrend itself. I'm not gonna be trying to fish the lows. What I want to see in the base would be at least the break of the horizontal line here. Clearly you can see what you deal with here is that base is kind of skewed. It's very time compressed. You have just only a few days, few weeks to the left. It's very sharp base. So now, if I decide to go into such a trade, then there are certain factors that I already have in mind when entering such a trade and how I'm going to approach it from a risk perspective and from taking the profits. That's the important part that we're talking about, having the price progression in mind when you're entering from any buying point. What you can see here, what I try to sketch here, if you're buying in such a low area from kind of this pullback, or from Mark Minervi would call it low cheat, then you're immediately running into that resistance supply here into those levels. And as you will see here further, what I would be immediately thinking, okay, we have this first level, and then we have here this 100 level, the psychological 100 area, where probably there are going to be some sellers too. So if I'm going to get into this trade, I'm probably start reducing somewhere in that area, probably reducing, if it moves even further, reducing further. What I did here, started with a very tight stop, with a 2% stop only. It also allows me, if you have such a tight stops, you can try multiple times, because then if you get your 3, 4, 5 multiple risk ratios and next tries, then it's going to all pay off. What I did here, started with a 2% stop and immediately reduced into that first, as you can see here, into that first supply area. This way, as we discussed before, about the free rolling concept. We started with a 2% stop. Now if I reduced, let's say 30% or 40%, now I'm moving my total stop, if I get stopped out, to less than 2%. I might be talking now maybe 1.5%, 1.25%, and so on. What happened after? So naturally, very often it happens, it turned directly on that resistance. I got stopped out. As you can see, I further moved that stop a little bit more up. This total stop was 0.5%. Nothing very dramatic. I can just refocus and wait for another buy point to present itself, which it further did. If you look at the volume action, actually very nice volume action. You have a higher volume up. On the pullbacks, you have a decreasing volume, and it formed another very nice, this kind of another, you can call it a pullback buy, or again the low cheat with actually more defined pivot. When it crosses this high, I would be starting to buy again. Sometimes I will be trying to, which is maybe one of the drawbacks also in my trading style, I might try to front run the breakout sometimes. Also the reason there is to, again, minimize the stop. So I might be trying to get a little bit lower with the thing that, okay, there are increased odds I'll get stopped out, but at least that stop will be lower. this time that breakout actually worked pretty well. It immediately moved into those areas what I expected would start forming another pivot. As we can see here, I started reducing into these, onto that, as it crossed to that kind of area where I would expect another pivot, and it was approaching this 100 Livermore level. That's a term I picked up from Leif. As you know, Livermore psychological levels 100, 200, 500 Anaconda steel. And logically, again, started correcting there. Honestly, naturally, I would expect some. For me, that's why I move the stop up and place it into an area, since we would expect, if you have another pivot setting up, then you would be expecting some action, kind of staying inside and forming it, basically turning that prior resistance to support level. You want to kind of stay on this kind of a red box and form the pivot there and move further through this area up higher. Unfortunately, it didn't happen. It stopped me out again, but as you can see now, I reduced twice. Now I'm getting stopped for a break even. So now I'm probably looking for some gain of, I would say, I don't remember exactly, but I think it was somewhere like 5%, 10%. So the total might have been maybe around total 5% gain. Further action, then we're starting to look for a normal base. Unless there is again some similar setup presenting. Here we had a nice shakeout from another area. In my style, this would be very aggressive, but also probably buyable. Unfortunately, there's a little gap, so it's kind of a tricky where you're gonna place your stop. And finally, we set up that pivot that we expected here. Finally, we set it up here and you can see also that base is pretty symmetrical. So I'm kind of here. I sacrificed myself and bought the gap up right to 100 level. What I would do here is, it's kind of a counterintuitive thing, how to cut your volatility down, because a lot of people will say, okay, increase volatility, I'm just gonna increase my stop. Well, I'll try it the other way around. Try tighten your stop and try it multiple times. Right? At the end, like if you count your money that you lost or gained, then all the money lost on one stop may be, basically 3 tight stops might be the same thing. So why not try it, and maybe you'll get lucky second time and it will save some money. So if we go further, how to handle the trade, here we've kind of logical what happened here. We crossed the 100 level and finally the real buying power started showing up. Already not that many sellers left, so here you have a very nice leverage what to do with the name after. Now if you're getting into the area, again here, resistance area, now you have a leverage what we talked about with the free rolling. Now you can decide, depending on your style, are you gonna try to hold through another handle, since we're approaching area where it would be very natural to form the handle which you're finally getting. Are you gonna try to hold through it? Are you gonna try to reduce some and get back in? Or maybe if you're very short term, you can also book the whole gains and wait up for another pivot and try to be creative getting back in. And you have multiple ways how to reduce the risk, right? You can, if I'm looking for a breakout here, very often people reach out to me and they ask, like, okay, your average stop is 3%, so you automatically set your stops for 3%. It's actually not the way. What I do, I would start with a 5%, and actually if you reduce some into strength, let's say you start with 5%, you reduce something, and then you get stopped out for 5%, your total loss is not 5%, it might be, for example, 3%. As similar thing with taking some profits, moving your stops, and as you move here, as I was saying, you have now a lot of options what to do. You can use your moving averages. You have here a 10-day moving average. You can place your stop there if you know the character of the name. Here, respecting the 10-day moving along it, you can set it there. You have a break even. Or if you want to allow a little bit more undercuts and you're trying to hold a little bit more long term, maybe you can place it a little bit lower, peel some off, and again, there is the trade. You don't have to move the stop at all. You can start with your initial stop, even if it was somewhere here, and only reduce the position. But really the goal is, as I said on the second slide, to improve your worst case scenario. So if you're getting into the risk multiples, you don't want to be giving back all the gains. You want to protect those profits. so you can focus on another name setting up. And for me personally, what I would do here, as you can see here, reduced, I would expect here a natural handle. One thing that I'm a little bit bad in is trying, a lot of people wait for a close below the 10-day moving average. I will very often cut it intraday, as I did here during the checkout here, move to the handle. As we set up the handle breakout, I would be buying here again. And what you will see on the next slide, if you get into certain scenarios like out of the base, little downside of it is that sometimes you might be trading a lot. You might be trading around the position, sometimes even forcing trades, but it all should be predetermined. You should not be really calling any audibles during the day and trying to get into some buy points that you didn't figure out before. And as I would say, what I did here, as you can see, I would be buying that handle again, as we discussed, reducing it a little bit into strength. Here I got stopped out prematurely, I would say, looking at it back from a post-analysis perspective. But again, we have here reduce, break even, stop. So I'm looking, at least I guaranteed some gains. I don't have to set, in case we go here to the further downside, I don't have to sit in a loss. I have guaranteed profit in the bank, and I can be focusing on the next price action. And as you can see here, further try to get back on those pullbacks of the moving averages. Similar scenario, reduce, got stopped out here. Finally, I was waiting for a classical breakout to new highs. The reduction here, I remember it was due to market was getting a little strange, so I just took some bit off. There's no further thinking behind it. Stopped out for break even, as you can see here, even though tiny gain, but still not a loss. So that's also the reason when several people reached out to me and they're saying, how is it possible that sometimes your batting average is getting so high? Well, that's the thing that you have to figure out what works for you in mathematical perspective. It doesn't really matter if your ratio is 4-1 and you have 30% batting average, or you're very aggressive or reducing the risk. You might be cutting down the ratio a little bit lower, but on the other hand, you're increasing the batting average to 50-60%. So the total number of that adjusted gain to loss ratio adjusted to batting average is approximately the same. It almost makes sense from a mathematical point of view. And just, I'm not gonna go completely throughout the slide. There is just a key principle that I wanted to highlight. As we discussed, there are multiple ways what you can do with once you start getting into profits, how you can manage it. Right? You can sell a portion for profit. We start here with original stop for 5%. So let's say you sell quarter for 3R. Your total result, if you get stopped out, is break even. And magic happens here. What I like to do here, this is the most common scenario which I would be doing in my trades. Selling for portion for profit and moving stop up. Let's say here we reduce stop just from -5 to -2.5%, and suddenly even selling a quarter for 2R, you're already operating with a positive expectancy. So I think this is for me, this part here is for me the sweet spot. If I would be reducing this quickly, then I'm not gonna be usually selling half. I might be selling most often between quarter, 1/3, maybe up to 40%, trying to really guarantee that positive expectancy ASAP. And of course,
I'm sorry.
Yeah.
Of course, I'll let you finish, please.
Yeah, of course, if the name moves a lot, let's say 10, 12, 15% up, we don't want to give back all the gains. So then, for me, the recommendation would be just sell something for profit, move it to break even, and here even the 1R guarantees you positive profits.
Yeah, what I was going to ask is, does it depend at all on the strength of the market and your recent trade feedback, which one you typically do, whether you sell 25%, 30% at 2R or 3R? How do you decide, per trade what strategy you're going to go with.
Yeah, there are multiple factors. I have it in one of the last slides just to recap. Of course, there are multiple ways and multiple factors that come into place. Since trading is more art than a science, there are several factors like amount of overhead and the sharpness of overhead. Of course, if the overhead supply is 2 years back and it's 15% decline, then you're not dealing with much. You can be very comfortable. On the other hand, as we showed in Palantir, you have there 40% decline in few weeks, then you probably want to be much quicker. Then, as you said correctly, the market conditions. How has the market been performing? And I guess for me, the more important than the market itself are the groups and sectors of that name. Is that sector hot? Is that theme hot? Is there a chance that, are there maybe another true market leaders from that group and the name might follow? Has there been any true market leader that already bounced from certain similar pattern? Like we had few months back, there was a lot of double bottoms bases breaking out. Has there been such a scenario? So it's also looking at the context. And the third factor also comes with how speculative the name is. What is the trading volume? What is the market cap? Are you dealing with some tiny cap under 1 billion? Are you dealing with Tesla? Of course, if you more speculative and more volatile name, as I said before, you want to cut down the volatility by taking your profits quicker and moving your stops quicker.
That's great. Thanks.
And another stats, not to have enough of them, just to show you the magic, what you can do if you move a little bit of your batting average or a little bit of your average gain or average loss. As you can see here, there is a return over 100 trades. And look at that magic. For example, here you're moving, let's say your average gain is 6%, which is very much achievable. That's nothing too dramatic. And your initial average loss is 3.5%. Your batting average is just a little than 50. Over 100 trades, you have 27%. If you just move that stop a little bit higher to 3%, it means you might be a little bit quicker on taking some profits, or a little bit, just tiny bit quicker in moving stops. First of all, your batting average might increase because, as we discussed before, by moving the stops, you are very likely putting yourself in scenario of potentially improving that batting average, and you improve your average loss. In that case, suddenly you're moving just with this tiny adjustment of 0.5% and 3% batting average. Suddenly you improve your return over 100 trades over above almost 20%. All right, and then if you're looking here, that if you are in some awesome conditions like maybe 2020. Or also last year, when you're operating, when a lot of names are flying, and you can be very quick on moving the stops higher. If you move it to, let's say, 2.5%, which is very tight, then you're getting, even with batting average below 50%, but guaranteeing this over 2 hour, basically over 2.5 hour, suddenly you're looking almost a super performance of nearly 100%. Yeah, maybe not to forget this very important highlight here, that especially in the bad times, you cannot really influence, when you're getting into a trade, you cannot influence what's going to be on the upside so much. So you really have to take care of that downside. And again, it's come for the multiple times mentioned today, improving your worst case scenario and really taking care of this column right here. Before, when we were showing the Palantir, we were showing trading inside of a base. We showed starting at the bottom of a base, going through alternative buying points inside of a base to a traditional kind of a high handle scenario. But then, of course, comes the scenario once you get out of a base and you're in a strong uptrending market and you're a very quick trader. What do? Because you very quickly you might get yourself out of the position, and of course you don't want to sit there the whole uptrend, which can be lasting for a year, 2 years, just watching the name go higher. So again, it comes down to understanding how the name is acting. Of course, if you have time to investigate and look at it, it's always very good to know the character of the name, what the name was doing in the past, as I will show here on the example of GEV, which I traded multiple times last year. What we can see here, there was a first base, then we were looking at one natural reaction, second, basically here you can consider as one ascending natural reaction, so totally you have about 3 of them. What's another characteristic of the name? It's respecting the 10-day moving averages whole way. Try to undercut it several times. I remember vividly there were also some bad news as they were focusing or shifting the focus from a wind energy to nuclear energy, but it always just shook down the 10-day moving average, continued higher. And finally, once we got the change of the character, when we started closing below the 10-day moving average, it finally set up that second base that we were all expecting. Unfortunately, then this mess happened here and we had to wait for another base. So it's very important to understand what you're dealing with and also how is the name acting in extensions. What are the extensions? Are there any blow-offs? Are there any high volume reversals throughout the cycle and so on and so forth? And so if we would look how I would trade the name or what I would do. So let's say I buy the breakout here in this area. As you saw on the slides before, you can probably guess that I would be probably trying to hold at least or majority of the name. If I peel here, I would peel probably 10-20%. As I said, when we're looking at the first base from the stage to uptrend, you want to ideally wait at least through this first natural reaction, especially if it's kind of a high handle scenario here when you haven't even advanced much through the base. It's just basically checking out. If you look at this, it's kind of a pullback buy to the base itself. And then further as we start advancing, you're starting getting this David Ryan MVP criteria, which is, of course, is a sign of immense strength, but it's also a sign that you should be ready for a pullback and you can expect some sideways action. So for myself, if I would be getting on here, I would be reducing largely here. I would definitely keep some small portion of the position, let's say 1/3 of the original position or something like that, to ride for the bigger trend. Because for me personally, if we start from the, let's say, new uptrend, what I will end up with throughout that uptrend, I will have kind of a basket of tiny positions which I reduce throughout the cycle, but I'm very bad in selling that last remaining portion. So I might be sitting with few larger positions if we're in the midst of the uptrend, and then pretty big basket of those tiny positions if I didn't get back on. Personally, I approach the all new each add-on as a new trade, so in my stats it kind of show as a new trade with the new statistics. And as you're starting getting into from the base and you're seeing the natural reaction, of course you have to keep in mind that you cannot expect the new base right away unless you're looking at some slow mover. So you always have to keep in mind that the first few natural reactions are addable. So you can be easily looking into the add spots. As we said here, it's respecting the 10-day moving average. If it bounces here from a 10-day again, very easily addable, as you can see here in this breakout. Volume coming in, sign of strength, you can be buying, adding back, and so on and so forth.
And that natural reaction is really tight as well. Really holds really tight against that 10 EMA. Exactly.
Ideally should be very tight. You don't want to have some very volatile action, but which is much more difficult to deal with. I'm not saying not possible to trade, but again, you're dealing with a lot of other factors that you have to take into consideration. Because at the end, in the stock market, anything is tradable, right? You can trade anything any time of a day. Nowadays, you can just with 2 clicks, you can enter a trade. So it's all right. And just touching a little bit also on the alternative buy points, as you could see probably also in that Palantir example from before. Personally, I would not be looking always for a breakout to new highs. As I said, very often I will be front running the breakout, or looking at the natural support areas. As the example mentioned here, the pullback buy. When you're looking at a pullback buy, again, it comes down from knowing the character of the name. As we saw here, as we discussed thoroughly, respecting the 10-day moving average. So this is the scenario of the GEV from this year when I started trading it again. After that, as you can see, after it blew out here, set up new base, and now I know, okay, previous cycle, what did it do? It formed a normal cup. It kind of set up a high handle or first natural reaction right above the base with a pullback back to the base. So okay, I probably know what I'm dealing with, so let's try to get on. Especially given how powerful this thing was, there was not too much space to get on board. So from the pullback area, you always want pullback. You don't want to be just buying random mid-air price fluctuation. This is not a pullback. Pullback should be into some kind of logical area, and as you can see here, we have a kind of the resistance area, supply area here. We have new high breakout here. What the thing do? It crosses to that. You have here two logical support points. And you have the 10-day moving average, and you have that price volume area here, where it finds the support, bounces back from there. So I'm not necessarily increasing my risk exposure by waiting all the way to new highs, but I can very easily minimize my risk of seeing the volume coming in here, finding the support rate of the 10-day, and I will be kind of buying as it crosses this kind of upper wig of the day before, putting myself in a very favorable situation in terms of risk multiples. And then comes the same scenario, reduce here a little bit portion, riding probably at this point, I'm pretty confident to say that I was probably having a stop already at break even, since we have also 10-day moving average there. So it would be a very logical area to find support. Unfortunately, what happened here is kind of changed the character, which is also one thing to mention and to notice. If you see from the name, okay, suddenly it's starting to respect, instead of 10-day, maybe 20-day. So maybe if we move up from here, and I'm somehow dealing with the name further down the uptrend, I might be probably thinking more moving the stops to 20-day instead of 10-day, since I know it's probably changed the character a little bit. But as you can see here, it ran what I would be thinking here. Okay, I try to reduce a little bit, then we have a 500 level. Again, psychological level 500, I'll be trying to reduce a little bit there. So it naturally hit the resistance 500, and the same scenario, somehow bounced to the moving average, found support, and I started buying in these pullbacks from, again, those 10-day moving averages. It was crossing those highs, a little front running, and same story again, small volume pullback buy, high volume follow throughs, reducing a little bit into strength, moving the stops and moving on further. Of course, this style has some drawbacks, as I said multiple times. One of the drawbacks is that if you're too tight on the risk, what might happen, and I can guarantee you that it will happen, is you will be getting knocked out prematurely. As shown here in this example with KRMN, which I traded this year, as you can see, there is a lot going on. And I try to buy here from this very nice kind of IPO, kind of a skewed cup, as it formed this kind of a contractions in the price and volume, and broke out, reduced a little bit, again, as we said here, a little bit into those highs, to the resistance, reduced prior to earnings. Then we have a earnings report. My stop was below the 10-day moving average. If I would be having the style like some other traders do that wait for a close, I would be very much safe. Unfortunately, I'm a little bit of chicken when it comes out to the risk, so I chickened out here, hit the stop, then 10-day moving average completely shook me out, went without me. Now when this happens, how do you want to deal with it, right? So first of all, do your post analysis. What did you do wrong? How you can improve it further? Did you stick to the rules? it also doesn't mean that, okay, I found something, then I'm gonna completely change my rules and rework my playbook. But is there probably something I could have done better, right? And of course, another thing is if you identify as a true market leader potential, then you want to probably be getting on back. And the true market leaders, of course, as they always say, they're very hard to buy, very hard to get onto. Then the downside of this style is then you might have to be trying to investigate really some alternative buy points, try to get a little creative with how to get back onto the name. If it goes and has very shallow pullbacks, very short pullbacks, might be a little bit tricky to deal with the situation. For me personally, example what I did here, as it formed here, this kind of started forming this mini base with the IPOs. We can be thinking also a little bit extending the time range. We don't necessarily want to wait with IPOs 4 to 8 weeks for a base, but few weeks is okay. And as it kind of finally the volume here on those sell-offs really dried up, and we can see this higher volume coming in, pullback buys through this resistance, mini resistance area as it pushes through. So I'll be buying here. And unfortunately, second time, same scenario that happened here. Really didn't learn my lesson. Thinking, okay, hitting the resistance area, it should kind of respect the 10-day moving average. Again, move the stop very bit higher to break even, since I don't want to give back all the gains that I earned. Again, get stopped out, shook out, and without me. So getting into a name for a third time, same scenario, pullback buy through this mini resistance area, moving the stop, reducing, and trying to grind the name further. And another thing which will be happening to you most likely is if you're trading, especially in these alternative buy points like pullback buys and low cheat areas, and you're dealing with the overhead supply, you might be kind of forced to overtrade. You might be really doing a lot of trading around the position. So if you do that, of course, be mindful that you're not losing necessarily just the financial capital, but my mental capital is also very important. So what happened to me, for example, last year was the typical example. It was the APP, which I traded like three times, always got shaken out on the trying to trade imperfect buy points, and it finally set up the perfect buy point that really went. It went without me because I kind of lost conviction, lost that mental focus on the name. So just really know what you're dealing with, know the odds, know your numbers, how you're performing from the long-term perspective, and really do not try to take away your focus from the name. If we go further, just kind of we're coming to the end to summarize also what you already asked before. What are the factors that you have to consider when dealing with trading such names? Of course, you're looking at the leaders versus laggards. It's a very important thing. Of course, in a new market uptrend, leaders are called leaders for the reason, right? Leaders lead. So very often, if you will be dealing with the names which are breaking out later, when those leaders are extended and they're going through those natural reactions or second bases, and suddenly you have names which are setting up only that first base, just be careful on the lookout whether the name may be laggard, what kind of group it is. It might be maybe some, I don't know, insurance name, things like that, some slow movers with lower relative strength compared to the other names. So be mindful of that. Identify the market conditions. As you pointed out, Richard, the good environment versus bad environment. It also important thing is to mention, market environment doesn't necessarily mean just Qs or SPYs going up. It really means, are the breakouts on your watch list following through? Is your whole portfolio? Is your equity curve moving up, or are you getting yourself the feedback that you're getting the volatility around buy points, you're getting the failed breakouts? Are you seeing some whipsaws in sectors? For example, you set up a watch list and you see, I don't know, 20 semiconductor names, and you look at it at 2 names, and suddenly you have a biotech setting up. So be mindful of that. And as we already discussed before, several factors to consider: trend, group sector behavior, the market caps. Are you dealing with some tiny caps? There is like a large or a mega cap like Tesla, Google, and so on. Also look at the fundamentals. For myself, the fundamentals, they don't necessarily mean too much when I'm entering the name, but they are very important for me how I'm gonna deal with the name later on. If the names are there, if I see very promising fundamentals, if I see fund ownership increasing, that for me it means a conviction to hold the name longer. It doesn't necessarily mean I'm not gonna buy a name if the fundamentals are not there, but I'll be probably much quicker to scale out of it. And of course, the redeployment strategy, the mental capital, and adding back to the name. So even if you get out of the name, still watch the name very closely, how it's acting, what it's doing, and if you have a chance, you might be thinking really about trying to get back on, especially if it's a true market leader and it's not too far in the cycle. If it's getting a little bit too far, if you're getting into base 3, 4, 5, and you're seeing some very volatile bases, then also be very mindful of how you're going to approach the trade. You probably then going into a scenario which is where you want to be probably even quicker and taking profits. You're probably not going to be getting so much upside anymore if you've been into uptrend for multiple years and you went through several bases without any larger correction. And to conclude the presentation, I didn't want to forget about my audience and some people that reached out with certain Q&As, which I didn't find any space where to put them into a presentation. So I just wanted to touch on those topics because I think it was very interesting questions that people ask. So I think there's a good chance to really go through them. So there was a couple of questions asking about holding through. How do you manage holding through pullbacks, or when do you decide to hold versus take profits? So you probably know by now, and if watching this presentation, that you have to expect some natural reactions. There are healthy price action, and if you know what kind of a name and the character of the name you're dealing with, that kind of improves your conviction and your kind of knowledge what to do with it. And of course, at the end, it all comes down to numbers. So you really know your long-term or longer-term numbers, your average gain, average loss, batting average, and try to improve it over time. One interesting question was, what do you do during the ape season? I suppose that means when a lot of very speculative names are flying up, GameStop and so on, and you're really getting the FOMO of chasing everything. So, defaulting back to your mathematical framework, really, I think that helps those kind of have that long-term convictions where you're gonna be in few years if you really stick to your principles and your scenarios. And if there's kind of discover that one of those names is not really moving the needle anywhere from the long-term perspective. It's only thing that it's doing probably, if you're really trying to FOMO into a trade, that it's putting the higher odds of the wipeout and the unnecessary gains, where I think one bad trade can really destroy the months of losses, months of gains that you worked on. So be mindful of that. A lot of questions about mindset and how you keep calm and what do you do. Some recommendations if you are a 5-year-old. So again, having this kind of a set of rules and knowing the numbers takes a little bit away those emotions and that emotional trading. So be aware of that, and know your action plan, know your game plan before every day. If you want, you can draw up, I don't know, if you want, like a 5-year-old, you can draw up some characters with it and saying, this is what I'll be doing and buying, or you can just highlight it with the markers or put it into some spreadsheet, but really do not try to call audibles during the day. Have very rigid rules. And if you cannot really sleep during the night, that you think about your positions, that probably you're trading probably a little bit too large. So also be mindful of the position size and what's your, not necessarily the risk, but also what's your kind of a mental capital, what kind of size are you able to take on. And trust the process, never dictate the money to rule your trading, always focus on the price action and what you're doing from the process perspective. I think taking away that focus and focusing on the money, and especially the short term and trying to get rich scheme, is a disaster to hell. As also I personally experienced during the USIC when I really was really reshifted that focus on those major gains, and kind of it was a disaster and way to hell. And the last thing about a question about specifics of playing the IPOs and high tide flags, I mean magnitude versus duration moves. So naturally for those high tide flags, you want to be accounting for a little bit higher risk reward ratio. So instead of depending again on your style, instead of taking, for example, first scales for 1, 1.5, 2R, you might be thinking more about trying to hold at least for 3 to 4R for our ratios, and also mindful of the risk. Of course, if you have a sharp move up very quickly, you don't want to give back all the gains, but you have to find kind of this sweet spot how to play with it. And with the high tide flags, you can really expect very powerful moves very quickly. And IPOs, there I would say don't be afraid to hold through those natural reactions that we discussed. With the IPOs, you can be looking for a magnitude move of multiple months or even a year if you get lucky. Again, depending on your style, then you have to figure out how you're gonna be handling the name. If you're gonna be, for example, reducing a little bit and then riding, for example, even maybe 50-day moving average, if you want to be holding a little bit long term. So be mindful that the IPOs might not give you second base for some time, so you can be a little bit more patient with that. And with that, we reach the end. If you want to know a little bit more what I'm doing, feel free to look at my website, which I deployed a few months back, and I'm trying to put there almost all the trades, what I'm doing, and I approach it as a interactive model book rather than any platform. So I want to have, instead of having printed out charts and having it in a book, having it kind of a software for it that you can browse through. And of course, when I'm doing it, then of course, why not for other people to see it? So you feel free to visit and click the donate button if you want. And of course, if you want to join some community of like-minded traders, feel free to join us with Leif or the Champion Team Trading. We'll be very, very happy to have you on board and share your ideas, and really you can get a little more in-depth into the style, into how to do it and what to do, and to really have a mentors alongside to help you with that.
Yeah, excellent. Leoš, thank you so much for running through that. I've definitely got a few questions to go through. And first, I just want to add, could you go back one slide real quick? Just holding through pullbacks, you mentioned the pullback drawdown that you had last year. I think we did the interview previously this year where you talked through that, how you dealt with the mindset, dealing with that, the lessons learned. Definitely recommend watching that interview. You should be able to find it on the YouTube channel for everybody who hasn't seen it. But I think that was an excellent discussion and something every trader goes through. So I think that was really good. Going back to the start real quick, just from a high level, I'd be interested to hear first of all, I think this doesn't get talked about enough, position management. I think everybody loves to talk about the perfect buy points, and that's the fun part, is analyzing charts, finding the pivots, all that. Position management is so important. Managing winners and treating them properly is what allows us to have a positive expectancy at the end of the day. How is your process for this, the one you presented today, how has that evolved over time, and what have been some key lessons along that way that made you implement, selling a bit, at 2R, and then holding the rest, moving your stop to break even? Were there any key turning points that you can look back at your trading career and say, all right, this taught me that, I need to do this, and that's how this kind of evolution has happened?
Yeah, absolutely. I think the biggest key lessons were when you get burned, right? So when you over time that you figure out that it's really no point of trying to press the gas very quickly if you don't have the guaranteed profits. So kind of I don't know if I came across that somewhere or how I actually came up with that, but kind of I keeping for myself, trying to keep these percentages and really having a visually display that whether I'm playing with the house money or whether I'm playing with my own money.
Right.
And next to that is having an idea, or really having it also somewhere displayed, what's your total expected drawdown, like your worst case scenario. So if you get stopped out nowadays from all the position, what's gonna be the damage?
Right.
And of course, over time you wanna combine it and minimize it. So this is with the position management is the same thing, like that we talked about moving those stops. So let's say hypothetically would start with the allowable drawdown of 5% of your equity. Then this kind of over time you realize that if you start improving your worst case scenario, suddenly you're dealing maybe, okay, my expected drawdown now is 3% because I reduced a little bit. And of course, you have to expect there will be choppy markets. Like it happens to each of us that you will start ramping up and suddenly you get knocked out and stop out everything and you have to start over. But that's also one thing that not that many people realize. They think, okay, I always have to start slow and start building out slow and never stop pressing the gas. But that's a natural thing in trading, that you stop pressing the gas and immediately when you stop pressing it, then you get stopped and you have to start all over again. So that's where this terms progressive exposure, I guess, comes, that you're somehow progressing and trying to push the gas a little bit more harder, and eventually it might happen that you have to step on a brake, that you hit some obstacle.
Yeah. And then of course, you went through the different factors. I think it was the slide prior about that you consider with your position management. And you mentioned earlier as well, from a first stage base, you take less off, you're a little bit slower maybe to take off that first piece. Does that same kind of apply to where we are in the market cycle? Like directly after a significant correction, are you trying to let trades work a little bit longer before taking that first bit off? Or because of progressive exposure, you just want to make sure you get as good expectancy you can, so it doesn't really change where we are in the market cycle, your process for taking partials? I don't know if I asked that perfectly, but I think you know what I'm trying to say.
Yeah. It's, of course, the market cycle is very important. It's one of those things that comes with this, avoid the temptation during the late cycle.
Mm-hmm.
So, like if you're entering the correction and you went through some let's say very bad market, let's say not recently we had a 20% market correction, then you start identifying those leaders that you look at those various factors, like maybe they held 200-day moving average, or they were the first one to recover. So if you kind of get this feeling that you're probably on a true market leader, then I think it applies even more, that you want to probably reduce even less, or not even reduce, maybe really try to hold a little bit longer, because otherwise you might be really trying to getting yourself out of the one leader. I have the example this year which I kicked out myself. It was a decent gain, which last piece I sold for 50%, but nowadays the name is 150% up. So
That's how it goes.
So just be mindful of that.
Yep, no problem.
But as I said, everybody always remembers those names that went to infinity without you. But then if the name corrects and it goes 50% down without you, you will forget very, very easily.
Yeah, exactly. And then throughout the different examples you went through today, you mentioned changes in character a few times, like the stock had been respecting the 10 EMA and then broke it for the first time. Are there any other aspects of that concept of changing character that you think would be nice to share with people? And then also, how do you treat a stock that has a changing character differently versus one that's just been trending very calmly, evenly? Will you be less likely to add back on the next consolidation? Are you quicker to sell into strength if you feel like it's later in the trend, it's gotten whippier, changing its character that way? I think that'd be a cool concept to expand a little bit on.
Yeah, that's a very good point. The change of character, of course, we touched on changing character in terms of respecting moving averages. But as you're pointing out, there are many other multiple factors that you can be looking at. One of those are, for example, as we have here, the extensions. Mm-hmm. If you're having some extension climatic moves that you're starting to get multiple gap ups, like for example, as you can see clearly in this example here, we have a 1, 2nd, 3rd gap up. Probably the volume is not even running that much higher. That can provide you another context that something's changed, especially if you start looking also the average, the volatility it's trading on, and it starts trading very volatile. Then you might be thinking, okay, something's going on. For me, the volume clues are very important. If you see the names like it's highlighted here, you have low volume pullback, and suddenly you have a follow through and high volume, and suddenly you start getting maybe extensions into some even declining volume or flat volume. Then it's another change of character that you can be trying to look at. A little bit hidden thing is churning. Mm-hmm. It's kind of a tricky part. It's when you're starting to get a lot of fighting between bulls and bears. So it means you're getting a lot of volume, but especially if you see it somewhere at some extended highs that you see the price is not really moving, but you have a lot of volume, then it's probably a sign that there is an intense fight between bulls and bears, and you might be on the lookout for the reversal. And of course, then there are other things, like if you have the negative changes in character, like if you have a significant drawdown or highest volume ever, or similar things, or if it breaks some key support areas and high volumes, then you might be on the lookout to run for the hills.
Yeah, for more of a correction. Exactly. And then, of course, I've asked you this in previous interviews, but for folks who haven't seen that, and I know that it's not the focus of today's presentation, but it might be good context. What's your typical position sizing for these trades, and does it differ in a very fast mover, a high type flag magnitude type move versus one that you're looking for more of a longer term trend?
Yeah. So my typical size is, or the ideal size that I want to get to is 25% of my equity. So it would mean if I'm 100% invested, then it would mean for positions of 25%. But again, it comes down with the market cycle. So if I would be starting very low in a base, that as you saw, for example, with that Palantir, then I will be starting maybe with the quarter positions, meaning, for example, 6 to 8% of equity, then increasing a little bit higher or potentially scaling into that full position. And then it depends on with the high tide flags, for example, it depends on the risk. You want to adjust the size based on the total risk. So if my average stop is maybe 3 to 5% to start with, if I see on a high tide flag it will be a little bit more volatile and I'm dealing maybe with the 9%, then I'm naturally gonna deal with that risk by decreasing the size. Instead of full position, I'd be taking maybe half position and things like that.
Yep.
And other thing is of course the liquidity. If you go to smaller caps and so on, then also you want to be a little bit on the lookout on the size. You don't want to get caught too heavy in case of some major gap downs and things like that.
Yeah, excellent. And then I don't think I've actually asked you this before, but given your sports background and sports can teach us a lot about learning to lose, learning to fail, and having to come back and dealing with that. Are there any key lessons that you take from sports that you think have really helped you when it comes to trading? Beyond just the competitive nature of both this being a game, a very very important game, but yeah,
Yeah, I think for me also because since both in football I played defense and in hockey I'm a goalie, so I was always the kind of a last line in defense. So I definitely learned that the responsibility if I screw up, there's really nobody behind me to repair the action. So really be responsible for and be mindful of your own faults and what your mistakes can cause.
Yep. No, I was the same way actually. I
Uh,
always played defense, so the strikers up there in soccer can mess up and be flashy, but you have to be stick to a process and yeah, you're the last
exactly
line.
because there's nobody else behind you to save it anymore,
Yep.
right? So
Exactly. Awesome. Leoš, this has been fantastic. Any closing words, summarizing, the key takeaways that you want people to have from this presentation?
uh, as always, I think the trading is the game of perseverance. So really stick with your process and trust the process and go back to your trades. If you don't have the stats now figured out or you don't know really what your average trading looks like, then really do your post analysis and try to kind of frame your style. You can always start with the foundations and inspirations and other master traders that I like myself that I found and try. You can start from that and kind of tweak it and find your own style, what fits you the most. And as always, never give up, really continue on grinding, study the charts, study how they behave, go through the manual, look at what's happening during the natural price cycle, and it will definitely help you because you will form that kind of almost a photographic memory in your mind, and you will know what to expect in the next market cycle.
Excellent. And actually, I just remembered one last question I want to ask you. In a market more like 2021, where it's more pop and drop, the breakouts didn't really have the follow through that you talked about really looking for. Do you adjust this process at all? Selling a perverse partial a little bit earlier, moving your stop up to break in a little bit earlier. How does that kind of impact things?
Yeah, it's. I think that also the clearest example is, of course, 2021, but a lot of people, for example, have in vivid memory this year when we started in not a very good note, and what I could see in January, still the breakouts were kind of working, even though there are some Black Swan events. But so until I was trading a little bit like the same, but further on, as the things stopped to work, I started trading a little bit quicker.
Mm-hmm.
So as I see, for example, what you will see, because it doesn't happen very often that we would just fall apart and really, have a major correction right from day one. So you will start seeing first a lot of volatility around buy points, things not working very well. So what I saw in around March time that I started doing much more trading, but much quicker trading, and it was still kind of working. But then eventually, when even that stopped working, then you really have to step on the brakes and take a little pause and reevaluate if really this is the right time to press in the market. And if not, just really wait, be patient for that prime conditions. They're gonna come back.
Excellent.
It's frustrating, but they're gonna appear.
Yeah, great. Well, Leoš, thank you again for your time for walking us through your process. Thank you everybody to you're watching. I hope you guys enjoyed it. If you did, go ahead and leave a like on the below. And we'll be right back with the next presenter. Stay tuned. Cheers.
Yeah, thanks a lot.
Thanks, Leoš. All right, welcome back, everybody. The next guest of the TraderLion Conference is Lawrence Bensdorp, who is an extremely experienced systematic trader and multiple-time best-selling author. Lawrence was also featured in Dr. Van Tharp's Trading Beyond the Matrix. Today, he will be presenting on how he designs and combines trading systems that work well both in trending and high volatility environments. Lawrence, thank you so much for being here. Welcome. I've been really looking forward to this one, so great to have you.
Likewise, pleasure to be here.
Yeah, awesome. Perfect. So I think it's always super cool to hear about traders of different processes, different systems, and I think what you'll be talking about today is obviously different than discretionary trading, growth stock trading that a lot of our audience does, but I think is extremely applicable as well. And I'm really looking forward to asking you about position sizing, risk management, sell rules, all of that. I know you've got a lot prepared, so yeah, excited for this. Let's dive in.
Alrighty, excellent. So welcome everybody, and thank you for attending. In this presentation, I would like to talk about the magic of combining non-correlated systems where we have the possibility to trade on full autopilot, a combination of systems that are designed to make money in bull and bear markets. So you're basically going to get from me two different systems with all rules reviewed, completely quantified. And the question is that the Holy Grail? I think it comes always close to what is the Holy Grail. There's never a complete Holy Grail, but this comes pretty close to it because I've been doing it for a long time myself as well. So one disclaimer, so it shouldn't be assumed that these methods and everything that I show in here will be profitable or losses. Everything is based on past performance and simulated performance. So what is it that you will learn? So we're going to start a little bit with what is systematic trading and how does it work and how do I do it? So then I'm going to teach to you one trading system with historical simulated returns of 21% compounded annual growth rate since 2003. And in comparison, the benchmark, the S&P 500, did about 8% or so. I'm also going to show you one system that is designed to make money in bear markets. And this is important because this helps to offset the losses of system number one. And you will get all the rules of both systems. There's nothing left out. So make sure that you attend all the way to the end. Then I'll teach you the magic of combining multiple non-correlated systems and trading them simultaneously. And that means when we combine system 1 and system 2, with that we increase the compounded annual growth rate, we lower the drawdown. So that means that we have a higher risk-adjusted return, and at the same time we lower the volatility of the equity curve. And then the last part, which is incredibly important, I'm going to talk about the pitfalls of system development, how to have an indication of what your future return could be, and what are the mistakes most people make and thoughts of getting actually started with this. So the first system, I first want to show the equity curve over here. This is a trend following system on the NASDAQ 100. And what you see clearly in this equity curve is that it does very well. But you see also the lower part over here. Do you see my mouse actually, Richard, or not?
I don't at the moment.
Okay, that's okay.
Yeah.
So the lower part of the equity curve over here, you actually see the drawdowns in there, and you see that this system significantly suffered, of course, in 2008 and in 2022. Both were bear markets, and I think that's very important to be very realistic with a system. This is a long-term trend following system that is designed to do very well in bull markets, but therefore you should expect as well to not make money and to lose markets in bear markets. But that is only the start, right? Because the second system is designed to make big money in bear markets. And you see that over here in this equity curve, where you see those lovely green circles. Those are exactly the times where this short selling system made money in the bear market in 2008, in a little bit in 2011 as well. You see the up spike during the COVID crash. You see the 2022 bear market where it did very well. And then you see 2025 where it did incredibly well as well. And that was, of course, for many people, a very hard time to trade as well. So the magic then, if we combine these two systems together, is that we get to a compounded annual growth rate of 28%, simulated compounded annual growth rate that is, and the maximum drawdown dropped significantly. And what you see is that the equity curve starts to get smoother. You see how it compares against the red line, which is the S&P 500. So it has a huge outperformance, of course, against the S&P 500. And that is basically the start of combining non-correlated systems and trading them simultaneously. And I do that with a lot more systems. So a little bit about me, not too long. My name is Laurens Bensdorp. I trade since 2000. The first 6 to 7 years mainly lost money. But since 2007, I've been successful in trading systematically. I started them with 4 systems, 2 long and 2 shorts. I'm a 3 times best-selling author of systematic trading books, and you see the images over there. If you're interested in it, I'd recommend you take a look at either the middle one, Automated Stock Trading Systems, or my latest one, which is more focused on trading retirement accounts. And I trade for myself a suite of 55 non-correlated systems. And it basically means that I don't care what the market does. The market can go up, the market can go down. My systems are prepared to make sure that I have it designed in such a way that I can profit of it. And I also mentor high net worth individuals and some fund managers. So what is systematic trading and how does it work? So we make use of very simple algorithms to define when to enter, how much to enter, and when to exit. And with algorithms, it's just a very simple mathematical calculation of price action from a historical data provider. And that is nothing fancy. The word algorithm shouldn't frighten you or anything. I do not have a math degree or anything. There's no super complex stuff in there. It's just a calculation of recent price action. And it then calculates the statistical edges when it is time to enter a trade or when to exit. Then with the software that we use for that, once we have done our back test and we know what the output is, so we have a good idea of what the statistics of the systems are, when it makes money, when it loses money, and how it performs according to different market types as well. So you suddenly have like 20 or 25 years of simulated performance that gives you a very good idea what your system actually does. And that gives a huge amount of confidence when you actually trade. So then the software, it basically spits out the orders. So you just click on a button and it generates the orders for the next trading day. And you can place those orders between the time the historical data has been updated. Depends a little bit on the data provider, but I would say generally after 11 p.m. Eastern time. until before the market opens the next day, 9:30 a.m. Eastern time. So you've got enough time to place those orders. And then during the whole trading day, you do not need to sit behind the screen. So this last process can be automated as well by software that connects with your broker. So it scans historical data, generates the orders, opens the broker platform, places the orders, and sends me an email. So this is what I use for myself, and this is also how I can trade up to 55 strategies on autopilot. If you trade so many strategies, there generally can be a large chance of human mistakes, human errors, and that is something that I would like to avoid. I think that with 55 strategies, I've got scenarios for all kinds of different market types that I am protecting myself for, but also leverage my strategies for, like when the gold market starts to move up, when there is a sudden volatility crash, for example. I have strategies in place that could kick in, and that's how I got to so many strategies. But of course, that's something that would be a little bit too much of a workload with possible mistakes in there. And for me, it basically comes to the point where I do not have any fear whether the market goes up and down, and I can trade this with zero stress, which is incredibly important. I've seen so many people who are trading and they're glued to the screen, but they're also stressed about what will the market do. There's coming news messages out and stuff like that. And that anxiety is something that I would not like to have.
And Lawrence, just jumping in with the question, of your 55 strategies, how did that number develop over time? I'm sure, of course, you're testing new things, new ideas, but how did the evolution go from those first 4 strategies to now taking into account more situations, more market environments, all of that?
Yes, great question. So I started in 2007 with 2 strategies, 2 long and 2 short. But then in 2011, I did very well in the beginning, especially 2007, 2008. So that helped with my confidence. But then I remember that very well. 2011, there was a big sell-off in the market in August. And my mean reversion short strategies were not in the market. So I basically was not protected at all. So at that time, I saw like, okay, I suddenly had a drawdown that was more than twice of my tested drawdown, which is something that can happen. But I saw, in my case, I saw a significant weakness as well of my strategies. I said like, okay, if there is a momentum down market, my systems, the long systems, will lose money, period. Because if everything drops like a stone, then I should not expect that my systems, that the stocks that I bought, that they would be able to make money. That's really wishful thinking. But the short selling systems, the way they were designed, were not in the market. So I needed a strategy for that specific kind of market type. And that's when I started to see like, okay, I really need to have more strategies for different kind of market types that maybe I haven't seen yet in my back test, but certainly on a conceptual basis could happen.
Right.
It was a huge, huge lesson for me, because then I started to add more strategies here. I said like, okay, also in times of big trend following parts, there are times when the mean reversion systems didn't do that well because the trends were so incredibly strong. So I was missing out. So then I started to add trend following system to it. And then it basically came to a way where I said, okay, the more systems I have, the more robust it is, the more I prepare myself for different scenarios, the more I prepare myself for unexpected market events. And that led me basically to the conclusion that I need as much strategies as possible to make sure that I do not depend on only 2 or 3 strategies, because if those 2 or 3 or 4 strategies are not working during a certain period of time, then my account is just going down, 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 down. But if I have other stuff which at that time is working, then I get a combined suite that does a lot better. So that's when things really started to evolve from my side. And that's what you see as well with the big quant funds as well, that trade multi-strategies. Many have like so many strategies trading simultaneously. So that was a huge revelation for me.
Excellent. Thank you.
So some benefits of systematic trading. So you know the statistical edge of your systems. This is very important, that you start to trade, but you at least have a good idea when it is supposed to make money. But even more important, you know when it is likely to lose money. And this with every strategy is absolutely key. If you understand statistically already that you understand when this system is likely to lose money, like a long-term trend following system is likely to lose money in bear markets or when it starts to give back money. And that is totally fine. But if you know that already, then you will stick to that strategy when it's not going your way. And that will help a lot, of course, to continue to trading it consistently. So you don't need to be glued to the screen at all, because everything is done by the computer. You don't care at all about the news. I really don't care what the news says, if there's coming a news message or something, if there's a Fed report. No, I have systems for that. Does that mean that they always profit when there comes a news message out? No, of course not. There's also time where it goes against me, but I don't need to worry about the news. So in my case, I don't care at all what the market does. I really don't care, because it's about my systems that are designed to make money when the market goes up or when the market goes down. And we've had a phenomenal bull run since 1995, basically, a couple of big bear markets, but generally there have been other time periods where the market for a longer period of time was flat or down. And I get into that later as well. So you can design this according to your risk tolerance in your personal situation. So everybody has a different risk tolerance based on their personal situation. If you're 30 years old and you have a $50,000 account, then probably a 20% drawdown is not such a big deal that if you have a $5 million account and you are 65 years old and you want to live completely off that retirement funds. Those two things means that for every individual, we need to develop something that is based on their risk tolerance, on their objective, and on their personal situation, on their skills as well. The last thing, it can run on autopilot. So during the day, you can focus on other things than you like, other things that you actually like to do. Like right now, the market is open and I'm chatting with you over here, and I have no need at all to take a look at the market. I have no desire to do so because my systems just are all in place. And that means that if I want to go out and go hiking or swim in the sea outside, it's wonderful over here, I can do that. So let's go to the system rules. Always something that is very, very interesting for people. I don't leave anything out. The first system is the trend following system on NASDAQ 100 stocks. And the objective, and this is important, with every system, we always need to start with the objective. It's always like, okay, when is this system supposed to make money? And when is it likely not to make money? The better we state our objective, the clearer we are about our objective, the easier is the actual development of the system. So in this particular system, the objective is to capture longer term trends in potentially strong moving stocks and stay with the trend until it bends. And that means that it should do incredibly well during bull markets, but should lose money in bear markets. I chose for this specific system as a trading universe the old NASDAQ 100 stocks. Those are stocks that have very strong moves. As far as position sizing, in this example, I made it fairly simple. There's a lot more and other sophisticated position sizings that we can do, but in this case I wanted to make it simple that we just trade a maximum of 10 stocks times 10% of our equity. And that means that we can never get more than 100% exposure. So if we, for example, already have 4 open positions, we only can place 6 more orders. Now, there's a lot more advanced position sizing strategies as well. It's a little bit beyond the scope for a presentation like this, but this keeps it clean and simple. We treat every stock the same. One option that you could think of, if you want to be more advanced, is that you can adjust them as well for volatility, for example. But over here, we just say, keep it very simple, 10 stocks times 10% of our equity. Liquidity, although there's enough liquidity on the NASDAQ 100 stocks, in this case, I wanted to focus on the top 20% of the average dollar volume of the NASDAQ 100 stocks. And that basically means that we get into the 20 stocks with the most volume, the big movers of the NASDAQ. So the setup. The close of the NASDAQ index is above the 200-day exponential moving average plus 2 average true range over the last 21 days. So this is basically a Keltner channel where we say the close of the index is above the 200-day plus 2 ATR. That's it. Very simple and straightforward. The next thing is we want the close of the stock above the 200-day simple moving average plus 2 standard deviations over the last 21 days. And that is a Bollinger Band. Nothing magical about these indicators. Nothing magical about the number 200. It could be 190 as well. It could be 210 as well. This was just a round number, and there's nothing special either about the look back of the average true range and the standard deviation. Just 21 days, and that's basically one trading month. That's all it does. That's it. So what does this tell us? So it tells us that the market is in a long-term uptrend. It also tells us that the stock is in a long-term uptrend. Very simple and straightforward. This is something you can do manually fairly easy even. Now, what if we get more than 10 signals? Remember that our position sizing says we are only allowed to trade up to a maximum of 10 positions. So if we will have more than 10 signals, we need to have some kind of priority score where we say we can only trade those kind of stocks. And in this case, I call that a ranking. And we select the 10 stocks with the highest rate of change over the last 200 trading days. So the highest rate of change means the highest percentile increase over the last 200 trading days. So we're measuring pure momentum over here. That is what we are measuring. So we are measuring an uptrend in the market, we're measuring an uptrend in the stock, and then we select the 10 stocks which had the most momentum over the last 200 trading days, straight and forwards. So once those previous conditions are met, we enter the next day market on open. So you see, we can scan these rules the day before, and then in the evening or before the market open, we place the order enter market on open. And we exit the next day market on open when the close of the stock is below the 200-day simple moving average minus 1 standard deviation. Again, this is a simple Bollinger Band. So what you see basically is our risk is where we enter on an uptrend of 200-day simple moving average plus 2 standard deviations, and the exit is the 200-day simple moving average minus 1 standard deviation. That is a difference. So we do give them space. They do need some time to develop in the trade. Generally, trend following systems, you do not get a high win rate, but this is the only exit. Very simple and straightforward. Especially with trend following systems, try not to make it too complex. Alrighty, so let's take a look at the performance of this system. So as you see, the orange curve is the equity curve of the system, and the red line is the performance of the S&P 500. So significant outperformance. And if we take a look at the statistics, the letters are a little bit small, but we have a compounded annual growth rate of 21%. We have a maximum drawdown of 43%. Then we have a longest drawdown of 36 months and a MAR of 0.49. But let's take a look, above all, about the two numbers, compounded annual growth rate 21% and maximum drawdown 43%. I could have easily optimized this with all kinds of other rules in there to lower that drawdown to, let's say, in the 30% or something. But if you get a system that does 20% compounded annual growth rate and you're trading on stocks like the NASDAQ, you are supposed to understand that you need to give back a chunk of the money when you just made a lot of money from mid-2000s till the end of 2021, for example. And that is what always happens. So if you see those drawdowns in there, for a trend following system, this is very, very normal. Try not to add all kinds of rules to it to make it better. That's the first inclination that many people want to do. Try to make it better. But this system shows exactly that it's doing what it is supposed to be doing. The average win to loss ratio is 4.3. So the average winning trade is 4.3 times larger than the average losing trade. That's exactly a typical trend following system. So if we go and take a look over here, we really see that on a month by month and year by year basis compared to the benchmark, we see that it outperforms the broad index in bull years and it loses less in bear markets. That's pretty good. So yeah, this year it's kind of flattish. Of course, 223 and 224 were very easy years on the bull side, so we were able to make significant money over there. 2022 and 2008 bear years, that's where you see those down markets as well, and that is totally to be normal. You also see that this system has significant volatility. if you see some monthly returns in there, like minus 17%, and I see at the start in 2008, minus 22%, it would definitely be a system that for me personally, as far as volatility, would be probably too large to handle. And I think for many people, they would kind of run away when they get those big equity swings. But that is what you can expect from a system like this. But what it does do, it is according to its design in the big bull markets, like 2013, 2017, 2020 after COVID, where it lost, but then it recovered hugely. That's where it made big money. And in bull and in bear markets, it gives back money. It's a typical classical trend following system, something very, very similar to what I trade myself personally as well. And as you see, there's no magic about this. The rules are very simple and straightforward. But we see the weaknesses over here, and you see that very clear in this chart. You see where the drawdowns are, and they're every time after that big run up. A part of it is just giving back money that you accumulated, but then the market starts to go down, and it takes a while before your stocks are getting stopped out because of your trailing stop, which can be very far away then, and that's where your drawdown comes from. But that is a natural consequence of what is a typical structure of a long-term trend following strategy on equities that are fairly volatile. And you see during the COVID with a sharp drop as well, 2008, 2022, you see the sharp sell-off this year as well, starts to recover pretty okay as well. So this is typical what you can expect. Now, are you willing to have drawdowns of 40% or potentially higher? Because you could have an even stronger bear market sometimes where you could even lose more, or you get whipsawed a couple of times. Are you willing to deal with the years being underwater? So where you're basically in a drawdown and not making money? So what if we develop a second strategy that is designed to attack the weakness of strategy number one? And again, what is the weakness? 2008, 2022, COVID as well. Those are the main things. So we want a strategy that attacks those specific weaknesses and makes sure that in other periods does not lose that much. So this is where short selling strategies comes into place. So this strategy's objective is not to make money when the trend following system loses money. So system number 2, mean reversion short on Russell 2000 stocks. So we're going more to a little bit less liquid stocks, mid cap and stuff like that. To make money when the objective is to make money when system number 1 does not perform or loses a lot. And the second part is to not give back too much in other market types. So it's not about the compounded annual growth rate or the max drawdown or the MAR or the Sharp of this system. It's all about when you get that compounded annual growth rate, when you do not have that drawdown, but above all, when do you need that compounded annual growth rate? And if we're seeing the weaknesses, we need the CAGR in down markets, 2008, 2022, and the COVID crash. So let's go to the rules. Our trading universe is all Russell 2000 stocks, excluding healthcare. And let me explain to you why I exclude healthcare, and I exclude that on all my short selling strategies. Very often they actually can test even better with healthcare, but I think healthcare is first of all a kind of a sector that can be very non-correlated to the overall market, but also you sometimes can have healthcare stocks or biotech stocks that suddenly have a patent approved after the market closes. And let's say you have shorted that stock at 11 bucks and a patent get approved the day after it opens up at 25. Then it doesn't matter where your stop loss is. It doesn't matter how good your risk management is. You're just going to get punished the day after. So I want something that conceptually is a portfolio that is more designed to actually, when the market starts to move down, that those stocks are moving down as well, and eliminating a little bit that corporate risk. So the position sizing is the same as in System 1, so 10 stocks times 10% of your equity. Nothing fancy about it. You can be a lot more fancy as well if you want to. Now, with a trading universe of 2,000 stocks, we need to have more filters in place because we need to filter down that universe to get to a tradable universe that is very suitable for mean reversion systems. And mean reversion system is basically where we sell very overbought stocks short with the expectation that they will drop and then we buy them back. So we have a minimum price of $5. I don't like to sell short stocks on $1.50 and stuff like that. Too much chance that they double in value overnight. Minimum average volume, top 30% of the average volume of the last 20 days. Enough liquidity, that's what we want to have. There still is a risk sometimes that there's some stock not available for shorting. That can happen. In my personal trading, I would say about 92-93% of all stocks are shortable. The minimum historic volatility over the last 100 days is more than 50. That means that we are looking for stocks that have shown significant volatility. As a benchmark, the average historic volatility of the S&P 500 is around 20. So we're looking for significant volatile stocks over here. Then the rules, the close of IWM or the Russell 2000, the IWM is just the ETF for it, is below the 40-day exponential moving average. So at least the market shows a downturn already. Then the 14-day ADX is above 25. And thirdly, over the last 4 days, the stock has moved up at least 15%. So what is it that we look for over here? 1, the market is down. 2, the stock is moving. ADX is another sign that there is actually volatility in the stock. It doesn't measure if that is up or down, but it measures that the stock is moving. And 3, the stock is overbought. And we do that by saying over the last 4 days, the stock has moved up at least 15%. That means that it's definitely, there has been some overbought momentum in there. You could use an indicator for that, an RSI as well, or something like that. There's no magic in that. Very important as well. So with a portfolio of 2,000 stocks and with those setups, we're going to have more candidates than we are allowed to trade because our position sizing says only 10 stocks. We then give preference to the stocks with the lowest rate of change over the last 20 days. So that's interesting because we're looking actually for the stocks that over the last month have shown the lower performance. Whether that's up or down doesn't matter, but we don't want to get into the super high flyers. We want to have them overbought, so the last 4 days are at least 15% higher, but then we rank them by the 10 stocks with the lowest percentile decrease over the last 20 days. Entry order, this is important. So we place a limit order to sell short next day, for the next day only, 0.8 average true range, and we measure the average true range over the last 20 days, above the previous closing price. Now, above the previous closing price, that part is incredibly important. We want the stock to even show more strength intraday before we sell it short. This helps us, first of all, that we won't have any slippage. If we have slippage, it can be negative sometimes. And we want to make sure that we really sell it short when the stock is kind of exhausted. That is what we look for. That means that we place orders, and very often we place 10 orders and only 1 or 2 get executed, because not all stocks are moving up almost 1 average true range every day. So that is something to take into consideration as well. So after the close, we see what orders are executed, and then we place a 2 average true range stop loss above the execution price. Now, this is a wide stop loss for a short-term strategy, and this is important as well. Very often, mean reversion actually tests better without stops, but I don't want to trade without stops because I do like to have some emergency stop in there at least. But on the other hand, we need to give the stock some space. If we sell it short, 0.8 ATR above the previous close, we cannot expect that it immediately starts to drop once we sell it short. No, we're probably in the beginning going to be in losing territory with that specific position, and that is to be expected as well. But then we place an order to cover the short, so we buy it back when the price drops below the 5-day simple moving average. So that's a very short-term moving average, and when the stock starts to drop, it eventually closes below that 5-day simple moving average, and we immediately place a market order and get out. That is a very simple exit to say, okay, now it has reverted to its mean, we get out, period. And this, of course, does incredibly well during bear markets. And if there's questions about this later, I'm happy to answer those, of course. So here's the equity curve. And what we see is 2008 did incredibly well. 2020, 2022, and 2025 incredibly well. There was a time period from, let's say, 2009 to 2020, 11 years, where it didn't really make money as a whole. But neither was there a big bear market during that time. There was a little bit in 2018, and it did make some money over there, probably not enough to cover everything, but for one strategy, I think this really achieves to attack those objectives. And here you can see that versus the benchmark. So if you're not impressed against by the equity curve, and you're not impressed about the compounded annual growth rate, and let me go back to that. The compounded annual growth rate is only 5%, and the maximum drawdown is 20%. And this is where many times I see people, they kind of want to jump away from that. Oh my goodness, that strategy is not good at all. Well, its purpose is not to have a good compounded annual growth rate, or not to have a good or a low drawdown. No, its purpose, its objective is to make money when the other stuff is losing money. Take a look here how it compares to the index. Take a look at the first green circle at the 2008 bear market, where the S&P 500 showed a 56% drawdown. This strategy made money, and quite a bit. COVID, same thing. 2022, same thing. And 225, same thing as well. And that was exactly our intention. So take a look here when it makes money. 2008, 22% compounded annual growth rate versus minus 38 of the S&P 500. Take a look at during COVID. So it was flat in January, February. Then in March, it made 13% when the market dropped like a stone. Pretty nice, I would say. You see 2022, 28% up, market minus 19%. 2025, up 20%. And you also see that there are years where it's not performing. Like 2017 is a good example, minus 8%. Remember what our NASDAQ system did during that time. It did incredibly well. 2023, yeah, the S&P 500 was up 24%. This system, obviously, because we're shorting stocks, is not making money. But it's all about the design of when it is supposed to make money. That is the key. And that's why objectives are so incredibly important for every single system. So let's combine System 1 and System 2. And we will allocate 100% to each and trade them simultaneously. So you can do that only if you have a margin account and you allocate 100% to trend following long and 100% to mean reversion short. So if you would be exposed 100% on both strategies, you are exposed 100% long and 100% short, which should flatten each other out quite a bit. So it's not that you're suddenly 200% exposed. So trend following NASDAQ 100, 21%, maximum drawdown 43%, MAR 0.49. So the MAR is compounded annual growth rate divided by the maximum drawdown. Mean reversion, only a 5% CAGR, 20% max drawdown, MAR of 0.26. So I want you to take a guess. How would this combine? What would be the CAGR and the maximum drawdown if we trade simultaneously both systems? So give that a little bit of thought before I show the results. So again, trend following, designed to make money in bull markets, will lose money in bear markets, has a great compounded annual growth rate, pretty big drawdown. Mean reversion, designed to make money in bear markets and will not do well in bull markets, as we have shown. So what would you guess? CAGR and maximum drawdown if we trade them both simultaneously. Here we are. 28% compounded annual growth rate and a 31% maximum drawdown. So the compounded annual growth rate increased by 7% and the drawdown dropped by more than 10%. The MAR moved up to 0.89, Sharpe ratio 1.15, Sortino 1.72. And this is the magic of combining non-correlated systems. You see that combined, the compounded annual growth rate moves up, the maximum drawdown moves down. It would still be too high for my personal taste. That's the reason why I trade so many different systems, and people that I help with trading are also aiming to that. You also see that the drawdown duration of the NASDAQ system is 36 months. You add a system that has a very long drawdown duration, but you combine them, and the drawdown duration is only 24 months. The MAR, 0.49, you add a non-correlated system to it, you get to 0.89. Pretty sweet, I think. So the magic of combining non-correlated systems and trade them simultaneously is as close as it gets to the Holy Grail. As I said, as close as it gets. By combining two styles in two directions, with that I mean long and short and mean reversion and trend following, we were able to significantly improve the numbers. CAGR increased, maximum drawdown dropped, drawdown duration dropped, and the MAR and the Sharpe ratio increased. And of course, the volatility of the equity curve gets lower as well. So on a month by month look and year by year, we see that the yearly returns for 2008 and 2022 are a lot better now than what they were with the trend following system only. They're still negative, but not as big as what they were. But we are maintaining our compounded annual growth rate. And we see that this year, it's up now 24%. This is simulations, of course, but I trade stuff like this as well. And I'm up very nicely for this year. It's been a very comfortable year for me so far. So this is where you really see that how adding a system that by itself does not do that well, you combine it with something else and they both help each other, and that increases the risk-adjusted return. So the key is to combine multiple systems, each designed for a different market type. So we can't predict where the market will go. Nobody can. If there's anybody who has a crystal ball that works, please send me an email. I'd love to know him. But we all know that that doesn't exist, period. But at least we can prepare. So we must understand that there will always be bull markets, bear markets, sideways markets, but we do not know when these types of markets will come. So one thing we do know, they will come, but they will always come with a different structure versus the past and versus our sample size. Our sample size is the historical data periods that we test on. So the more systems we trade simultaneously, the more we are prepared for different market circumstances. Like COVID, for example, was something where a lot of funds got hammered suddenly within 2 weeks. If you had hedges in place over there, I have specific volatility hedges for that, that could do miracles. The higher the possibility compounded annual growth rate and the lower the maximum drawdown. The lower the volatility of the equity curve and the more robust it is if you trade a combination of multiple systems. The more systems, the more robust it gets, the lower the volatility gets, the higher possible compounded annual growth rate and lower maximum drawdown. Okay, so these were a lot of numbers, and system development is a very long road. I started this road myself after years and years of losing money on a discretionary basis, but still to develop systems, it is a very long road. And I want to make sure that I explain a little bit what the pitfalls are, so that you at least have an indication of what your future return will be, but understand the mistakes most people are making. So there's a couple of them, a little bit more than a couple of them. Let's go over them. We have over-optimization, and in each of one I go in a little bit more into detail. We have recency bias, that's a big one. We have thinking that the past repeats itself. We have perfectionism in development. We have position sizing, And we have focused too much on single systems and think they work forever. So let's go to the first one, over-optimization. This is looking desperately for the best combination of parameters. So if you saw my parameters and you saw that trend following system with a 200-day look back for the markets and a 200-day look back for the stock itself, how much time did you think that I put into that? I could have easily come up with fancy numbers like 186 days and for the market and 173 days for the stock itself. Then you're just looking for optimum, which looks great on paper, but what you're basically assuming is that the future will be exactly the same. So believing that these best or optimum but over-optimized simulation is a good representation of the past, and it's not. The more you over-optimize, probably the worse is the indication for the future. And it is very human that we try to make things better. I see that often. Very hard-working people, well, this looks good, but I want to make it better. I saw some flaw over there. Let's add some kind of a rule in there that makes it better. That's curve fitting, by the way. Be careful with that. Some software programs have an optimization button. And many people think, okay, let's click that button. I go out, drink a couple of beers, and come back, and I see the results, and then I select the best result. And wow, because that's what the software told me, that's the best result. Yes, but that's also an abuse of the optimization button. Because you are looking for optimum based on past data, and that never works. So the system really needs to be robust. And with robust, I mean is that there is a large variety of parameters, neighboring parameters, that are showing similar results, that you understand and that you see in every single system, times where it makes money, but also times where it loses money. If somebody presents to me a system that is long only and it shows a positive return in 2022, I'm going to decline it. I say, well, there must be something wrong with it. The market went down 20%. There's a large chance that that was just luck. So understand for each system when it's supposed to make money and when it's supposed to lose money. And embrace that part, that there are losses in it as well, because you've got enough other systems that you can put to work on those times when it is losing money. Recency bias. People often are very drawn to recent returns. It's incredible. I see that so often that you see that with investors as well. I'm a shareholder of a mutual fund in the US, Standpoint Alternative Investments. Currently has about 800 million under management, and I've got no active function in there. I'm just a shareholder in there, but I follow, of course, the assets under management in there. And what you see is that when the recent returns are very good, the assets under management increase a lot because people think, okay, we're going to hop on to the thing that does best right now, thinking that it will continue to do best. So many people think that a better recent return indicates a better future performance. It does not indicate anything. So they jump each time on the next best thing. Now guess what? Most of the times they are too late. And I see this often as well with system development. And people develop a system and they see, well, the last year it didn't do that well. Let's tweak those parameters to make sure that the last year did well as well. Because otherwise I wouldn't have the confidence. Except that there will be times where the system doesn't do well. It's part of trading. That every month it's going to do well. It's not going to be the case. And it is something that you want to be very, very careful about. If I see in a back test that the last year wasn't good, I say, okay, this could actually be something I'd like to put in production because it was on paper. I didn't even have it in live trading, but conceptually the strategy is right. So if there's nothing wrong with it, that last year, don't try to chase that every time the last 2-3 months is always a perfect return, because those people often suspend their system after a year of or half a year of negative performance, thinking that it doesn't work anymore. No, that's just a recency bias. And what you don't want to do then is have your existing system where there's nothing wrong with, tweak your parameters, so change the 200-day Keltner channel to 180-day because now it suddenly looks better, then you're just running behind the fact. Be careful for that. Thinking that the past repeats itself. Past does repeat itself, but not in the same structure. So let's say you test on data back to 2003. And let's compare this to 1929 to 1932, where the market dropped 85%. That's a huge crash, which is not in our historical data. The 1964 to 1982 time periods, big inflationary time periods, was a flat performance for about 17 years of the S&P 500. There was a drawdown of 50%, but also you lost 70% of your purchasing power because interest rates at its peak were about 17%. So that's a whole different scenario that we haven't tested on. Could certainly happen, but in a different way. The 1987 crash, not in our sample size, but we have another sample size with 2008, but it's very different. So history does not repeat itself, but it often rhymes, as Mark Twain said. And that is very true. And what is meant by that is that we will have bull markets, we will have bear markets, we will have sideways market, but the structure of those will be different. The time period of those will be different. The magnitude will be different. There will be ones with lower volatility, higher volatility, sharper sell-offs, and that's what you really need to understand about sampling, basically. Perfectionism in development. So understand that it is a simulation, is just a representation of the past, and if developed correctly and in a robust way, at best an indication of the future. Aiming for a higher Sharpe or CAGR by hugely optimizing, by tweaking parameters, by adding indicators is almost always counterproductive. So endlessly trying to tweak the system, and I did that when I started. I'm guilty of it, like almost everybody who starts with it, because you want to make the best out of it. And I remember once I had developed a system, I never traded it live, thank God, but it showed a 250% compounded annual growth rate and a 5% maximum drawdown. For one day I thought I was a genius, and then it turned out that there was a bug in the system, so that woke me up pretty much. But if it all looks too great on paper, be careful. So be careful. If it looks too great, it generally is a big red flag. Your position sizing is wrong. Wrong position sizing is such a huge thing. And there could be a whole topic about position sizing. Good friend of mine, Tom Bassa, wrote a book about it. Take a look on the internet, and highly recommend to purchase that, among all his other super interesting stuff. So in my experience, almost all starting traders, but also experienced traders, overstate their risk tolerance. They think they can handle a 40% drop or a 30% drop, where mostly after a 15 or 20%, they freak out. And I've worked with enough individuals, funds and everything, and I always see the same thing happening. So you need to be careful with your position sizing. Define your position sizing also from a risk standpoint of view first, not from a profit objective. No, it is what you can handle as far as risk. That will be the outcome of your compounded annual growth rate, period. So imagine if you have a $2 million retirement account. How would you feel if you're down to 1.2 million? Can you still live off that with the expected returns that you have? Or do you now say, well, maybe I should find some consultancy job for 10 hours per week because I lost too much? And that's mostly because risk management was just bad and it was too aggressive position sizing. And therefore I say, always remember the law of compounding. The law of compounding. When I started to trade systematically back in 2007, I had some phenomenal years in 2008 and 2009. But I had significant risk as well. But my capital wasn't that large, so I was able to deal a little bit better with that risk. But then in 2011 came the man with the hammer for me, where suddenly I got a lot larger drawdown. But at the same time, my equity started to increase as well. Right now I say, well, if I get a 15% compounded annual growth rate and I get my drawdowns below 10%, that's a pretty smooth ride, because that means that every 4.7 years I double my money. That's the law of compounding that so many people forget. The reason why Warren Buffett is one of the richest traders in the world is I think, certainly because in his earlier time he did phenomenal as a trader. Secondly, because he never spent a lot of money. But third, because he's so old. He's in his 90s, so the law of compounding is so incredibly strong. So to me, 15%, and if that keeps my drawdown below 10%, I've got a very relaxed life, and every 4.6, 4.7 years, I can double my money. It is better to aim for a lower compounded annual growth rate, but consistently trade your system, than trading too aggressively, but suspending your system at what moment? At the worst moment of pain, when you're down 30 or 40%. That's when you're going to pull the trigger. You're not going to pull the trigger when you're up 40%. No, you're going to pull the trigger when you say, I just can't handle this emotionally. So try not to get into that situation. It is incredibly important. So focus too much on single systems and think they work forever. I see that very often with many people. So the two systems that I presented over here, if you think that they work forever, or if there won't be a time where it has a larger drawdown that you saw in the backtest, you're mistaken. They will have. Markets change. That doesn't mean that the edge is gone, but the system can be temporarily on vacation, where it just doesn't work. Now, the more systems you have trading at the same time, the less impact that one system has that doesn't work. So you need to have a combination of many systems in place. And here's a little bit of a recap of that. I trade a lot of different things. Long-term trend following, short-term trend following, strong pullbacks with mean reversion, weak pullbacks, panic hedges, catastrophe hedges, and also aim for different markets. Commodities, for example, can be very interesting. So if you only have one system and the market type is not right for that system, you can be underwater for a decade. So this, if you only have one long system and we get a decade of non-performance, you'd have to be very good to stay above water that whole time. So be careful with that. And it's very easy to avoid. So we can go to some Q&A, but before that, I wanted to talk a little bit, because Richard, you mentioned as well, like, okay, it's important for people to have a little bit of an idea of how you can get started with this. And I think the first thing, and this is something that I work very closely on with many people, is define your objective. So what is it that you want to trade? What is your motivation to trade? Is it wealth preservation? Is it wealth accumulation? Is it income freedom? Is it diversification? How much are you going to trade? What styles? Some people like trend following, other people like mean reversion or swing trading, whatever. I think with every style you can make money, but if there is a certain style that you are not suited for, you don't need to trade it. People that are very impatient, they possibly would not be very suited for a long-term trend following system with an average trade duration of 250 days. Other people that do not want to watch the market that much, they might not like a system that trades 300 times a year. I have the belief for myself that I like to blend everything together because I can run it on automation. What is your risk tolerance? You need to start with that. And what are your thoughts? This is an important one. What are your thoughts versus the benchmark? And what is your benchmark? Is it the S&P 500? If you have a hardcore desire to always beat the S&P 500, which I know many people do, then you want to gear your strategies to that. The more you trade with commodities, the more you deviate from that. The more you trade on the short side, the more you have a chance that you could lower your compounded annual growth rate in a big bull market. But it also means that if you follow the S&P 500 and want to beat it, that at some point you're going to have a 30 or 40% drawdown. That's what it is. So think about that. I don't use S&P 500 as a benchmark. For me, it's a lot more important that I have a certain percentage above the reasonable inflation rate so that I maintain my purchasing power. That is for me very important. I mean, there have been decades where the S&P 500 didn't work at all. So the question is, would you still use the S&P 500 if for 15 years it had a 0% compounded annual growth rate? There have been times where people were sick and tired of stocks. If you at that time had been trading short as well, it would be a whole different story, of course. So objectives, and I can talk a lot about objectives, because the more you work on objectives, the easier the system development is. Also, you need to learn some basic principles of statistics and trading indicators. Nothing special, nothing incredibly hard, but you need to have basic understanding of it. It all needs to be based on objective, knowledge, capital, and skill to start to think of your toolbox. So you need to define a budget for that toolbox. So you can start in the cheapest possible way, very labor intensive, takes a very long time, generally requires top programming skills, build software and stuff like that. But you could do that on your own if you're young, if you do not have a lot of capital, and if you have that skill. If you are a programmer by nature, by all means, go that route. It will be a long route, but if you have that skill, go for that. you can buy some retail software and try to code yourself. It still requires a lot of time and skill to code, but you don't need to build a software. The third thing is that you buy a software and hire a programmer and let him program your ideas or ideas that you got from somewhere on the internet, a book, or from here. That's faster, but it's very tedious and the budget can increase very fast. That's the road that I took because I am not a programmer at all. I cannot code strategies. I have no intention to code strategies. So 20 years ago, I started to pay programmers and have my ideas programmed. And then you get a code back. You need to test that code. Then there is a bug in there. Then you need to send it back to the software developer or to the coder. And then he charges you to fix the bug because they all work on an hourly rate. But it is absolutely doable. I think in my case, because I went very far to having 55 strategies and over time I had more capital, I spent over $500,000 on software development. There's also a full A to Z program that I offer. I'm not really going to talk about that, but that is often or obviously something that will get you the faster to your return. You don't need any program, but there is an investment in there. So if you want to know more, and this is completely new to you, I'd recommend you read one of those two books. The Automated Stock Trading Systems was released in 2020, is really focusing on both long and short and the big principle that I explained over here, but then extended quite a bit. Trading Retirement Accounts is for long only, was received or was published in 2025, just a couple of months ago. And if you go to tradingmasteryschool.com, on the right upper side there's an opt-in form and you get a free course where I explain all the rules of the last book as well, but I also explain 5 systems for bear markets as well, and then I show you how those 5 systems are combined with the systems in my book from Trading Retirement Accounts. And then what you see is that the compounded annual growth rate goes up, but the drawdown goes well below 15%. And that is very interesting. So it's a very unique resource I get, which you can get free of charge. So I think that's pretty much it from my side. I'm sure there's some questions over here though.
Yeah, Lawrence, first of all, this was very comprehensive and really well explained. So thank you so much for walking through all of that. I've definitely got plenty of questions. To start with, could you go back maybe 2 slides, I think, here. First, I love how you talk about how defining the objective of a system is the most important part, and really thinking that through and spending time is so important. It's like writing a really good outline is going to make writing the essay that much easier, right? Because you know where to go, what to actually include versus figuring things out on the fly. So I think that's really great that you emphasize that. If you could go back maybe one more slide to the different types of systems. I want to hear a little bit more on the pullback strategies here, but first, looking at your 55 strategies, if you had to break down maybe percentage-wise where the majority fit, if that makes sense as well, or just to hear your thoughts on how you think about breaking that down, how would you say? Yeah.
So it's a little bit more extensive than
Sure.
this over here, but I tried to break it down in a simple way. Long-term trend following on stocks, 50%.
Mm-hmm.
Long mean reversion on stocks, 50%. Short mean reversion on stocks, 50%. Short trend following on stocks, 25 to 30%. Then about 10% on panic hedges, and the difference in there is that they go very fast.
Yeah.
So it's the time where your catastrophe hedges, where you say, I sell short the market when the close is below the 150-day moving average, right? Which would have done incredibly well in 2008, but not during COVID. You would have been too late to get in.
Right.
So then I have systems in place for that as well. But I also trade both long and short commodities, metals, energy, grains, stuff like that, both long and short. Bitcoin is in there as well. And then I have strategies as well for unexpected scenarios. I have a strategy in place that really hedges things when there's a sudden sell-off. I think that's the main thing that very people forget about it. When you're in the market and everything goes fine, and suddenly during the day a war breaks out or something like that. And that can have both a positive and a negative effect, by the way, on the market.
Right.
So you need to have something that breaks out either to the upside or on the downside. But to make it simple, long-term trend following stocks, long mean reversion stocks, short mean reversion stocks, short trend following stocks, catastrophe hedges, commodities long, commodities short.
Perfect. That's great. And
yeah, what
please.
is so important with commodities, for example, they don't test that well over the last period since 2003, for example. But because we don't have more data, for example, if you use ETFs, if you use futures and you take a look at historical data since 1960, if you see how the turtles did and how much money they made on commodities in the 70s and the 80s and possibly beginning of the 90s as well still, it's incredibly important to have over there. Same as Bitcoin, long and short to me, I think, because it moves a lot.
Yeah, I was going to ask if you've been doing any strategies related to cryptocurrencies, and if so, how much you've had to tweak strategies from different asset classes to apply and work well with cryptocurrencies, because they might be more inherently volatile than stocks or commodities.
So I only do Bitcoin, so I don't do altcoins and stuff like that. I only do Bitcoin, and I think I only started with Bitcoin when the institutional world really started to accept it. Meaning that I do it on the futures market and on one ETF. And I think that by now it is a little bit more of a mature market than what it was back when it made 3,000% per year. I don't use that data of Bitcoin for my testing at all. In fact, I don't use a lot of testing at all for my Bitcoin strategies. It just needs to trend up, and then I know I will be in. So I treat it fairly similar as gold or silver, or take a look how platinum moved as well suddenly, or how cocoa moved incredibly. So I treat it very much the same as those. I think it matured quite a bit right now. But if you move over to different crypto assets and altcoins and stuff like that, that's a whole different area. I decided not to go there because there's a little bit of an issue still with broker risk, counterparty risk that could be there, and I think I'm a little bit more comfortable with the futures market for that.
Excellent. And I wanted to ask, is there What has been the most recent strategy that you've added to your portfolio of strategies? What was the objective for that strategy, and what was kind of the observation you made with regards to your overall portfolio that said, okay, I need to go ahead, either tweak, find something else, develop a new strategy. I don't know if there's a recent one that might be a good example in terms of how you think about needing to create a new strategy. But if there is, that'd be fantastic.
Yeah, so a recent one, I think what I mostly have done is adding to my suite of systems. Mm-hmm. So if I have like 12 trend following systems, and maybe I added then a 13th one, which has a different look back. So if I have medium-term trend following and long-term trend following, I would look then for something with a different portfolio and a shorter-term
Gotcha.
look back, like 25 days. But to give a better and clear example, after COVID, what you basically saw is you saw two things. You saw a very sharp decline, mm-hmm. and a very sharp recovery.
Yeah.
And that is I think COVID was mainly, of course, because there was so much panic in the markets and we didn't know what was going to happen. But then also the recovery was very fast. But those fast sell-offs, I think that is something that has to do with more systematic trading as well, and therefore you suddenly see that more orders are placed at the same time, and it could be a little bit noisier sometimes. So what I said, okay, I want to make sure that I capture that. So what I said, okay, I want to capture when there is a volatility spike, so that the volatility spikes up like crazy. So that means I want to capture that when that happens. So that means an on-stop order. So which is in the market every day when the VXX ETF, so the VIX ETF, moves above a certain point, I buy on the market and then I trail it very closely. So that helps me to mm-hmm. being in when there is a sudden event. But at the same time, I said, okay, very often you have those sharp V-shape recoveries then. I said, okay, I also need to have a system that is part of the recovery, because if you have a strategy like that NASDAQ system that looks for a 200-day look back, it takes forever until the market is above that 200-day. So then I started to look like, okay, I need to have something that has a 10-day look back, where there is a trend where the close is above the 10-day exponential moving average. And that gets me in a lot earlier to participate already. Because often what you see is that during the first half of a recovery, buy and hold beats everything.
Yep. That's interesting. And how did this actually perform in real time here in 2025? Because it actually was a pretty steep drop, and then also so far has been a pretty rapid recovery. Were there any observations you made or thoughts that you might have to improve what you created?
I think the VXX system, so the volatility long strategies, did okay. Mm-hmm. They didn't do that great, but they definitely helped me. The hedges helped as well, especially the panic hedge that got me in very early when that stuff happened in April. But There was also a whipsaw, of course, when suddenly it moved up 10%. And that one was very, very hard to find something and to say, okay, yeah, this one got me, and yeah, I lost that day, I think 2% or something. But it wasn't a reason for me to change anything of the systems that I had, because I said, okay, I think there's nothing that I can add to this that would significantly help my portfolio. I think it's really a one-time event. It's like when you get a 1987 crash and you get burned by that. And do you need to develop something specifically for that? Yeah, you can have your hedges in there, but if you still lose a little bit, that's okay. But I didn't find anything that would have been worth it to continue. And then when it started to really recover, because I have more strategies that have shorter lookbacks as well as far as the trends, I started to get filled and maybe not completely outperforming at that stage the S&P 500, but I was getting more and more and more filled, obviously.
Right. Excellent. And then I also want to ask, when you're analyzing either a single system or a combination of, like what you talked about today, what kind of benchmarks are you most focused on improving? Obviously, we don't want to overfit or over-optimize anything, but it seems like MAR is a big one. Overall drawdown is a big one. What other key takeaways do you think are worth share with folks in terms of metrics that you most are watching as you're developing new systems?
It's an interesting question, and I think over time I have started to give less and less value of statistics. That doesn't mean that you don't want to use them, but I very often get the question like, okay, which one do you look the most at and why? And then the next question often is like, okay, what's the kind of benchmark? Should it be above, like should the MAR be above 1? Or how much should the MAR be for a mean reversion long system? The MAR, I think, is the easiest intuitively because everybody understands intuitively compounded annual growth rate divided by maximum drawdown. But the maximum drawdown is a one-time event. Now let's say you've got a strategy with a backtest of 40 years and that maximum drawdown happened 39 years ago. Now your strategy, the rest of its whole life, is punished by that specific statistic. So I like better the average of the 5 largest drawdowns. I think that gives a little bit of a better view of things. I do like the regressed annual rate of return instead of compounded annual growth rate. And that is fairly much the same, except for the fact that compounded annual growth rate really is very sensitive to the start date and the end date. The regressed annual rate of return is a good fit line. So it's a little bit more robust. And what I then do is I divide the RAR, or the regressed annual rate of return, by the average of the 5 largest drawdowns, which to me is a little bit more of a robust way of the MAR ratio. But I think besides that, it really depends first of all on the strategy. So trend following short has often a negative compounded annual growth rate if you test it back from 2007 or 1995. Because the market has such an upward bias. So the MAR is negative. Every number looks negative. CAGR is negative. It has a 50-60% drawdown. And in those strategies, you should look exactly when it is supposed to make money. And those are designed to really be in the market when a bear market kicks in. But the rest of the times it will lose money. And I think further on with statistics, we need to understand it is a representation of the past, at best an indication of what you will have in the future. But if you see a maximum drawdown in your backtest of 10%, you want to expect a 20% in live trading. And that's what you need to take into account for your position sizing when you go to trade live. Because if you see the structure of a drawdown, how fast it suddenly can happen, it could happen again in a different kind of a structure, but before it recovers to a new high. and then you're suddenly in a larger drawdown. So to me, I look less and less on magic numbers and statistics, but I do help everybody with that because it is for some systems important, and that's how we kind of measure if we're doing the right thing to combining the systems, because there it should show up. But you shouldn't optimize for those numbers, but it's more about the objective, and then asking yourself the question, does it make money where I designed it to make money?
Right.
And does it lose money where I expect it to make money? I think those two questions are so incredibly important and much more apply to real life trading than any kind of statistic.
Yeah, and I liked your point earlier that you made. If it looks too good to be true, you probably made a mistake somewhere. Either
Absolutely.
Your look back period is using future data or something like that. So that's excellent. This is a little bit related. So when you were talking about the short-term mean reversion system, obviously you did have some more specific numbers. 0.8 ATR would be your buy point, all of that. More on a general question, what are some ways that you like to investigate improving buy-sell rules while still staying robust and making sure you're not overfitting to very specific situations? So what are ways that you'd like to tweak those to set something up that will work, well into the future, but also, have something that is specific enough to work, but not too specific that we're overfitting and getting that too good to be true equity curve based on previous data that probably won't work as well going into the future? If there's anything that you found in your studies or investigations about how to tweak those different values, what indicators to use, all of that'd be great.
Again, it starts with the objective, like what kind of price measurement do you want, or what kind of price movement do you want to measure? If I want to measure a trend, then I can use a moving average, and if I want a volatility component in there, I use a Keltner channel or a Bollinger Band, for example. But what I think is more important with that is the sensitivity of those indicators. When a 200-day look back gives a certain return, then 180 days, 190 days, 210 days, 220 days should look equally well. And then I want to make sure that I do all those different tests. So I generally run then 175, 180, 185, all the way to 230. And I want to make sure that I do not cherry pick the best number, but that I pick a number that is right in the middle, so that I've got a lot of neighboring numbers that show similar returns. If that happens to be the best number, okay, that's great. But if I see, for example, 200-day looks good, but 210-day has, instead of a 21% compounded annual growth rate, only a 14%, then I get very nervous because, okay, that means that I probably filtered in some very big winners, which with a very similar parameter, I apparently do not get. And then I probably would go back to the drawing table again and say, okay, this doesn't look robust to me. And that part is incredibly important, to be very, very critical to yourself on the parameters that you have. What I always say is, I need to be able to defend my system in front of a group of 1,000 very smart but very annoying people, where I'm going to explain all the rules of my strategies, and I'm going to expect a lot of annoying but smart questions. If I think that I have the confidence to answer all of them, so okay, bring it on. That's probably a good sign. But if I'm honest to myself and I say, well, they're probably going to crush me with their criticism and everything. That probably means that some part in my brain didn't want to ignore that part, which would have been an alarm sign.
Yep. Great. No, that's super helpful. Thank you. Just one last question here. Could you dive a little bit deeper here onto the strong pullbacks and weak pullbacks systems? Maybe give a general description of the general objectives for those, and maybe a short example if you've got one off the top of your head for each of those different styles.
Yeah, I mean, there are markets where strong pullbacks work incredibly well. So a strong pullback is, let's say it this way, okay, the close of the stock is above the 150-day moving average, and the 2-day RSI is below 5. Mm-hmm. That is a significant strong pullback. And then we buy lower the next day, 6% below the close. There should be some more components in there, but that is a very strong pullback. Now that works very well when there's significant volatility and when it then reverts to its mean. But if you are in a roaring bull market with not that much volatility, none of those setups, you probably don't get a lot of setups, because it pulls back a little bit and then moves up. But it doesn't pull back enough.
Right.
So a strategy like that could create a 0% compounded annual growth rate in 2023 and 2024. Although you're trading long, but you're missing everything, so you don't get or barely get any good trades. And the trades that you get might be crappy stocks. That's where weak pullbacks come in, where you say, okay, the close of the stock is above the 150-day moving average. The last 2 days were down days. Or the 2-day RSI is below 50,
30, 40.
For example.
Yeah.
40,
Mm-hmm.
exactly.
Mm-hmm.
That would be conceptually a very different strategy because you now have a larger chance to actually get into a stock that just had a weak pullback in a bull market, and those generally tend to do better in big bull markets. But when you get a COVID scenario, yeah, you get filled a lot earlier, and then it goes down, 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 and you see then that those strategies will do worse in bear markets, for example.
Yeah, excellent. No,
so that's how I split them up.
Yeah, that's well explained. Thank you very much. Lawrence, this has been fantastic. I've really enjoyed this. Any last bits of advice for traders out there, either about learning systematic trading, getting started with that, or just trading in general? Any last words of wisdom that you might want to share with everybody in the audience?
I think the most important part is, and I cannot emphasize this enough, is you need to trade something that you feel good about, that you have confidence about it. I do think it is incredibly important that you do have some simulation so that you know actually what you are trading, that it actually has an edge, because I know many people that trade, but they really don't know if they have an edge. But the last thing that is the most important part is risk management. And I know many other traders have hopefully told you that as well. Focus on what you can handle as far as daily P&L in your account. Focus on what you can handle as far as a drawdown. And don't think that because you see on paper something that has a potential of making 100% per year, that you will be able to handle a 40% drawdown, because your whole mental state completely changes the moment you are in that drawdown. So think long term about your strategies, although those strategies can be short term, but think long term about consistent execution in a position sizing that is within your risk tolerance, so that you will never suspend that system based on an emotional decision and not on a rational decision. That's the key thing that I think applies for everybody who trades.
Excellent. I think that's the perfect place to leave it. So Lawrence, thank you so much again for being a part of this. I really enjoyed it. Definitely everybody watching, leave a like if you enjoyed. Check out the resources that Lawrence mentioned. They'll be down below in the description, and we'll be right back with the next presentation. Take care. All right, welcome back, everybody. For the next presentation of the TraderLion Conference, it is my honor to introduce Denise Shull, Bill Long, and John Burns of the Rethink Group. The Rethink Group works with hedge fund managers, Olympians, and many other clients in high-stakes arenas to help improve their decision-making and performance. Today, we'll be doing a fireside chat-style session covering the neuroscience behind trading decisions and key methods and tactics that they use to help improve their clients' results. First of all, Denise, Bill, John, a real pleasure to have you all here. Thank you so much for taking the time.
Pleasure to be here.
Thank you.
Yeah, awesome.
Thanks for having us.
Yeah, of course. My pleasure. My pleasure. To start things off, I'd love to start with you, Denise, actually. And, if you could give the latest view from neuroscience about making a trading decision, why that might be relevant to traders watching this, I think that'd be a great place to kick things off.
The core of what we decide is based on what we perceive. And what we perceive is based on everything we've experienced. And so we're constantly taking everything we've experienced, studied, learned, experienced, whatever, anything that's happened in the past, and making a prediction about the thing we're looking at. Is it good or bad for me? And once you really start to integrate that, you're able to look at any decision, but particularly a trading decision in what's really a more effective way, because it's like you're dealing with gravity, you know, and it's like you have this gravity and you can't get around it. Well, you really can't get around this prediction. Is this good or bad for me? So like I will see people, you know, say, don't make a prediction. Well, you can't not make a prediction. I mean, your brain is a prediction machine. And when you learn to realize that you're always predicting, like, is this good or bad for me? You can start to understand decisions you make or decisions you're about to make in a different way. It's called in neuroscience anticipatory affect, meaning you are anticipating an affective or feeling emotional state. But basically it's like, is this good or bad for me? Or like likely to work out good or bad for me.
And that's any time that you're analyzing a daily bar, or what you might think might happen tomorrow, or deciding, should I buy this setup or not? There's always a prediction happening right there that impacts how we're feeling, all of that going on. Is that right?
Yeah. I mean, you know, we're talking about looking at a chart, but like I tell my new clients, think about it when you go to a restaurant and you're thinking about what to order. You're like right underneath consciousness. You're thinking, will this taste good or not? You know, will I be too full? Does it have too many calories? Like you're thinking all these things about the implications of what you order. Now, we're never conscious of that. We're just thinking, oh, I want the burger, you know, like, but why do you want the burger? Like right there is this list of things of what that burger is going to mean to you. So you can practice, like in simple situations, becoming aware, because that prediction will influence what you do every time.
And I want to add one thing, if I could, because I just thought of this example while Denise was talking. She mentioned our experience, and often she will go into this deeper. We'll probably get into this more later in this session. But you know, imagine that you see the sky turning dark. The point I'm about to make is that our experience is based on our thoughts, but also on our emotions. And so you see the sky turning dark. You're in a small town in Kansas. You see the sky turning dark. You know, okay, you know, cognitively, you know the sky is dark and not blue. And so what does your experience tell you about when the sky turns dark? Well, there could be a tornado coming. But if you've actually been caught in a tornado, if your experience includes being in a tornado, then you also have an emotional reaction, an emotional reaction to the experience that you've had in the past and what you're experiencing now, and that is going to affect but your decision about, do I go to the hurricane bunker or to the tornado bunker? You know, so that's one aspect that we look at a lot. Not only the cognitive side, which is very relevant, obviously, to trading, but also to the emotional side.
Yeah, I know. I think Denise, it's you who maybe said that using emotions as data and having that awareness can help us with our trading decisions and all decisions. Of course, I know you said that before. For people who maybe aren't familiar, because we're taught to be robotic, to just push everything to the side. And John, I'd love to hear your take on this. But first, Denise, do you mind explaining kind of what using emotions as data kind of means and how traders should internalize that?
So I'm going to give a little bit of history, given what you just said. In 2003, a journal wanted to publish my master's thesis, and I was like, you guys are going to look stupid. It's like 10 years old. And so I went back to the research, and I've been trading and running trading desks and following the take the emotion out of it, be logical. And what the research was showing, though, is people who are brain damaged in a way that they don't have emotion could not make even the simplest decisions. So literally, if you could take the emotion out of it, like everyone says, you'd never take a trade. Like, what you don't realize is that embedded in your decision is the confidence, which is the prediction, that this is likely to work out. And that is an emotion, that experience of confidence that you gain through learning and trial and error.
Right.
or the lack thereof. So then you don't take the trade because you don't have that feeling of confidence. People haven't thought about that as information, but the brain is using what we experience as emotion as information. And so from way back then in 2003, I was like, well, if literally that's the way the brain works, then we should probably learn to work with that. To me, to this day, it sort of seems like, you stand at the beach, the earth looks flat. It looks like you'll sail off the edge if you sail out there, but we know that you won't. So you think your brain is flat, i.e. it's cognitive, analytical, when in reality it's round, and the feelings and emotions embedded in perception is actually what's driving both your perception and your decision making. And so to just carry that analogy one step further, like if you learn how to work with that, you can sail around the world of your brain, if you will, and like open up this whole world of possibilities, literally, as opposed to sailing off the edge, trying to be just in your head. I'm just a messenger. I wasn't expecting to find that. There's a scientist named Antonio Damasio who wrote a number of books, none of which are going to pop in my head right at the moment. And he showed people who were brain damaged such they had no emotion. They couldn't decide what shirt to wear. They couldn't decide what day to make an appointment. If you think about it, it's because they had no sense of what's an appropriate shirt, or does Tuesday work better than Wednesday, or do I like the Reese's cups better than the M&Ms? They couldn't make the simplest decisions. It's just a misunderstanding. We see people get very emotional and then do things that act out those emotions. So it looks like the emotion is the problem, when it's actually the doing the thing that exemplifies the emotion. It's the action, the behavior, the choices that illustrate the emotion, not the emotion itself. It's got all kinds of data in it. Some about the trade and some about everything else. And oftentimes about everything else. About your P&L, about if you're going to be right, I have a guy who runs a hedge fund in Asia. He's going to call me shortly. He and I had this conversation last week. Is that emotion about the market, or is it about anything else? And you need to learn to say these experiences I have are information, and sort and categorize so you can find the ones that are telling you something about the market.
I've got a good follow-up, but John, first, is there anything you want to add on that stream of thought?
First, Descartes' Error is one of Damasio's books, I believe. Secondly, Mark Solms, kind of the founder of neuropsychoanalysis, makes the case that kind of emotions are the seat of consciousness. Now, whether you agree with that or not, the point is that emotions are there, like Denise said. We can't make a decision without an emotion. And so that emotion is there to help us. It's to come, to give us information and go away. It's supposed to flow through us like the breeze. When we kind of recognize an emotion, take the information, it just gives us the information and goes. But when we try to change the emotion, fight the emotion, whether it's in trading or anything else, it usually intensifies and sticks around. That energy kind of gets stuck. I kind of like the image of trying to hold a ball or a balloon underwater, right? You can do it for a while, but eventually it pops up, and it pops up in a different spot than you pushed it down. So my point in that is the better we can get in understanding what our emotions are by putting words on them generally and externalizing them, the better we can have that feeling, the emotion, and the action, and start to understand, okay, when this combination happens, I act out this way. And by understanding that emotion precedes the action, we're over time able to then take control and have that action be conscious rather than automatic. And so it's kind of how I think about it a little bit. Yeah.
Yeah. And that's actually kind of what I was thinking as my follow-up is, obviously very important to be aware of our emotions. And then awareness is the first step. Then how do we build over time that awareness and the ability to probably this is the wrong way to phrase it, but put a wall in between the emotion and the action that has negative consequences for the negative emotions or negative outcomes that come with certain emotions. And then also lean into when we're experiencing the emotions that come with the successful trades, the trades that we do well. How do we recognize that state and then lean into that and, be more aggressive, act more for the good outcomes. So I'm not phrasing this well at all because I'm not as eloquent as you guys, but what's the next step after the awareness? What exercises or methods do you guys use with clients to help get to that next best outcome? That's a big question, I know.
It is a process. It is a step.
Yeah.
And I often, Denise and John have heard me refer to this a lot, but there is a poem, I can't remember the author, but it's called Autobiography in 5 Verses. And it talks about walking down the street, falling into a pothole and not taking responsibility, getting out. And finally, the last verse is, I walk down a different street. But, so the different stages of awareness. It's not like, most people don't have these big aha moments, these epiphanies where, okay, I'm never ever going to do that again. That seldom happens. So it is the process of being aware over time, experience, and frankly, that's where the coaching process can help with that. To understand those things, where they come from, and putting them into words, putting those experiences and what's going on now, what's happened in the past, those experiences into words, and it can help with the awareness and the understanding, and ultimately with the behavior change.
Yeah, I mean, awareness, sometimes I liken it to learning to play golf. So like there's a lot of, tiny little things that make a difference, whether that club hits the ball the right way. And so developing awareness is really developing a skill. And it can take quite a bit of time. I mean, sometimes people will be introduced to something about themselves and they'll just get it right away. I mean, that does happen. And we do tell people, like, try to put it's not just what we would call emotion. It's anything you experience physically, like a small sense of, a minor feeling or a very like engulfing, overwhelming feeling. But try to just like, what is this? And what is it really about? Like, that's 2 additional questions that help people develop that, game of golf of emotional awareness, if you will. A couple things. If you get it right, no matter how agitating the feeling was, it tends to like lose its intensity. You feel less compelled, like when you get it right, even if what you get right is very unpleasant, but there's something that your psyche does when you have the accurate understanding at which you feel like you can handle it more than, when you go round and round and round about something, it probably means that your understanding of the emotion you have isn't correct. Like you're maybe in the ballpark. A common one is people will feel guilty or self-critical when they're really annoyed or irritated with someone or something else, because it's safer to criticize ourselves. And like in the coaching relationships, I'm often like, well, of course you feel that way, irritated or annoyed at your boss or whomever, or even the market as like an entity, because the market functions as if it's another person, particularly an authority figure, like the cops or your dad or, and so you can get mad at it. A lot of trading psychologists will say, oh, don't have that feeling. All that's going to do is turn into overtrading. Like, just be mad at it, Like, realize it's difficult to climb the mountain of the market. I keep adding different metaphors, but like it is difficult, and it does feel like it's out to get you, and you do want to fight back. So like realize that, and to Bill's point, be able to say, I want to fight back, because being able to say it keeps the energy here as opposed to in the buy or sell button.
Mm.
And that's what you want. I mean, you first want to stop yourself from doing, the impulsive trades. We've always said, stop the impulsive trades by controlling the emotion. What we're saying is understand that emotion. Like you're mad at the market for being so difficult. Okay. What's the, then like you realize that, then you can say, okay, what's my best strategy? That's what happens is you be able to develop awareness. You be able to, John will sometimes say, put space between the feeling and the action. And in that space, you can then use your intellect to say, what's my best move to get what I want from this other person of the markets, so to speak. So awareness is a big endeavor. It is. And it comes and goes, and certain situations are harder than others. And I mean, we have clients for years, and the reason we have them for years is, you get more and more aware, but it helps people, even professionals, to have someone to sort through, is what I'm feeling about the market, or is what I'm feeling about my P&L, my teenager, anything other than the market.
Right. John, I think,
Yeah, sorry. One thing, I used to think that I wanted that feeling to go away, and that the feeling that led to impulse in my case. But what I realized over time was the feeling was valuable, and the reason it was so intense was because it was about something not having to do with the trade. So for me, when the intensity level is super high, that tells me that it's probably something about the past that's kind of superimposing itself over the present moment. And so once I started to realize that, the noise went way down, the screaming of that emotion went way down, but the feeling was still there. And so it gave me super valuable information. And I'll just give a really practical example of this. I used to remember when I was in a trade and it was kind of the middle of the trade, not much is going on, like it's not going my way, it's not going against me. And I, through working with Denise, realized that when in my mind, when I was in that space, I said, well, that's why I have a stop. I got stopped out every time. So what happened was, when that combination happened, I got out of the trade. But I also tracked it. I didn't just make a decision and say, I tracked it before and said, oh, wait, this combination is actually doing something. And then I tracked it after to confirm that it was correct. So again, this is the way to use these feelings within a structure of a trading system to kind of amplify, create another edge on top of the edge that we have.
Yeah, and that was actually going to be my follow-up question is, and what you just said was kind of an example of it. How do we build that skill of awareness? And it sounds like journaling, tracking those states of when you were feeling that was that step. So I was going to ask you guys, when working with clients, do you give them any homework or like things to do as they're trading to work on that skill of awareness? And I also was going to ask, are there any physical manifestations of common emotions like tapping your feet or an increased heart rate or something like that you like to have your clients keep track of? Should we all be wearing our Apple watches and watching when that boosts up? And Bill, maybe hand this over to you, unless you think somebody else would be best suited for this.
Well, I think the idea of exercises is dependent on the client. Mm-hmm. I think the best exercise is the coaching session. One thing I do sometimes is, we try to get clients, as I mentioned earlier, to put their feelings and their experiences into words. And some people have a difficult time doing that. So when they start out, I suggest, okay, if you experience an emotion that you recognize, but maybe you don't have a word for it, and this can be while trading or any time, but I recommend this during a trading day, is just make a check mark on a piece of paper. Start out just recognizing when a feeling comes up. Then, after some period of time with that, getting comfortable with that, then say, okay, what is there a word that comes to mind? Just one word, and then build on that practice of adding words and being as describing as many different emotions and as many different variations of a particular emotion. There can be fear, terror, apprehension.
The intensity of it.
Yeah, different intensities. So
right.
That's a way. That's one exercise that I sometimes recommend to just help people get used to the process of first recognizing when an emotion comes up, and then second identifying the emotion as they get better at that.
There's an actual skill called emotion differentiation and emotion granularity. Differentiation is like knowing the difference between fear, frustration, disappointment, like big categories. And then granularity, like if we take frustration, from like minor annoyance to enraged. And there's been research showing that portfolio managers who better differentiate amongst their emotions make more money. So one thing I'll often do, particularly when I am new with a client, and it's funny to see the results, I'll ask them to make a list. And a lot of my homework involves make a list. But in this case, it's make a list of every emotion they think occurs during their trading or portfolio management. Sometimes they call it investing, but yeah. Anyway, some people will come back with like 3 words, and some people will come back with like 300. But think about that. That's saying that the person with 3 words probably has less skill of emotion differentiation and granularity than the person with 300. And because, to Bill's point, there is actual research that being able to put this stuff in words and to get it right helps you pull out that information about the trade versus about anything else. You end up realizing that you're irritated that whatever, the dog sitter didn't come, or, irritation is a perfect one. When people are irritated or annoyed, you kind of feel out of control. Someone didn't do what you wanted them to do. It's like something didn't go the way it was supposed to. Well, feeling in control, you can feel in control by clicking on this thing. So you will click on this and take a trade to gain that feeling of being in control, as an antidote for, you feel out of control because the dog sitter didn't show up or whatever. And you don't realize it. But if you end up saying, okay, I am really annoyed at our dog sitter, or our teenager, or the tax guy, or the whatever, then you don't have to pick this up. And you don't have to take a trade that you didn't mean to trade because you didn't channel that emotion. You knew what it was. You could say, I feel out of control over this, and that's really super annoying. Okay, let me focus on what would be a good trade. You can channel it into intention of what you want, as opposed to distort it to just change your feeling. Well, in any event, yeah, I will ask people to make a whole list, and then I'll often ask them to take the words that are in the category of fear, which includes confidence, right? Are you terrified on one end, or are you overconfident on the other? And make themselves some sort of scale that they can work with on a regular basis. Am I slightly worried, or am I concerned, or am I afraid, or am I terrified, or panicked, or, am I confident or overconfident? Because then they have their own words. I think Bill he used apprehension, but you can't really see this article. But this is about Lindsay Jacob Ellis, the Olympic snowboarder. I taught her to do this, and she was able to say she had trepidation going into the Olympics, and that was a word that resonated with her. Mm-hmm. And it helped her get out of the gate faster. It helped her focus fear is a normal thing. People will tell you, do all these exercises to get over the fear. Generally fear is meant to help us do more of what we need and less of what's dangerous if we understand the fear/worry that's about the thing we're trying to do, as opposed to anything else, like our P&L.
Another exercise that has been pretty successful with teams of traders and analysts, or PMs and analysts, is what we've called our conviction spectrum. And there are a lot of 1 to 7 scales that people use in psychology and other areas, and people typically will put a number to it. What we do, and what the research has shown, is that putting a word to a different level, a different rating, is more useful than just putting a number. So we'll have people, particularly teams, come up with these words from the lowest conviction or confidence in an idea or a trade to the highest. And then they'll talk about them, and they'll come up with a common one scale, one conviction spectrum, and then they use that. And we've had teams that actually track that over time with a position, or use it to when they start a trade or get ready to put a trade on. They'll see where they are, where the team is on that common conviction spectrum, that they all know what the words mean. And that's an exercise that's been pretty useful with some of our clients.
It helps particularly because it gives people who think they're not supposed to be thinking or talking about their emotion a way to do it. Like, because they've agreed that these emotions are the kind of things that they feel. We have one client, it's a $12 billion long only fund. They have actually been doing this for 5 or 6 years now. And they did conclude, to my surprise, that their overconfidence actually is their best decision place. So now they, like, that to me is I always wanted something on that spectrum that reflected hubris, when you're getting too confident. But for whatever reason, this group of people, and there's about 20 analysts and, like 4 or 5 managers, they have a PhD in a research guy, and he tracked all their trades over all these years, and they've come to the conclusion that their 7 is where they make their best decisions. So they've switched their scale now to, like, that's their optimal conviction, ranked at 7. But I mean, even though it was a little bit different than I was expecting, I was super happy to hear it, because they were using it, they were thinking about how they feel, and I mean, they are so fundamental, in their research, that it must be when they get to the point that they're really willing to say that I'm super confident, they've done the right research, it would appear.
Hey, may I just add one thing real quick, and then we could go on to the next topic, or maybe Bill something else. But for me, one homework assignment that I really like is collecting random thoughts. When you're brushing your teeth and position comes into your mind, pay attention to that, grab onto it. It's giving you information. It's the unconscious kind of whispering. To me, it's kind of like a dream, right? When we wake up, sometimes we remember the dream, sometimes we don't. But if we don't kind of bookmark it in some way, it disappears. So I like to have my clients collect random thoughts throughout the week and then talk about any patterns that come up, because I think really that's the unconscious whispering. And if we don't grab onto it, that whisper just goes away. It's different than impulse. Impulse will yell at us until we pay attention. The kind of intuitive voice just gives us a little whisper and says, you're not interested, see ya. Gone forever.
Yeah. I have a really great example of that. What I'm going to say, just to put it in context, like we talked about, is the feeling about the problem at hand or anything else. Like, intuition is the feeling you get as a result of, like, all kinds of, past experience, right? Studying explicitly, getting experiences, learning things. Then you're unconsciously seeing a pattern, and your body just gets this feeling of, like, I sense what's going on here. And it'll maybe deliver it to you when you're brushing your teeth. Years ago, now 15 years ago, I was coaching at a place called Graham Capital in Connecticut, and their then head trader, they kept giving him more and more capital. And this big, beautiful building up on a hill, and the parking lot's a fair amount away. He would say to me, when I'm walking in from the parking lot, I know what the S&Ps are doing. I know what the bonds are going to do. I know what oil's doing every morning. He said, then I sit down on my Bloomberg and I start reading the news, and I get all twisted around. He goes, if I would just trade what I thought in the parking lot.
Yeah.
The skill is to learn how to know that, like, to know that John just talked about how impulse, like, yells at you and wants you to do something and is very agitating. Intuition is just, yeah, that's the way to do that. Like, it's just,
it's more subtle.
It's this calm sense, like, of what's right. And you can target knowing, is the feeling about the trade or not about the trade? And is the feeling intuition or anything else, like as an objective? So that you set yourself up like strategies and tactics to develop the awareness, to get better at that. So more of the time you are choosing to act with the information coming from the feeling that's about the trade that has an intuitive component. Which, by the way, and I'm going to say something, that some people will be upset about, but like it ends up usually causing you to have ways to deviate from your rules. Because it's telling you, when you get that sense of something, the trade really isn't working, even though it's not going against you yet. Like, right. And you can get permission to have some fluidity within like your structure of how you trade that is based on trusting yourself. If you've gone through like the sequence to develop awareness, categorize these feelings, learn when the feeling is mostly this or that. Are you going to be right 100% of the time? No. Are you going to be right more of the time than not? Yes.
And that actually goes really well with one thing I wanted to ask you guys is, how does the trading decision-making process differ between someone who's much more advanced and has gone through those steps, as you talked about, studying, winning trades, actually gaining the experience over years and years, working with a mentor who's very successful, who taught them how he approaches things, versus someone who's very new to the markets, maybe just 1 year, more of a hobbyist, just getting into it. How is it different based on what's actually going on in the science behind how they're making decision making, and just how they approach everything? Is there a big difference? And Denise, maybe start with you if you've got a good train of thought on this.
Well, I think one of the big problems that independent traders don't actually realize they have is they're not sure they really believe whoever's teaching them. So like if you go to Goldman Sachs and you go through your 2-year training program and then you get put as a junior person on the trading desk, and then over the next 5 to 10 years someone teaches you to trade, you don't actually question, do these guys know what they're doing? Because you're at Goldman Sachs and they're making billions of dollars. Of course they, and you watch them. Well, when you start, okay, there's all the banks and there's hedge funds that have training programs, but when you start almost anywhere else, you're not really sure. And everybody makes trades that lose money, right? And so like maybe you notice the trades your mentor makes that loses money versus the ones they make that make money, or maybe you don't understand. So you start out with this huge disadvantage of being unsure, am I actually learning the right way to do this? So a way that I try to get people to solve that is like, listen to themselves. Mm-hmm. Do they really do they really believe this person is helping them over any period of time? And is their approach to doing it, does it work? Number one, does it work? But number two, does it make sense to me? So there are, effectively an infinite number of ways to make money in the market. You've got to find one that, like, the way you watch prices and the time frame that you watch prices and the way you see prices move, like, makes some sense to you. Like, if it doesn't, you're not going to be able to trade it. And people don't realize that they need to sort of go through this process of figuring out what's the best way for them to learn to play golf. Like 2 weeks ago, I was in a clinic with this really great instructor, and he talked about when he had very intellectual, highly analytical people, how he talked to those people versus when he had very feeling-oriented people, and how he talked to those people. And like people will learn, oh, so-and-so knows something about trading. My friend learned trading from this person. Oh, I'm going to go learn it from that person. Well, maybe that person's way, either of trading and or of teaching, does or doesn't speak to you. Right. So I just think there's this huge gap. If you start at Goldman Sachs and they teach you, you believe them. If you start anywhere else, you're not really quite sure. And you got to figure out how to solve that problem first. Mm-hmm. Because you need to believe that the way you're trying to do it will work if you can do it that way. But people never stop to ask those questions. Like, again, and to do that, you have to listen to how you feel. Does this person seem like they have integrity? You know, do I believe the way they're going about this? Like, and listening to your intuition about, do I, resonate with this person and the way they think about markets? Right. Like, does this make, people have heard me say this before, and like, options never made any sense to me. And I started with guys from the Chicago Board Options Exchange. And I was like, why? Why do you not only have to be right, but you have to be right in a certain time frame? And you can be right in the wrong time frame and you start losing money. This just seems too darn complicated. And I don't care that I only need $1 to buy this $80 stock. I'll just buy the $80 stock. Because whether it's going up or down seems way easier to me than that having to add the whole time frame. Not worth the dollar. But to other people, it makes complete sense. Okay, you guys have at it. But I had to do that for myself. Right. And new traders don't necessarily know that, like, if they were going to hire a tutor for their daughter, they would go through sort of this process of what's that tutor's method, and do we do that?
Excellent. And are there any other bits of advice for traders setting out, or even common mistakes that you find traders make around trading decisions to look out for or to avoid? And Bill, maybe start with you on this one.
Well, both Denise and John have both former professional traders, and I'm not. I trade my own account, but that's about it. So I'd like to turn that over to one of them.
Sure, John, go ahead. If you got something.
Yes, sure. You do not have intuition. Let's start there. If you haven't traded for more than 5 years, you do not have intuition. Let's just start there. Now, some people may, but I'm always shocked when I work with retail traders. They are convinced that, the system's good, but I really felt that this was going to go. And when I talk to a guy who manages lots of money and is a professional, and we start talking about intuition, he's like, I don't know. And so to me, that's very striking. People starting out, I think, one, the chaos of making a risk decision in the brain, because the brain wants certainty. That's why people jump from system to system to system, trying to find the Holy Grail. And like Denise was saying, this kind of dovetails nicely with what Denise was saying, because, we have to understand what we're trying to do. And so for me, finding one way and doing it, that's probably the way to do it. And then saying, well, you know what? I'm a breakout guy or a mean reversion guy, and I'm trading the opposite. Okay, I should switch. The other thing, too, is that I think when we learn anything, the kind of the path from the novice to the master goes through complexity, but it reaches a peak of complexity well before you're at mastery. And so what is beautiful about masters is they strip complexity away. Now, it's embedded in what they do. Josh Waitzkin talks about this in The Art of Learning in a beautiful way, that, the master makes a move and he can see whatever, like sequence. He can see 500 frames where the beginner sees 2. And so for me, it's about that. Like, until you can build the Legos with the really big Legos, and then you get the smaller Legos, and then you have different colored Legos. Like, there's a progression to this trading thing. And I think starting simply is best, and really being rigid about rules and understanding that there's going to be all these crazy feelings that are, like Denise was saying, not about the market. You're in the market, but they're not about the market. And the other interesting thing I've been thinking about recently is that our eye is attracted to movement, right? Our ancestors needed to see movement and recognize it and do something about it, or else they wouldn't have been our ancestors. So when we sit there and win our trade and there's all sorts of chaos going on, and we're seeing that thing going this way, oh my God, oh yeah, oh no, no. Take a step back and say, okay, the uncertainty of this moment is going to feel awful. But I have a structure to deal with that. And then as we progress further on, like Denise was saying, we could add the feelings as additional information, but it's a process, unfortunately.
Denise, anything you'd like to add? Yeah.
Yeah. So at its core, a trading decision is a decision about other people. It's called theory of mind. Like it's a decision about like, where are the other market participants going to move this price? Based on what? And it doesn't matter who you are in the market, what your system is, what your time frame is. That's the thing you want to know. You want to know, like, are people going to be more people wanting to buy this or more people wanting to sell it, 1 minute, 1 day, 1 week, 1 year, 1 century from now? That's what you're trying to. And everybody's going for that. Thing is, human beings are actually good at that. Like, we all have this theory of mind. I have a theory of your mind. I have a theory of the market's mind. So on one hand, trading's the hardest game on the planet from a mental point of view. You do need to find someone to mentor you who makes sense to you, who you trust, who you believe in. You need to go through the structured pieces. But at the end of the day, you actually have the innate skill to do this. And people forget that. And so what will happen with traders who are earlier in their career is they will get flashes of intuition, but they don't really have the skill to recognize it, right? Like, so that's what you got to get to the point where you have enough skill with the thing. Like if you're cooking, you use a recipe, and the more you cook, the more you can maybe deviate from the recipe a little bit. Like, but first you got to start out step by step by step. So I just wanted to point out that while you can't trust your intuition when you're newly into it, on the other hand, you do have the core skill. And when I ask all of my clients, no matter what level they're at, to add in, why are other people going to pay more for this? Or why are they going to sell it for less than this? Like the direct people question. I'm buying it here, and what is going to cause somebody to pay more for this? They tend to make better decisions. Tends to help you recognize a short squeeze. This thing is moving up crazy quickly because there are a bunch of shorts who just went out. Like, which may not mean you want to buy it, but because theory of mind is a core human skill, if you ask the human question or you incorporate it methodically into your process, chances are you make a better decision. In the hedge fund world, they call it positioning, but it's what are other people doing?
Yeah. Interesting. And this is something you guys brought up that would be a great topic. What can be done to help understanding around predictions and therefore decisions? And Denise, maybe start with you.
I'm just going to go back to, realize you are making all kinds of predictions. First of all, ignore anybody who tells you to stop making predictions because it's impossible and whatever, I don't know. It drives me nuts. I hate advice that's really bad. And I feel bad. I mean, I've seen so many new traders struggle and put their heart and soul into it. And then I see them get this bad advice and it's like, endeavor to know what you're predicting. Because inevitably it goes like this. If I'm predicting this, I'm in this trade, I'm predicting it's not going to work. I'm predicting I am going to lose money. I'm predicting to be my third loser in a row or my third loser this week. When I tell my spouse that I had another loser, they're going to be mad at me. And then when they're mad at me, they're going to tell me I can't trade. And then if I can't trade, I'm going to have to go back to my boring job. And if I have to go back to my boring job, we do this. Human beings do this all the darn time. And you don't realize that your hatred of the idea of going back to the boring job takes you out of the trade or puts you into the trade. So when you start to realize that really you're trying to avoid the boring job, which is 2 years or 10 years away, then you don't have to avoid the boring job by doing the trade right now. I'm not kidding. Take that little monologue I just gave you and do that. You don't have anything else we said. Realize that if this trade works or doesn't work, if I get in or out, leads to not only the boring job, but maybe, I'll have to leave my family and go and live on a sailboat because I can't take the boring job, or all kinds of crazy stuff. It's happening all the darn time. Everybody's doing it. If you just realize your end, I mean, I had a client who turned 5 million into 450 million. It's a true story. He took a break. He told his wife he'd help with their kids. And he said, Denise, I am more nervous making sure I get my kids to school than I ever was when the Singaporean dollar was like, orders of magnitude against me. Well, he realized I was like, well, what happens to this? And what happens to this? We went to what the next. He was afraid his wife was going to be so mad at him that she'd kill him. Now he knew she wasn't really going to kill him, right? But they're young kids and he damn well better get them to school on time. And he burst out laughing. And what happened? His anxiety about taking the kids to school went down. Because, so literally, just learn to become aware of the layers of prediction. And back to what Bill, put them into words. And then you don't have to push the button to avoid something 17 layers down that's going to possibly happen to you.
Bill, John, anything you'd like to add on that?
Bill?
I think that covers it for me.
I like that. The slippery slope. One way, your riches and fame and all this, and then the other way, poverty. I like that.
Right.
Yeah.
Well, and the riches and fame. If I do this, and if I add to this here, and then I'm going to be. It usually goes through the path, by the way, for most people of am I smart or not? Am I a genius or not? Am I an idiot? Usually, almost every client I take through this, not the guy taking his kid to school, but it goes through this am I smart or not, which is a proxy for can I depend on myself or not.
Yeah, when I would go Ferrari shopping when I had a trade on, I knew that wasn't going to work out over time. And when I was deathly afraid to take a trade, those are the ones that probably worked out. So yeah, it definitely. The other thing was that my experience was amazing because on the trading floor, I didn't have to keep anything in. It was, I mean, I could scream and yell. It was part of the job, both to get trades, but also to vent energy. So I really had a tough time trying not to scream and yell when I was upstairs. And that took part of the game away from me because I was doing what I thought was right, which again, I probably shouldn't be screaming and yelling profanity in the office when nobody else understands the context, but being able to feel those feelings and write them down or just kind of vent them in a positive way, I think is something that's very valuable and it needs to happen or else we make other decisions or compensations that don't help us be productive.
Excellent. This has been fantastic. A lot of it I'm going to have to rewatch and take notes and dive deeper into it. To close things out, I'd love to hear maybe from each of you guys, what's one piece of advice or recommendation to traders watching this that you think can help with their decision making? And based on what a lot of we've discussed today, it's improvement on reflection, communication with yourself, thinking about positioning. Denise, you talked about that. Adding in space between awareness of the emotion with the action that could have negative consequences to it. So Bill, if I could start with you, what's one thing that you think traders or just anyone can do to improve their decision making, whether it's an exercise or just a way of thinking about it?
I think the first and foremost, I don't want to take anything away from John or Denise, but I think don't be afraid of being aware of one's feelings and emotions.
Perfect. Excellent. John?
Be kind to yourself. I think most people spend the day looking for the stick with which to beat themselves. Be kind to yourself.
Excellent. Denise?
Yeah, I was going to say a version of both of those, but it boils down to stop judging yourself. First of all, this is the hardest game on the planet. It is going to induce in you all kinds of emotions because it has all kinds of symbolism. Don't judge, seek to understand. Don't judge us, don't criticize yourself. Don't think that so-and-so is doing so fabulously and you're not an idiot. And that was my point about theory of mind. You have innately theory of mind as a human being. So net, give yourself a break.
Excellent. Well, Bill, John, Denise, thank you guys so much for your time. I'll have the link to the Rethink group down below, as well as I believe your program that you guys recently started, I think last year. Where else can people reach out to you, or if they'd like to learn more about what you have been discussing? If they want to learn more from you guys, where would you point them to?
I wrote a book a long time ago now called Market Mind Games, which I may be able to update finally. That's finally in process, but it's still out there. I am on Twitter as Denise K. Shull. I only tweet about trading like 25 or 30% of the time. I tweet a lot more about health, because physical health is like, and energy is like a foundation for everything, right? But it's foundation for this. Yeah.
There's also a contact us. I know you see contact us on a lot of websites, and I'm always uncertain whether I'm going to get a response to one of those, but we do respond to the contact us messages that we get. So that would be another place.
Great. Well, thank you guys again, John, Denise, Bill. Appreciate your time. To everybody watching, hope you guys enjoyed this quite a bit. Check out the links that we put in the description, as well as the resources they mentioned, and we'll be right back. Thank you. All right, and with that, everybody, welcome to the end of day one of the TraderLion conference. The sad thing is it's the end of day one, but the great thing is there's 5 more excellent days of fantastic speakers that I'm really looking forward to. So thank you guys all for attending. One thing quickly in the chat right now, let us know what was your favorite presentation from today. I'd be really curious to see what you guys thought. And again, just a reminder that there's some amazing speakers coming up very shortly. Morgan Housel, Victor, and Sperandillo are speaking tomorrow. They will be fantastic. So definitely stay tuned and stay on the lookout for the link to tomorrow's session. A few quick things. Again, if you want access to the slides, extra resources, completely free, we've got the VIP pass that all you need to do is go ahead and scan right here or click the link in the description. You can get access to all of that. And not only from this year's presentation and conference, but also from all the previous year's conferences. Definitely go ahead and take advantage of this. Also, a huge thank you once again to Ninja Trader Live for helping make this possible and for powering the conference. This is a tremendous resource that you definitely want to check out. They're live at 6 days a week with real-time analysis and lessons and fantastic educators as well. So highly recommend you go ahead and check out their platform. Again, you can scan the QR code right here or also click the link in the description to learn more about Ninja Trader Live. One more thing, just a quick reminder, if you haven't yet picked up your copy of the Trader's Handbook, go ahead and do so. We worked very hard on this resource. It was just released a little over a month ago now. We've already had 13,000 plus readers, over 400 plus reviews on Amazon with a rating of 4.9. Very proud of that. And it's endorsed by Market Wizards. So if that's not enough, Stan Weinstein says you should go ahead and pick up a copy for your trading library. Also, if you haven't yet, just a quick reminder that we're currently offering for the first time ever a free month of Deepvue. And all you have to do is visit deepvue.com and follow the instructions there. This ends July 27th, so make sure you go ahead and lock in your free trial before then. But all you have to do is go to deepvue.com. No credit card is required. All you have to do is follow the instructions on our website. This is my go-to and the only one I use for screening, watchlist management, idea generation, all of this. And we're building so many great features that help you save you time practically and trade more efficiently. So definitely go ahead and check it out if you haven't already. Here's tomorrow's schedule. So we've got Morgan Housel kicking things off, then Victor Sperandillo, Marius Stamatudis, Brett Stengbarger, Scotland, and then the Lifecycle Trade team with Eve Bobak, Kurt Dale, Kathy Donnelly, and Eric Kroll. Fantastic lineup once again. We'll be starting at 9:30 a.m. Eastern. And again, you can see the topics right here. And with that, let us know in the chat who you're most looking forward to tomorrow. So let us know, which topic and which presenter you're most looking forward to hearing from. We've got Market Wizards. We've got some great momentum traders in here, some trading psychology in there as well. So again, there'll be a little of something for everybody. And this should be a fantastic day 2. So look forward to seeing you then. And with that, thanks so much for tuning in, and we'll see you right back here tomorrow for the next set of presentations. So take care, and we'll see you soon.